Okay, hello, good morning, everyone. So as people start streaming in, I will do a little short opening. My name is Parveena, and I am the co-founder of the Stable Summit series. And some of you might know, the first edition that took place back in 2023 was held in a basement in Paris. And since then, we've taken stablecoin conversations around the world, from Istanbul, Denver, Bangkok, Brussels, Singapore, and many more. And now we are back in Cannes for the second time in a row. And this is definitely our fanciest edition yet. And so yeah, basically we went from a basement in Paris to a Cannes Film Festival venue. And at that first summit, I remember we held a workshop where someone in the audience yelled, "When institutional adoption?" And it got a laugh, and it felt very far away. And this was in 2023. But today, in today's program, we have speakers joining us from Franklin Templeton, Deutsche Bank, JP Morgan, SG Forge, Stripe, and even representatives from ESMA. And I think that question from the workshop back then has now been answered by the people who will be joining us today. And many of the teams that were at that last event, at the first event, sorry, in Paris, are also here with us today. Our hosts, Curve, teams like Teller, Aave, Liquidity, and even OGs like DeFi Dave, Token Bryce. They're both here. I saw them around. And we're really very grateful to all of you for your support. And honestly, Stable Summit exists to serve each and every one of you in this room who is so dedicated to building the future of finance. And all of us, I guess for all of us in this room who are usually the only stablecoin passionate people at family gatherings, we're all in for a treat with the program lineup, which you can check on the website, or like there are QR codes around so you know what to expect for these 2 days. And of course, none of this would be possible without the teams supporting our work. I want to say a massive thank you to the Curve team, who have hosted every single edition from the start. Curve, as you all know, is the home of stablecoins on-chain, and Stable Summit is the home of stablecoins off-chain. And of course, another massive thank you to our title sponsors, Bridge. We're very excited to have you back, and our partners, Enterprise Ethereum Alliance, for all their support. To all our other speakers and sponsors, you can see their logos on stage. None of this would be possible without their support as well. And thank you for allowing us to create the most impactful edition yet. Now, without further ado, I'm going to go ahead and introduce the first talk, which will be by Michael Kay on the topic of FX swap, from market design to on-chain deployments. Welcome, Michael Kay, everyone.
Hi. Good morning, everyone. So my name is Michael. I work at Curve Finance, and today I'll tell you how we at Curve approach Forex markets on-chain. So let's start from afar. What's Curve? Some sophisticated people may say it's just some squiggle. Some more crypto-oriented users will immediately think of some bonding curves of, I don't know, Uniswap maybe. And me, because I work at Curve, for me Curve means it's like a pioneer decentralized finance protocol that relentlessly is shipping for the past 7 years, starting from StableSwap, the primitives in DAO, and all the way through lending and stablecoin, and now we're shipping the Forex markets. To talk about Forex markets, we need some proper background on automated market making. And I hope you all had sufficient coffee amounts, because I will start from math. Well, a simple one though. I hope everyone is familiar with constant product invariant. This is stuff that's moving billions of dollars on-chain daily on dozens of EVM forks. And the way it works is it's a passive pool that has some tokens, say one token and another, and it has some law, x times y equal k, that governs what is the price based on the reserves. So if you perform a swap, you give some amount of token x, and AMM gives you some amount of token y. This is good for price discovery on chain, but this is not very good for Forex markets. In Forex market, you have some price that AMM should respect. So if FX price remains at 1, and your pool was just imbalanced with some swap here, now the fair price is this, but your pool gives you some other relationship. If you give the same amount of token X, it now gives you less token Y. That's called slippage. And that just shows that this kind of invariant is not suitable for Forex markets on chain. What would be the perfect Forex market invariant? This would be constant sum. This invariant is so perfect, and yet nobody uses it. Why? Because it fixes some price. Let's say we have price of 2 assets and it's 1, and then everyone can come and swap. I give token X, I get token Y. And then I repeat this, I have exactly the same situation. However, what happens when someone trades a lot of token X to token Y? Pool gets imbalanced, it doesn't have any more reserves, and it's unusable on chain. Now, what did Curve do to facilitate swaps where you know the price, but you also need to respect the reserves of the protocol? It combined these two invariants into something that's called stable swap. So you see, it has a constant product part, it has a constant sum part, it also has some parameter A that regulates the slope. The idea is to combine positive sides of these two previous invariants. So we have a good slippage region in the center, and then towards the tails we have something that protects pool reserves as large swaps happen on chain. So indeed, as we do the first swap, we can see we behave almost as the constant sum. So we respect exactly the price that's coded into the invariant. But then as the reserves deplete, we start acting with slippage so that the pool remains functional. Now, from abstract AMMs, let's go directly to the example of a real Forex pair, Swiss francs to USD. This is how the plot looks like for the past 8 years or so. We started from around 1, so 1 Swiss franc was worth $1, and now, thanks to politics, we are at 1.3 US dollars for 1 franc. So what would happen if we create an on-chain pool in 2019 with our stable swap invariant? We see that we are perfectly reserved, we have the best slippage, so if people swap back and forth, we respect the price of 1. Now, fast forward 7 years, and the price is 1.3. Our pool has less Swiss francs, more dollars, and here we're far from the center where we initially were. That means that we give worse slippage. So whenever people swap, they get less token than they could if the pool would be perfectly centered. So what can be done here? We can say, okay, now we want to recenter our pool. We want to act so that 1.3 is in the center of the pool. We can do that. Mathematically, we actually just shift, rescale the reserve variable, and then we recalculate the invariant. But what happened here is that the new position yields lesser invariant than it was. We actually fixated the impermanent loss. We rebalanced the pool. We now are in the center and we give the best possible slippage, but we lost some value. So here is the animation of what happens in the pool. People trade back and forth, and when they trade, they leave some reserves in the pool, meaning that invariant goes up. However, when pool decides to recenter, it loses some value and invariant will go down. So the source of loss in on-chain AMM is this rebalancing when you say the new fair price is now this, and I want pool to work around this price, and this means you lose value doing so. And pool earns when people swap inside it. So they come, they leave the fees. And it can be arbitrageur who comes from external market and brings you information of the fair price and at the same time moves your pool. And it can be organic users who just want to unwrap off-ramp, sell some stable coins. Another source of AMM income could be the refuel. It's something that we do at Curve that facilitates this rebalancing from side of asset issuer. So literally asset issuer will pay so that the pool now provides best slippage and this way rebalances. Sometimes it's justified because if you rebalance the pool, it gives you better slippage, more users come, more fees, and it's kind of offsetting the costs. Now, what do we want from our on-chain AMM applied to Forex? We want it to perfectly track external price with its center, because this is where we get the best slippage. And we want it to be automatically. We cannot just say, okay, now we rebalance. Well, we can if we use other protocols, but at Curve, we want the full autopilot. We want the AMM to just itself automatically follow external markets. And it should not leak value to arbitrageurs. For this, it should protect itself with the fees. It should have a good rebalancing strategy. And now I will show you the live example of the Swiss franc pool, the Franken coin, on the curve. Here we can see that fair price around 1.3. The red line is external true price of the Forex market. And we can see the liquidity concentration in the 0.5% bins. That means that, for example, at this image, if you swap $40,000, you move price 0.5%. So this is exactly this liquidity concentration you can see here. Oh no, the Mandela access. No video. No worries. I have it in the very end as a GIF animation that doesn't need any access. So we can see here that the liquidity follows the true price, because arbitrageurs come, they can always buy in the pool cheaper than the market, so they move the pool center. We can see that there is this refueling budget where Frankencoin team added some funds so that the pool tracks better. And we also saw that the liquidity rose because this was the pool that had adjusted a parameter somewhere in between. But the idea is that the pool there tracks very nicely the external price. So how do we design a pool that tracks with its liquidity center the external price perfectly? Well, if we just deploy any random pool, we say, okay, here is our A parameter, here is now no refuels, and we fix some fee, and then we just play it around and we simulate it against the arbitrageurs that kind of trade into the pool if they have profits doing so, we can have this picture. What we see here is the true price of Swiss franc, and this yellow line is this pool center position, the mathematical one that gives you the best slippage. And if we just pick any random pool with any parameters, we might have a result like this, where our pool kind of exists, but it does not provide the best possible slippage all the time. And we can see that parameters yield so that over 8 years, arbitrageurs just do 1,000 swaps, so the pool isn't really active. And if you swap, like if this pool has $1 million and you swap 5% of this size, 50,000, your slippage will be 3% on this. So pool works, it's automated market making, but it does not behave optimally. Now, if you select other parameters, let's say we want a bit lower A, this concentration value of the stable swap invariant. The pool is a bit more active. Arbitrageurs brought 8,000 swaps, but the slippage actually got worse because you reduce the A. That means that you are now in a worse slippage situation. Now then, if we do some magic called optimization, we find that with A equal 50 and some refuel, your pool center mathematically will follow the Forex market precisely, meaning that at every moment of time, the pool guarantees that the center is exactly at the price and you get the best possible slippage. So you see that with these parameters, if I swap the 5% of pool TVL inside, what I will pay is exactly equal to the fee. So you're in no slippage situation. You're at a stable swap that behaves exactly as constant sum. And whenever price shifts a bit, you recenter it smartly. So how do you do that? Well, you can just brute force all parameters or you use some numerical optimization. But what we do, we just do the grid searches. And here is the grid search where, for context, to simulate such pool, it's, I don't know, second or two on some MacBook, so it's not very extensive. Now here is a grid of 32 by 32 pools, which is like 1,000 pools. On y-axis, we have this A parameter, the pool concentration, and on x-axis is the fee of the pool. And we see that in such grid, if we fix that there is no refuel in the pool. So the asset issuer doesn't sponsor the rebalancings. We see that the price difference is around 5%, which actually is like, it's somewhere around this. So whatever we do, if we don't refuel the pool, it doesn't behave nicely. Now, we say that the refuel is 3%, means that asset issuer have to refuel the pool with some assets to facilitate the rebalancings. 3% means it's 3% of TVL annually. And we see that now in this grid of the A versus the fee, we have some patterns emerging. We see that if we pick A around 50, it will yield the best profitability for the LPs in the pool. So when people come and add money into the pool, you don't overspend on the donations, on the refuels. Also, we can see that here the price difference has a front where you see that it's below 1%, meaning your pool has centered around the price at all times. So we are free to pick some parameters. If asset issuer says, we want a pool that takes 10 basis point fees on every swap, we tell them, all right, then you take a pool with your liquidity centered with A equal 40. So the grid there was just A against out fee. These are two parameters. And if you do a grid density of 32, you have 1,000 pools. The thing is, when you design an AMM, it's very hard to have a code that relies on two parameters. In fact, we have around 15 of those. And if you run some quick math, 15-dimensional grid of whatever density is a lot of compute. So you will not handle it with purely a MacBook. And what we do is multidimensional computation sweeps across a variety of parameters. And here you can see the interface where I just sweep through various rebalancings, and I can see many metrics that we track when we deploy on-chain pools. There's at least 10 metrics that I have to analyze very carefully. We see them changing, and it's our job to actually do the proper backtesting for each FX pair and to figure out the optimal parameters to deploy the pool. So what does this procedure give us? We have an AMM that is entirely passive, that doesn't need to be actively market-maked, that just behaves perfectly for this pair, and from asset issuer, what is needed is to just provide the refuels on time. So this can be programmatically set that they deposit the whatever percentage is optimal to Streamer smart contract, and they have an on-chain venue that provides low slippage, that respects external price, that automatically manages your liquidity around the center of the price. And this can be used, of course, for Forex pairs. I showed you the example of the Franklin coin. We have some euro, Indian rupee, Brazilian real. Interestingly, I think lately, someone deployed some uranium RWAs on Curve. We have some real estate tokens as well. And we have sophisticated DeFi strategies that use it for leveraging, for example, yield basis. I think I covered the entirety of it in 15 minutes. Yeah. Thank you for your attention. I hope you liked it. Do we have questions? How does it work? Please, Parvina.
We have time for one question, okay? One.
Hello, how are you doing? After seeing that you shared with us the pair with the US dollar and the Swiss franc,
yes.
What about emerging market coins? For instance, the Brazilian real, very solid and huge market cap.
Well, already on this slide, I highlight that we already have deployed pools with Brazilian real and Indonesian rupee. Asset issuers come to Curve saying that they want liquidity for their stable coins, and they want it paired against more solid currencies, so they use FX swap already. The TVL isn't that high, but we believe that it will grow.
Okay, thank you. Sorry, we don't have time for any more questions, but you can grab Michael to ask him questions in the networking area or something. But thank you, Michael. Okay, and next up, we have a panel which will be focusing on institutional use cases and adoption limits of non-USD stablecoins. If we can get the slide up, yes. And our speakers will be Sylvain Prigent from SG Forge, Johannes Kern from Frankencoin Association, Peter Groskopf from AllUnity, Sylve Chevet from Highly, moderated by Benjamin Levitt from Blue Chip. Welcome our speakers, everyone.
Hello, everyone. Good to see you in this beautiful venue and city. So, obviously, we all know USD stablecoins. They're about like 99% of the market, even more. But today we want to shed a light on all non-USD stablecoins and kind of why institutions are looking into them as well, what the barriers are for regarding adoption, and what we can expect for the kind of next years, because obviously with regulation in Europe, things will probably change now that institutions are getting involved big time. So with our guests, we would like to discuss these topics, and I would love for every one of you to introduce yourself quickly, please.
So I would start. Hello everyone, I'm Sylvain, I'm CPO of SG Forge, and mainly we are a stablecoin issuer for Euro and dollar, and we try to push the Euro as far as possible, so good discussion.
Hi, I'm Peter. I'm CTO at AllUnity. We're building a multi-currency, multi-chain stablecoin platform, which means that we already launched a euros-denominated stablecoin, the Swiss franc-denominated stablecoin, and we really believe into the future, in the future of non-USD stablecoins, and that's why we build our platform.
Yeah, hi. Good morning, everyone. My name is Johannes. I'm the managing director of the Frankencoin Association. We're the steward of Frankencoin. Frankencoin is a fully decentralized Swiss franc stablecoin. It's the largest in the market. And we're kind of the Swiss guys, right? Always talking about store of value instead of transactions. But that's going to be an interesting conversation with you as well after, I guess.
Hi, I'm Sylve. I'm the co-founder of Highly. We're a layer 1 blockchain optimized for ZK-based applications and specifically everything related to confidentiality.
Great. I'll have some questions for you today, and obviously feel free to chime in anytime. Some questions are for all of you, and some are just kind of individually, but we can just talk about it casually. So my first question would actually be to all of you, and it would be, when institutions are actually looking at non-USD stablecoins today, what in your view is the most realistic use case that they're actually kind of thinking about when they kind of want to learn more about them? Whoever wants to go first.
I start. So on our side, when we speak with a non-USD stablecoin and use case, we have one use case with demand for now is for, let's say, institutional entity that is a European base. When you do your accounting report in euro, and when your liability is in euro, you need to have the stablecoin, euro stablecoin for that purpose. But it's crypto native entity, and behind this crypto native entity is more, let's say, high net worth individual, SME, small asset manager. And in terms of, let's say, in the forward use case, the more advanced discussion is with corporate, and mainly for payment and cross-border payment and treasury management. And the last point that is quite interesting is about discussion we have with traditional market infrastructure, exchanges, clearing members, and custodian. That is the main, and it's more for collateral management and settlement for securities on chain.
I go next. So I think the first question is, and so I heard it a lot when I told people that we're building a euro-denominated stablecoin, especially people in crypto usually tended to react like, why do we need that? Yeah, so because we have this US dollar dominance, 99% or even more of stablecoins used in crypto are US dollar denominated stablecoins. And I think, and that's the response to the question as well, because I think that non-USD stablecoins really can't copy the history of stablecoins. So kind of becoming like strong in the crypto space. I think especially the non-USD stablecoins need to play an important role in the real world and in real world use cases, because in the end, so where's the relevance for different currencies, so like Swiss franc or euro or Hong Kong dollar and so on, of course in the real economy. Because if people want to receive salaries, if businesses want to pay, in the end they do this in their local currency, and we see more and more adoption in the real world. Also thanks to Stripe, for example, integrating it into their products, and banks being interested in using stablecoins and other distribution platforms. Stablecoins being integrated into fintech systems as well, and therefore I really believe that the usage for non-USD stablecoins will mostly be in the real world.
I agree and disagree with you here, Peter, because I think you're kind of interesting with the Swiss franc and the euro, and those two cannot be compared. I'd argue here. With the euro, I would agree fully with you. It's it's transactions, it's real applications, payments, But for the Swiss franc, as a special case, is a bit different, because it's more a store. I've said that before. I'm going to say it a couple of times probably today again. This store of value thing, which has its place also, not just in the real world, obviously. Agreed that we need to go towards real world applications and what we see, but also for crypto native users that want to move into a less volatile asset, which is not losing value as the dollar does. And that's where probably, and argue with me if there's other currencies that have those properties. The Swiss franc is kind of this, it's not digital gold, it's just like the less volatile store of value you have on-chain, and which also crypto natives can use. And we see institutions being quite interested in that, that to get back to your question here, what institutions see, but then liquidity becomes a big bottleneck, which probably is more one for us than for you guys, because we cannot just go and mint new Swiss francs or francoin with fiat, because it's decentralized. So that's like where we're building.
Perfect. Yeah. Sylv, no comment here. Peter, then
I could make a comment. Just wait if you wanted to say something. That's you raised an interesting point, because I think we really need to look into like every currency and kind of like judge. So what's the real usage for it? Because I agree, like Swiss franc really plays an important treasury function. I think even with euro, because you said it's for transactions, that's true. But also when looking into Europe as a whole, we have the euro system with SEPA Instant and so on. So like the infrastructure is pretty far developed. So it's also a little bit a question how many transactions are done in euro stablecoins within Europe. Yeah, so that's maybe also there other people in the round have an opinion to that, but so especially from the global perspective, when we have stablecoins in different currencies, we leverage that use case of global remittance and FX, and I think that's where it really becomes interesting, especially on the transaction side.
Yeah. And Peter, on that note of institutional use cases, for institutions that are already managing multiple currencies, generally speaking, is there something where non-USD stablecoins can actually kind of improve the workflow also for them compared to the kind of traditional banking rails that they're using today?
Yeah, so in general, stablecoins can be used in four verticals, how I always say it. So it's in payments, it's in remittance, so if you send money around the globe. It's in settlement, if you settle, for example, crypto assets or real-world assets. And it's in treasury, so you hold it and you want to earn yield. And I think coming to the institutions, I think we need to judge how like in what vertical they are and where they're located. Because like I said, for example, for European banks doing transactions from within Europe, I think I suppose that every bank would prefer doing transactions within Europe with the SEPA system, because that's the easiest for them and probably also the cheapest. So I think that's not really the use case. But in global remittance and in FX, I think it's incredible help to use stablecoins as a platform, also for integrating the technology into fintech products and so on. I think it's way more easy than using banking as a service or other companies and platforms of that kind. And then also, I think that has always been the end game, I think, also for people working in blockchain when it comes to settlement, because of course it's the holy grail that we maybe can achieve in the end, that you have tokenized assets, tokenized real-world assets from all across the globe, and you can settle them instantly on-chain. I think that would also be an incredible future for banks doing those kind of businesses.
Great, and Sylv, from kind of a payments infrastructure perspective, where are non-USD stablecoins kind of simplifying cross-border settlement today? What do you say?
Well, in the context of the euro, there's actually, I would say, massive bootstrapping issue compared to the US dollar, which is that no one wants this for remittances. It's extremely useful within the Eurozone, but like we pay people in stablecoins, in dollars, in the Philippines or elsewhere, but they do not want euros. So that's one less use case that we can have in order to bootstrap just liquidity for euro in general. And then you mentioned settlement, and that's actually another tension that we have in the Eurozone, which is, on the one hand, we want to move really fast with what the ECB considers commercial money, with like euro stable coins, but at the same time, they're moving forward with their own version of the euro stable coin, they're moving forward with Appia, they're moving forward with their digital euro. So it's moving a little bit in all different directions. And as for payments, like currently it sort of works, but it's completely lackluster when you compare it to like the residual demand that exists for dollar stable coins.
And Johannes, when we look a bit more on-chain, obviously crypto markets are very USD-centric. And what role would you say play non-USD stablecoins within DeFi and on-chain in general today?
Yeah, I mean, I always make this point for this differentiation between an asset and a means of transaction, right? Because if you do a transaction, you don't really want to hold that asset. And that's where the dollar makes a lot of sense, because then you want to have just the most liquid market you can get, with the lowest slippage, with the lowest fees, with the easiest on and off ramps. So where I see non-dollar stablecoins in DeFi is as an asset, meaning you want to use a certain product, you want to go short something, you want to leverage something, you want to build a basket. You know, the good example with the Francoin is Sakix Edelweiss, which is a DTF, which is kind of a, I think it's positioned as a ETH plus, which is less volatile and better, right? And that's where non-euro or non-dollar stablecoins can play a very strong role, depending on who you are and what you want to do, right? Obviously, from my perspective, the Swiss franc is the obvious choice for for everyone because it's stable. But there's certain people who might want to have a short exposure to the euro because they are doing trading there, or they might want to leverage the euro, or they have business which are off-chain in whatever market and want to hedge against their local currency. You know, there's many options and things where you can use that now. That said, I think as a settlement currency, it's hard to compete with the dollar. And anyone issuing a non-dollar stablecoin, I would kind of suggest try not to compete with the dollar on settlements. You're gonna die just because of the liquidity the dollar has. But there's other things, and those are, I'd argue, to be found more in DeFi than in the centralized or CDeFi, as you would call it, right? Because in DeFi you can only use stablecoins. They are often more efficient because they have immediate settlement. You don't have counterparty risk. rather than having those same products in the decentralized world, or they might not even be accessible because not the whole world has the same access to financial services as we do in Central Europe, and they might also need or want this.
Yeah, and also stablecoins have always been the safe haven in fast markets, right? So if kind of the prices go down, so do you just like go out and wait? And also, what we shouldn't forget, especially also with the politics that the Americans are doing these days, there's a huge devaluation of the dollar. Yeah, so if you hold dollar, whatever you got it 1 year ago, so you lost quite some money in parity towards the euro, for example, and that might also be the case in the future. That so if people want to get out in fast markets, so that they better use the Swiss franc, euro, or another stable currency.
And that gets actually interesting because right now it goes the other way around. There's now many people thinking because you still have the petrodollar, that the dollar might appreciate, even though the Trump administration is kind of printing hard. And that's why, for example, there was a discussion in our community going on not too long ago with liquidity, where you can use liquidity, and it's actually been proposed, I think, yesterday. It's not live, but it's going to live next week if no one vetoes it. But you can now leverage your Swiss franc, leverage your dollar or liquidity dollar with a yielding liquidity dollar against the Swiss franc. So it goes both ways, right? You go short Swiss franc, there's a need for that, there is a demand for that. And I think this is the same with any currency, and that's where it makes a lot of sense to have those currencies if they are liquid enough.
Yeah, thanks for this great overview on kind of institutional use cases. I want to talk a bit about the adoption constraints, what's kind of holding growth back a bit, and a question to all of you. I mean, as we mentioned today as well, or you mentioned today, liquidity is obviously a huge aspect here, and it's kind of the biggest barrier for some institutions at least to engage. And without liquidity, institutions also can't really rely on these markets, so it's kind of this chicken and egg problem. And I would be curious, how do you see this liquidity barrier, liquidity issue solved?
That's a good question. Liquidity, to be honest, is a nightmare for a stablecoin issuer. It's really expensive, it's costly, and there is a lot of constraints. So I would say liquidity and accessibility is the key element for a stablecoin issuer. On our side, I think there is not only one good answer, but on our side, the strategy was to try to be, let's say, crypto native compatible, but also TradFi in parallel. So we push the same strategies and, for example, Circle or Tether for Euro. I mean to increase the network and to increase the distribution. We consider centralized exchange, we consider broker, crypto broker, and also protocol like within this network. So we push this use case. It could be trading, margin call, margin loan, but also lending, borrowing, on DeFi. But it's not enough, and it's really expensive. So we need in parallel to have some usage and some use case. That's why we push for institutional use case in parallel. We want to leverage on let's say on what asset we have within Société Générale. So we push for institutional use case with our client for payment. We discuss with market infrastructure to enable euro stablecoin within their legacy system. We try also to allow securities on chain to ensure there is economic activity within this ecosystem, because without it you don't need a stablecoin. So we try to do it in parallel, but it's a kind of race, because everything is difficult. You have compliance constraints and you have a liquidity cost that is not so obvious. Every time you onboard a market maker, it's a cost of capital for the bank, so it's not so. It's really a charge. So we need to be careful, and we need to onboard, let's say, partnership that is relevant.
I think I would answer that question around adoption again from the perspective of the theory that non-USD stablecoins really need to happen in the real world. And I think, so when looking at the crypto world, I think adoption is mostly driven by paying incentives, right? So if you do like launch campaigns and you pay incentives, and then you usually are able to gain TVL. In the real world, it's a little bit different. And from my perspective, the distribution topic will really be the driving factor for adoption of non-USD stablecoins, which in the end means, so once the Revoluts, the Stripes, and Amazons, SAP, and so on in this world are adopting stablecoins, then via this distribution, the non-USD stablecoins can also grow.
That's certainly one point, like real adoption. Keep in mind, one problem you have with liquidity on chain, now I'm talking about decentralized markets, Uniswap, AMMs, and so on, is that they're extremely capital heavy. You have dead capital, which is basically parked on fragmented markets. You have to have it on every chain. You're basically launching something. And that is super inefficient from a capital perspective, because you have, in our case, worse than in your case, because we have to mint it. You have capital costs. There is engineering solutions to that. There's a lot of research and building going on with intent-based stuff, on-chain OTC deals, RFPs, basically unified liquidity across chains, and so on. So I think this problem, in absolute terms, at least for us, for a decentralized stablecoin, will become smaller over time a bit. But apart from that, as you said, usage, people wanting to buy it, but also people willing to buy it. Venues, liquidity comes with venues. Where can you obtain that stablecoin? And if you can't buy it anywhere, you will not have any liquidity. And unfortunately, especially centralized exchanges, most of them their business models are still geared very much towards highly volatile tokens. And that is reflected in fees. And that is reflected in, like their onboarding processes as well, that they're built for meme coins and not for stable coins. Just an example, one on-ramp which we were working with and we stopped working with them, bottom line, they charged 7%. And that might work for a highly volatile meme coin, but you can't charge 7% on the stable coin, and then someone has to foot that bill because they're arguing, yeah, this is compliance cost and this is like our card cost we have. And that just kind of, you need to build new venues for that, I argue. And I believe just, the very big players, Circle, Tether, is just being subsidized heavily so that they have those cheap on-ramps as they have right now.
Just to jump into what you said, Johannes, you're right, but the main point on my side is when we speak with, for example, this big traditional market infrastructure, and when they consider stablecoin within their legacy system, for example, collateral management and so on, the first question they ask is how we can modelize the stablecoin with their risk framework. What will be the LTV? Do we consider that stablecoin, our Euro stablecoin, so SG4 stablecoin, is it like a corporate from Société Générale? No, it's the kind of question we have. And one point that is quite important, they point out the liquidity, because this liquidity is not efficient today, but it is a proxy to the adoption. So if your stablecoin is considered as liquid, and the metrics they have of liquidity comes from, it's not efficient, but come from centralized exchange, come from Uniswap or Curve swap. And so they calculate the spread, they calculate the slippage and so on. And after, they will consider it as a liquid asset. And from my side, the main point, that's why I say it's a race, is we want Euro stablecoin to be considered not as an asset, but like a fiat. You know what I mean? That I mean, it's not a product, it's an infrastructure per se. And this is the main point. That's why I think there is a race for Euro, because for dollar, I think it's quite difficult. But for Euro, there is room, and we need to have an equivalent of Tether or Circle in Euro. to integrate this kind of market infrastructure. And when they speak about dollar, they don't consider as a regulated one or let's say a bank dollar one. They consider as the most liquid. They consider Circle. They consider sometimes Tether when they will be regulated. So the race of dollar, it's let's say win, and we need to have it for euro. So that's why it's quite this question of liquidity, because it's accessibility, but you cannot onboard all the world. So you need to have liquidity on chain. You need to have a secondary market to ensure it is accessible by let's say the world. And this liquidity is really a key point, and it's not so obvious.
Sylv, anything you wanna add here on liquidity?
Well, one big question here will be what the regulation looks like, and in particular, what happens with like central bank euro in regards to commercial money, because that's basically the big cheese. Like everything we do is to put tokenized assets on chain. The thing is that there's a very heavy book of regulation regarding delivery and settlement, and the moment you start realizing or you agree from a regulatory standpoint that, yep, commercial money actually is equivalent to ECB money, you can just do settlement on chain and all hell breaks loose. And it is very, very, very unclear that the ECB or the regulation wants to move there. But at the same time, it allows the Eurozone to experiment quicker. So it's a really big thing. Either the guys at the ECB move fast enough that we can actually get central bank money on different chains if they manage to publish something faster than a report every 3 years, or you'll have to have a circle.
The question back to you, it's a political one, right? Do they want to experiment faster?
No.
Exactly. I mean, that's what we see in Switzerland as well. The FINMA and you know, Lucius, the inventor, said it very nicely in an interview 2 weeks ago. First priority, stability. Second priority, stability. And third priority, stability. Right? That's how the FINMA, the Swiss financial regulator, thinks. They don't want experiments.
I think history tells us about like something that happened already. I mean, Sylvain, you probably know this better than I do, but I read a really, really heavy book on the history of infrastructure and settlement systems in Europe. And basically you had CSD, clearing houses, everything else. And then like mid-2000s, we said, oh yeah, we're actually going to have a central thing called T2S that's going to centralize everything. And it's going to be easier. I guess we're going to have the exact same thing. Like people will be able to like marginally innovate on the fringes just to move right enough to build something like Circle-like. And then the ECB gets their shit together and say, oh, actually, we may have something that works now, and you guys can actually have digital euro that works.
And then, Sylv, I have another question for you. Which key technology enablers would you say are still missing today for institutions to actually adopt and really kind of scale non-USD stablecoins?
I mean, you always have the three usual suspects, like performance, compliance, and confidentiality. On these three aspects, it's still very lackluster, and we're all vibe coding solutions together and trying to make it work, which is why I believe that there's like still significant innovation that could happen at the euro level. Just trying new stuff. Like you can try using zero-knowledge technology in order to make compliance faster. You could leverage EITA signatures. You could leverage the fact that every single European citizen has a digital signed ID card that could be used for KYC, or even just to wire money. But again, it's a political question. Very difficult to answer.
I actually really want to highlight the one point that you mentioned, confidentiality. I think that's the most underrated but most important topic, I think, to really drive real-world adoption. Because I think, like us in crypto, so we kind of dealt with that in the past, so that we know, like, okay, so we somehow the transactions are transparent, so we can deal with that. But if a large corporation is like Siemens also is going to use stablecoins for payments, kind of without confidentiality, it would be a no-go for them. So therefore, it's great to see so many initiatives these days really trying to solve that.
And I think there's a really big tension here between, and I'm curious what you think about this, Sylvain, for example, which is like the playbook for stablecoins is let's try and pick up the slack and get to the level where the US stablecoins are. But it seemed from the discussion that it were much more institutional use cases than the usual payments or remittances use cases, where in our case, confidentiality would be much more of a pressing issue. But the thing is, in order to bootstrap liquidity and everything else, you have to play ball. You have to be in the curves, you have to have liquidity, you have to have LTV, which basically goes against developing or bootstrapping confidentiality features. So I'm just curious, like, what we do to get there.
Why not both?
Well,
piggyback on top. You build it without confidentiality, build it up, and then we're having those conversations, for example, where you then piggyback on top of it, and you have a part, or you enable also confidential transactions on top of your stablecoin. Sama, for example, offers that, right?
It was a very different discussion that we had, talking with different Euro stablecoin issuers. We're like, yeah, confidentiality, this is fantastic, this is perfect. This is in 15 years, when we actually are out of the dead zone and we make sure that we have enough LTV that we don't look like idiots compared to US stablecoins. So it's definitely like the 5th or 6th priority.
I can't argue with that.
And Johannes, obviously, decentralized stablecoins have different approaches in many ways than bank-issued models. And my question to you would be, for institutions, does that bring certain advantages or also trade-offs? What would be like just the main few points?
I mean, one very big advantage is that we're unencumbered with many of the very restrictive regulations which make life hard for centralized stablecoins. For example, DeFi composability, yield on top of it. And that obviously there's a lot of institutions that basically, they want to use centralized stablecoins because they have this regulatory clarity and especially the path to liquidity. That's always the big point, right? How can you get from my stablecoin back into fiat if I need to? But then they're actually, from a use perspective, they're a lot more interested in decentralized models because then they have the whole DeFi world at their fingertips and they can, potentially start giving yield to their clients with it, or they can use it so that their clients can use their assets and borrow against it, which is also a lot harder doing with a centralized stablecoin. So I think DeFi composability is the big advantage, which, just because centralized stablecoins, because of the regulation, are not allowed to do it, it's a play field where, and a decentralized stablecoins in that sense, it's nothing else. How does a protocol like Francoin differ from a protocol like Aave or Morpho? It's a lending market. It's just the difference is that it's a lending market which is a one-sided lending market, because the other side is just a fixed, Swiss franc representing the value of the Swiss franc. So it's DeFi playfield. Composability.
And Peter and Sylvain, when obviously with regulation now emerging in Europe and obviously being active for getting close to 1.5 years now, I would be curious, would you say this also had like some barriers along with it for certain institutions, or is this just really the kickstart for making this all possible, or do you see some barriers with regulation in general?
Well, I think so from the crypto perspective, I think regulation is always making things more difficult. From the real world perspective, regulation opens doors for adoption.
Yeah, so regulation. We are in Europe, so regulation is it's really painful, a little bit difficult. I think at the end there will be 1 or 2 or 3 euro stablecoin, but with bank, maybe crypto native entities that is regulated also. But the main point today is the prohibition of interest of this kind of, this feature is really concerning. I think it's the same for US now, so we are in the same level now, so it's quite good for that. And that's why DeFi is pushed a lot, because it is maybe the only gray area that allow a stablecoin issuer to distribute yield. So, but we need to have a clear message from the regulator on that point.
Yeah. Well then, one last closing question to all of you, maybe 1 or 2 sentences answers, please. So when we're really talking about the future of non-USD stablecoins and scaling this institutional adoption, I want to ask you if we have this conversation again in 5 years, maybe, or 2030, we're sitting here again, what would have need to happen for institutions to really widely adopt non-USD stablecoins? What's like the main thing, simply put, for you?
A third Donald Trump term.
Good one. Lindy. I mean, maybe the old guys getting how you call it, going into their pension, and the new generation understanding the risks and actually having them in.
From the infrastructure side, confidentiality as a door opener, and other than that, really distribution so that large platforms adopt stablecoins.
So no USD securities on chain. It will allow to have this kind of economy. And yes, that's it.
Perfect, yeah. I love that we now went from the other direction for the last question. That's perfect. And I can close with a thank you very much and have a great rest of the conference.
Thank you so much.
Thank you.
Thank you.
Thank you. Next up, we have a solo talk by Dennis Dinkelmeyer, CEO of Bidus, and he'll be talking about open liquidity architecture for on-chain capital markets. Welcome, Dennis, everyone.
Okay, before I start, I want to say very clearly why we're doing this. We're doing this to bring any asset, any vault, any fund, any ETF, any stock, any bond on-chain with atomic instant liquidity. That's the message. It's really around bringing assets on-chain with deep atomic liquidity. Okay, let's start. Briefly, Midas, tokenization business. We bring on-chain investment products on-chain, $2 billion in asset issued last year, $40 million in yield paid out last year. We've been operating for 3 years with no incident. Let's look at some data first. The presentation is on liquidity, and that's really the key point. So why does liquidity matter? The data I'm referencing to here is adoption or collateral use cases in money market. Column on the right are traditional money markets, so real finance, and then there are on-chain money markets. Let's look at some assets. US government bonds, agency MBS, I can't actually read it, but somewhere between 6 and 2 trillion adopted in on-chain money in off-chain money markets, and around 2 billion in on-chain money markets. Massive category, and really hope that someday crypto and DeFi scales to that extent. You could argue that solvency drives everything. Solvency, stability, such as T-bills, drives the adoption to those markets. But liquidity trumps everything. And you see this along that equities or even Bitcoin, which are volatile assets, not exactly solvent, but with very deep liquidity, are integrated in very deep volumes. So really, liquidity drives everything first and foremost. And this is really why we're talking about this. Very briefly, why do lending markets or money markets matter? They're a very large asset class in crypto. And for an asset issuer, bringing assets on-chain, we talk about distribution, we talk about a lot of things all day, but really to bring assets on-chain, you need to have adoption in lending markets. Now, why is liquidity not solved? We had many people here today talk about market makers. We all love them. They have a hurdle rate of around 30%, 20% if you're really competitive. You might wonder, 30%, that's absolutely crazy. Well, maybe you should go to the StableSummit next door and talk to some of the security incidents that you see in crypto, and they justify the high cost of capital. It's a very risky industry. When you make 30% or targeting to make 30%, and an asset turns over every 4 months, so a user holds it for just over a quarter, you have an asset turnover 3 times a year, and that would mean a 10% discount. And these are real figures. So basically, I make a market and I get 90 cents on the dollar when I make the market with the market maker. And that's really it. It's counterparty risk, settlement risk, and so on and so forth. You can slice the dice in many different ways. You can look at short-term assets, different things. It comes out of the same equation. Market makers effectively take settlement risk and counterparty risk, and that really, really prevents scalability of these assets. It's a really hard challenge to solve. How do we solve it? We build an open architecture for liquidity. That's the first thing. First and foremost, we're not really just building our product, we're building an architecture how we think products can come on chain. So there are 4 liquidity mechanisms in our infrastructure. Number 1, you redeem the standard way. You make a request and you wait until the asset is settled. 1 or 2 business days, you receive the underlying funds. Then there's an internal liquidity buffer. So let's say you tokenize a private credit fund, like we did last year with MF1, and you say 10% of the assets are held in T-bills. That's basically a liquidity sleeve that provides some buffer on-chain that also causes cash drag. This is inside the collateral assets. And these are the components that are inside the collateral asset. The third mechanism, which we really sort of bringing and going to dive a little bit deeper in the next slide, is MSL. It's Midas Staked Liquidity. And that's a dedicated pool of capital that's external to any collateral, therefore not causing cash drag, but equally settling redemption. And number 4, there's the OTC market. Our tokens are transferable, composable, and we love integrations to RFQ platforms, third-party platforms. In fact, just today we announced an integration to Infinify, where we're acting as a liquidator for a product globally we just have announced. So we're super excited about those things. Let's go on MSL. MSL is a dedicated capital pool. It sits there, it's on-chain, it's credible. You can see it, you can verify it. And against this pool of capital, and against any other asset you've issued, you can make a redemption call that's atomic, so instant, and you immediately receive your funds back. That's really an infrastructure we've solved. This is a little bit at the back end, how it works. There's a capital pool, there's a dedicated compartment, there's a credit facility, and how it works in the back end. But really, how does MSL work, and how does it solve this key challenge of liquidity? The key challenge of liquidity is settlement risk, counterparty risk. It uses a mechanism of a risk buffer. So when you redeem 100 units of an M token, this is an illustrative example, you might get back 90 cents of the dollar atomically, instantly. And then the underlying proceeds are settled. Once they're settled and clear the original value, then you receive the remaining 10 cents of the dollar, 11 if you've generated some yield, or 9 if you made some losses. Remember, if you go to Wintermeat directly, they will give you 90 cents of the dollar and keep the profit. In this infrastructure, as an issuer, we effectively wait for clearing of the asset, which is somewhere between 1, 2, 30, whatever the underlying asset is, and then settle this. This is a risk buffer that's determined token by token and allows you to really scale this. So this is really a piece that we have been inspired by the concept of redemption or audit holdback in traditional finance. These are proven mechanisms, and we believe they will really help to scale liquidity. The impact of this is actually quite dramatic and understated. This is a product that we are launching or just announced with them global. We'll make some detailed announcement on this, but when you have an asset that generates around 10% yield and you give it 20% liquidity, a cash drag would imply a 2 percentage point dilution. Here we're talking about this product generating 30% more returns than otherwise would be at no additional cost. That's a dramatic change. Ultimately, this creates utility for assets. When you scan all asset classes, put them on a map between risk, reward, liquidity, you ultimately see as you go up the illiquidity curve, you can generate higher returns at possibly no higher risk, but higher illiquidity. So this is a mechanism how we can solve this. We have a dedicated capital pool that sits on chain, and the big announcement we tweaked to last night is that this capital pool has grown to $40 million. So we're very excited about this, and we'll be rolling out selectively to a number of assets. And we have interest from many other market makers that want to plug into this infrastructure and even deepen this. I want to reiterate, it's an open infrastructure. We are very happy to work with third-party RFQs, very happy to work with others, and really scale this because it's a really important mission to drive the future of finance. That's it.
Any questions? Okay, I guess not. But yes, thank you, Dennis, for that talk. And next, we have Brenda Loya, co-founder and CEO of Teller, who will be talking about From Money Markets to Stablecoins, the Hidden Politics of Cash. Welcome, Brenda, everyone.
Hello, everybody. My name is Brenda. I'm CEO and one of the co-founders of Teller. Teller is a decentralized oracle, and it's one of the very few oracles that can actually pass the walk-away test. You don't have to go through the team to get your query whitelisted or be whitelisted to become a data reporter or validator. That's my shameless plug. But here today, I'm not here to talk about Teller so much, but to actually talk about the hidden politics of cash and what's going on in DC. The implications of it, and give you some historical context of where this fight started. So, in this talk, I'm gonna discuss a little bit of how it all started in 1930, how MMFs or money market funds actually challenged Regulation Q, what that is, how the MMFs exploded in 1981, and how high yield savings accounts emerged in the 1990s, how MMFs risks were observed in 2008, and whether or not, the real question here is whether or not the risks justify eliminating or reforming. So with that, let's get started with what's going on in DC currently. So in 2025, the Genius Act was passed, and that basically set a certain way that stablecoins should operate. So it basically said that stablecoins can only, on the reserves, they can only hold either cash or treasuries. They cannot be rehypothecated, and so it really limited what they could do. Now, we still were able to see Coinbase offering us 5% yields on our USDC. So even though Circle couldn't offer that to us, Coinbase could. And so then the Clarity Act became the next version of this bill where bankers could actually come and lobby to close that gap that was left open. So the Clarity Act has not been passed. It's still going on in Washington, D.C., or talks about it are still going on in Washington, D.C. But the White House did have several conversations, closed-door meetings with Coinbase and the American Bankers Association, ABA. And basically, this happened because Brian Armstrong basically retrieved Coinbase in itself, they basically said we're not going to support a stablecoin clarity bill that supports a complete ban on stablecoin yield. And so these talks happened behind closed doors. And while these talks were happening, in March 17, so just like 2 weeks ago, the SEC and the CFTC actually issued guidance on what the Clarity Act was supposed to actually be accomplishing, which is providing us clarification on the classification of assets. And then in March 20th, just last week, there was a deal reached between the White House, Coinbase, and the American Bankers Association, where basically passive yield was banned. And now you can only earn yield as a holder through activity-based things. What that means is still to be seen, but basically the whole point of this is that this fight was supposed to bring clarification on classification of assets, but in turn, it turned into a fight that has been happening since the 1930s. So, In 1971, so you cannot outlaw competition, and ultimately what ends up happening is when something very restrictive happens in the economy, or the government decides to do something very restrictive, people find innovative ways to extract some value. And in 1971, Fidelity launched the first MMF. And that happened because in 1930s, which it was very justified, the US was going through the Great Depression at the time, and they implemented the 1933 Banking Act that implemented restrictions on interest rates allowed on savings accounts. So they implemented a cap, and for checking accounts, they completely banned them. So from 1933 to the 1970s, you were basically earning no returns on your money in the bank. And that was so that banks wouldn't experience bank runs in the middle of a depression, right? So that way, the only incentive for you to move your bank from a bank was that it wasn't your local bank. So it took many decades for us to actually start seeing innovation come into place. And at the time, Treasury's yield was only 5%. Which was not that big of a deal, right? But in the 1980s, that grew to almost 16 and 17%. And what that meant was that in 1977, MMFs were about 4 billion, and by 1982, they were 230 billion worth. And even though banks, they completely opposed them publicly, in the back end, they were building infrastructure to be able to take advantage of this. So banks, the way that they operate, they have this bank holding company. They can own a bank that has the charter of the bank from the OCC, but they can also own other entities under that umbrella. So what they ended up doing was they had their bank charter, and then they created some MMFs. And by the 2000s, they actually were able to capture 50% of the market. Let that sink in, because this is going to be important of what's happening with stablecoins fight right now. All right, so they captured this 50%, but then in 2008, we had the Great Recession in the United States. And what that ended up creating was a lot of things went to, didn't work as they were expected. So the market was really bad, and Lehman Brothers actually filed for bankruptcy. And that's when it came to light that Reserve Primary Fund, one of the biggest money market funds, was holding a bunch of this commercial paper in their reserves. And so they broke the buck. That's what they called it when it was depegged. We call depegging in USDC or in the crypto world, but then they just called it, oh my God, they broke the buck. Anyway, they didn't eliminate the product, they just managed the risk eventually. So now MMFs are not allowed to hold commercial paper because of what happened in 2008. Today, there's about the amount of assets under management in MMFs is about $6 trillion, and that's actually where the fight comes into place for the stable coins. And there's a lot of parallels between money markets, the money market fights that happened in the 1970s and what's happening currently. Also, these were the arguments against MMFs. They were going to be cause deposit risk and will destabilize lending. They were acting as shadow banks. They were doing all of this unfair regulatory arbitrage. They had higher systemic risk for runs, and consumers would not be able to understand that these products were not FDIC insured. So they didn't have a lot, they never really have a lot of trust in the consumer understanding what they're getting into. But if you look at these arguments, they're very familiar to what's happening today. Then high-yield savings accounts came about in the 1990s because we got so comfortable with the internet, and we started trusting this new way of transacting. And so now these entities didn't have the higher overhead that banks, brick and mortar banks, had, and they were able to pass on higher yields. But where it really gets interesting is on sweep accounts. So sweep accounts were actually created alongside the money market funds in the 1970s. And they were originally, they would take your idle cash, put it in an MMF, allow you to earn that return, and then you would get the almost market rate for that, and then the broker would get a small fee. Nowadays, especially since in the 2021 time period, this model completely changed. So go back and check your brokerage sweep accounts, because now your idle cash is actually put into affiliated bank deposits. And then you as a customer, we're only passed on about 0.45% of that if we're lucky. And then the broker actually pockets the 4% that was intended for the consumer. So there's approximately about $1 trillion in retail cash just sitting in that arrangement that happens every night as we sleep. And the SEC has really turned a blind eye to it for a very long time, because it was somewhere in the fine print, it was disclosed that they were no longer moving your money into money market funds, but instead they were moving it into their affiliated banks or partner banks, and they're keeping all of that, or capturing all of that interest rate. So that's the gap that actually stable coins are actually competing with. It's not just bank deposits and savings, but this is mostly like it's like a shadow way of banks taking over interest rates and yields that had at some point being passed on to customers. They were able to acquire that without even us noticing it. And that's actually what they're fighting against right now. So banks didn't actually defeat money market funds. They joined them, and by the 2000s, they owned more than 50% of the industry. And what they're trying to prevent right now with stablecoins is that same competitive threat. It's not a new one. And basically, what they don't want to happen is that Coinbase does the same thing that they were doing back in the 2000s when they took over money markets. Because that's basically how Coinbase and Circle are circumventing these regulatory constraints. And that's not to say that banks are wrong or that they're just driven by greed. There is a real risk with stablecoins because, well, we have a lot more global reach. And as we signed in 2008, anybody that was holding any of those securities that failed with the housing market, they experienced some of that downturn as well. With stablecoins that is pegged to the US dollar or any other currency, we can experience or we can absorb shocks even though they're not happening straight in there. So they become more of a systemic risk because as they become reserves on other assets or collateral, part of the collateral of other things, all of these things can become affected. So this systemic risk is very real. In March 20th, who won and who lost? In my view, everybody lost a little, everybody gained a little. But ultimately, the main question is whether or not passive and activity-based yield, if that distinction is going to make a difference in the long term. And also, we have to keep in mind that the only reason we are getting yield from the majority of these entities when they're coming into the industry, it's because they are trying to motivate us to move our money. It's not an altruistic thing that they're doing. They just want our money. They want to make sure that we go into our bank accounts and move it. And so these periods where we experience these returns can be very, very short-lived. And my real concern with what's happening right now is that ultimately Coinbase and everybody else is out there for profit. So once they become the institution, will they continue to do the right thing? And for us as builders, as we see how regulation shapes, how do we build products that are actually, that take this into consideration? Do we diversify? Do we freeze? what do we have to do to make sure that we don't experience similar systemic risk like what happened in 2023 with USDC depegging because the Silicon Valley Bank was closed down or shut down. And even though it didn't happen on chain, it had a direct effect on what happened on USDC and anybody that held USDC in their collateral. And with that, I'm out of time, but if you guys have any questions or would like to chat more about this, I would love to talk about it and find out what your take is and whether or not you actually knew that your sweep accounts have changed so much over the last several years. All right, thank you.
Okay, and next up, we have a session about integrating tokenized cash instruments and stablecoins into institutional systems with our moderator, DeFi Dave, or maybe TradFi Dave today, I'm not sure. And our speakers, Emma Londriel and Rafael Mastro Berardino.
All right, thank you everybody for joining us. This is going to be an electric fireside chat with Emma and Rafael over here. To start off, I'm going to define all these different dollar assets in my own words. You have stablecoins. They're basically dollar assets that are backed by treasuries and other highly liquid assets. You have tokenized money market funds. Money market funds, they've been around for a long time. They're a regulated asset. And then you have tokenized deposits, which are dollars off a bank's balance sheet. Emma, we'll start with you. Can you define those three assets in your own words and say the similarities and differences between the three?
Yeah, definitely. And I think you nailed it, right? We see them all as kind of cash equivalents, right, that are available on chain. I would say from a money market fund perspective, the difference that we can bucket these in are really twofold, and actually all three assets. Basically asset backing and legal structures around it, and then the transferability itself. So MMFs are structured as funds, right? They are investment vehicles, backing by, papering accordingly and short-term debt, high-quality liquid assets. They're designed to stay around a $1 NAV and should, in theory, be redeemable for that, but they are funds, right? So principal is not guaranteed, and with that comes usually like a higher yield. Stables are kind of the crypto native bearer instruments. I feel a little funny telling people about what stables are in this audience. But of course, as you likely all know, made up of HQLA, the NAV of that HQLA has to always exceed the number of tokens in circulation. Otherwise, the stables will lose their peg. And then deposit tokens are, as exactly as they sound, commercial bank money, right? Same type of money as you all hold in your accounts today. They're claims against a bank that are demand deposit liabilities, and they are treated and capitalized as such from a balance sheet perspective. The second way I think about differences, transferability, right? And I think this is where it really defines the three, right? So a lot of these, as we see them on chain, are usually built as like ERC20s with a few additional functions. They tend to be transferable, but of course, money market funds are funds, meaning that parties actually have to subscribe to be part of the flow of these funds. So it does have permissioning at that layer. And unlike traditional MMFs, TMMFs allow for transferability on-chain, which actually is the creation of a secondary market that doesn't exist right now, right? Which I think is very cool. Secondly, stables, bearer instruments, right? Fully transferable utility is unlocked. Of course, that comes with its own trade-offs in terms of managing compliance, managing risk, but they are fully transferable. And then deposit tokens would be transferable as well with permissioning, but aligned to traditional kind of banking permissioning. So things like third-party money models, client money models, correspondent banking, they can go just beyond the client boundary, but they do remain permissioned. So it's going to be like a smaller ecosystem than stables, but the ability to build out kind of a trust ecosystem of parties that are permissioned that aren't just bank clients. And I think last but not least, the three of those then find, like, accordingly, use cases, right? MMFs you look at as like hold assets, savings accounts on chains, stables as payments, and deposit tokens, given the credit risk profile, probably sit in between and can be used for hold use cases and payment use cases.
Yeah, Raphael, to you.
That was,
yeah, go ahead.
Yeah, that was indeed perfect. And ultimately, like, they all have features, different features, but they all also carry different risks. And the question is, what do you face when you buy those assets? Obviously, stablecoin, at the end, you face the issuer. Even if he has proof of reserve, the guy you face is really the issuer. Money market fund, if done well, you only face the underlying assets because the issuer should be bankruptcy remote. So that's what the risk is, only the underlying. And obviously, bank deposits here, you're facing the bank, and they have obviously some level of insurance on that. So ultimately, they all have some features. They will all live together on wallets, and yeah, that's important to say.
Emma, so what have been the catalysts for institutions holding stablecoins, tokenized deposits, or these tokenized money markets, and what have you seen as blockers for them, for holding them?
Yeah, I mean, a number of different things. So catalysts, I think, let's be real. We see the ability to do two things. One, faster cross-border 24/7 payments. Two, an opportunity to invest in new assets like RWAs that are being natively issued on chain, and stables being part of the settlement arm of that, right? So I think those are two of the big catalysts. But in terms of the drawbacks, and this is partially why we built JPM Coin, is that we have seen, certain issues for institutions holding them around things like balance sheet certainty, around questions on the credit risk that they're actually taking, and we can dive into this a bit more as we contrast the two assets. As well as potential liquidity. Not every stablecoin is created equal, so if you don't have quick on or off ramps, that becomes an issue for institutions. But then also looking at the tech side, I would say a few things, particularly as there's lots of builders in the audience to think about, right? One is that when an institution is holding a stable or issuing a stable, they're fundamentally entering a new market which is outside of their four walls. It opens up new questions on how do you do cyber monitoring, how do you connect to these networks, and how do you ensure that your security posture is strong, right? We already have a ton of staffs in all of these institutions just working on protecting our internal assets. So it's a net new kind of boundary of risk to build controls around. Second is infra, right? It is not easy to set up custody rigs, to have wallets, to build wallets that interface these external assets. And I think that's something as well that institutions continue to explore. And from a risk appetite perspective, particularly as their holdings grow in the space, it also means that the type of custody that they need to set up needs to grow and be appropriate for that risk management. And bringing in this type of tooling and this type of infrastructure into institutions is still a difficult thing. And then last but not least is that this still requires fundamentally right now being able to hold crypto. Right? And there's a lot of institutions who aren't yet comfortable with holding even the majors on their balance sheets for many different reasons in terms of risk management, but also just the operational complexity of doing it, which remains, not prohibitive, because of course there's things like account abstraction that can be used, but generally speaking, there's still, again, technology to navigate there to even be able to execute any functions on chain.
Yeah. And Raphael, a question to you. How do you think institutions evaluate which asset to use when, and why would they use one asset, whether it's a tokenized money market fund or a stablecoin, over another?
Well, the first thing for them to go on-chain is that the asset should be better than the asset they have on the traditional market, because a lot of time, what's happening is that, for example, tokenized money market funds, most of them on the market, digital twin, well, you will never see a treasurer buy a digital twin or a private fund and hold it into its balance sheets. So the first question for them is more, why should they take those assets? And that's why, for example, at Franklin, when we built our money market fund, we issue it with the shareholder registry officially on chain, so that when an institution buys it, it's like, for them legally, it's like buying a traditional money market fund, but on chain. And because it's on chain, then there is the true legal instant peer-to-peer transfer and also the intraday yields. And so the first thing is really, why is it better on chain? And the second thing is, they all have different balance sheets, different segments on the balance sheet, different regulator, and different operation. And so depending on what they have to do, if it's more payments, global payments, obviously they will first use stablecoin because it moves faster, it's more global, there is not a lot of jurisdiction. Now, tokenized money market fund, for example, if you've got one like us regulated in Luxembourg, well, you can also do cross-border transfer between Hong Kong, Switzerland, France, but you can't send it to the US because that fund is regulated in Luxembourg. And that's where stablecoin comes in. At the same time, those institutions, they need a bank account, and the bank account will be represented by a deposit token, which at the end is the same thing, it's just much more efficient.
Yeah, and Emma, tokenized deposits have historically been used for internal transfers. We were talking about it before the chat. How do you see them growing and expanded? Will they be used for anything externally or anything else?
Yeah, it's such a good question because I think that's one of the things I hear a lot when speaking with the industry. And of course, JP Morgan has a long, rich history of building in this space. We started building in 2016 with a blockchain center of excellence. Our engineering team, built the Quorum network, which ultimately was sold to Consensus, and we started building on-chain payments internally. So we have a product called blockchain deposit accounts. It's essentially internal private permissioned ledger that's both core banking system and the payment rail collapsed into one. It's integrated to the rest of our downstream systems. And I talk about this because we use this for a very specific set of use cases, right? Moving money across our footprint. We offer, deposit accounts that are just that, but on this blockchain-based rail, clients can move money across Singapore, London, New York in a day along our footprint. They can do FX on this chain, and it helps deal with things like treasury cutoff times, different operating hours, right? Because if you're moving money New York, Singapore, London, Australia in a day, most of these markets have, 4 hours of operating overlap? So when you're actually a corporate treasurer moving money that way, it means you need to fund positions in all of those markets, right? Never mind the FX risk. So we've used we've used the tech, right, really to build a solution that solves this problem for our clients. To date, we've processed over $3 trillion on that rail, so it does remain adopted. But I think what we continue to see, and really the reason that we built JPMD, or JPM Coin as many of you know it, is that we had our institutional clients coming to us being very interested for either the faster payments aspect or to engage in the on-chain public chain markets, but they could not hold significant liquidity in stables. And it comes down to a few of the reasons that I mentioned. First is balance sheet certainty, right? If you're a large regulated institution, what do you put as a line item on your balance sheet for a holding of stables? How do you do capital management, risk management around that? Many Web3 institutions know how to do that, right? But if you're talking about corporate treasurers, there's not really a precedence necessarily. So we felt like it was important to bring commercial bank money in the form of a deposit token to help bring adoption of these more traditional players in something that is just a demand deposit, right? Treated accordingly in the same way that they manage all of their account-based deposits. Secondly is that, again, we look to say, how could we bring the strength of our balance sheet to the ecosystem so that we can bring more liquidity with these traditional players and they could get comfortable doing that. Yield, because this is commercial bank money, it can be natively yield bearing, it can be eligible for relevant deposit insurance schemes in their specific jurisdictions. And we also look to build something that had really quick on and off ramps and into JP Morgan accounts. And the reason being, right, which again I think is key to this audience, is that even on the last panels, we heard a lot about liquidity still being an issue. But if you're going to bring significant liquidity into the ecosystem, you have treasurers who are managing that. And what they do every day is they look at their own interlegal entity positions. And if they're holding too much at a specific institution, they'll lend that on repo markets. Or maybe they have notional pooling structures to move cash into a certain area. And so our hypothesis was that we needed to bring that integration to actually be able to continue to bring significant liquidity into the space. And all of those things drove bringing deposit tokens into a public chain ecosystem and looking for those external use cases. And I would say today we're seeing both hold, so store value, because of the yield-bearing capability, the credit risk, the balance sheet certainty use cases, and also payments use cases. But payments more so among like permission groups of counterparties, even on public chain, the permissioning just goes to the token instead of the actual protocol itself. And then with some of the more Web3 native institutions, what we're seeing is like an interest in diversifying their holdings. So they may be holding significant amounts of majors and stables, and they're interested in using JPMD to also have their deposit position natively held on chain. And through that, we'll see payment use cases grow, settlement of RWAs, and I think interestingly, going back to bringing liquidity to the market, even potentially bringing in new broker-dealers who will market make these more traditional money market funds, traditional private credit funds in just US dollar. And they may have been the parties who wouldn't have had the risk appetite to market make in what is stables.
Yeah, and Raphael, Benji has been around since 2021. Tokenized money markets have grown so much, 78% over the past year, 1,600% over the past 3 years. What do you think has accounted for such growth, and how do you see it growing in the future?
Indeed, we've seen tremendous growth. So we started in 2021 with the US regulated Benji. Now we've got 4 different Benji, as we've got 1 private fund, 1 regulated in Luxembourg, and 1 in Singapore. I think this growth, we've got basically 3 waves. The first one were fintechs, especially after the bank's crisis. A lot of those fintechs started to understand that maybe it was not, it was better for them to diversify their holding and to add some money market fund into their balance sheets. After that, we also got some VCs, escrow use cases, and basically then those VCs started to understand that they could hold Benji in their balance sheets and then also subscribe directly in deal by sending peer-to-peer Benji to their portcos. So that was the first wave. The second wave, more, let's say, capital markets, trading, hedge funds. So we saw a lot of market makers, hedge funds, using Benji as collateral across different exchanges, but also between them, and doing some repo trade and bilateral agreements. And today, I think, and that's why this year we are at the inflection point, is that we're seeing the first wave where treasurers, banks, state-owned institutions, they are ready to invest. They understand more of the product. They understand blockchain. They understand the different type of tokenization. They know what they want. And the only thing they miss is the integration. How they can have a wallet. Where is this wallet? How they can bring what's on-chain and just be connected and connect their own operation. So I think it's really, we're really at the inflection points. Product has always been better and better every year. And now it's time to deliver.
Emma, you've described these 3 different types of dollar-denominated assets as layers to a cake. And to me, it sounds like tokenized deposits and tokenized money markets are the savings area, and stablecoins really the payments and transfers area. And so how do you think the winners in each category are going to come about and emerge, considering that?
Yeah, I love that you said layers to a cake, because I've used that analogy so much that you're making me realize maybe I should stop using that analogy. But no, I mean,
we love cake, so.
Yeah, true. So I think that, like, you know, the layers to the cake analogy, for those of you who haven't heard me say it, is this idea that like digital money will, you know, continue to coexist, right? And there's this idea, if you look at banking, of like M1 and M0 money. Right? And so the idea of M0 money is that it's central bank money, it's the safest asset, it's the euro issued out of ECB, it's the dollar issued out of Fed accounts, which traditionally financial institutions have access to those accounts. Then you have this M1 money. That's the money we all hold in our accounts today. We all face institutions. Technically, you hold a demand deposit at, Chase or SocGen or name your institution, right? And those demand deposits find their finality into central bank money. And that's how you maintain singleness of money and financial stability, right? It's the reason that a dollar issued from one institution in a specific jurisdiction doesn't trade differently than a dollar, or isn't worth a different amount, right, than a dollar issued by another institution in that same jurisdiction. And I think our view of the world is like, stables will be part of this M2 money, right? Because what now those look like are money issued by private companies. And they will be very useful on chain and for certain use cases and certain client sets. And they will find their finality into commercial bank money, which will find its finality into central bank money. So that relationship continues because stablecoins ultimately will still need to off-ramp at some point for fiat. So we see it as an extension, right, of that relationship. So that's the layers of the cake and the way that we see these things converging. And then to your question, like, what's the winner? I actually think, I thought about this, so I think all three, although with in different ways, right, different implementations, have the same three characteristics that will help drive winning. One, and I think I've already heard it on 2 different panels this morning, risk management, right? How robust are the risk management practices? For MMFs, this might look like, what type of short-term debt is in it, how much high-quality liquid asset versus short-term debt ratios are there, how transparent is the NAV, how often is it actually being published, right? I think with stables, it's going to be like, who are your underlying reserve holders? Again, how much transparency is on those reserves? How often are they being published? How have you planned for what your stable will do in times of stress? Right? And then with bank deposits, again, I mean, risk management is the whole name of the game with bank deposits, right? People hold their money at institutions because of the capital ratios, because of the robust stress testing, because of the existing risk management practices. So I think in all three states, it's going to be like, and in deposits, it's like the strength of the balance sheet, right? So in all three of those, I think that's strength. And that goes side and side with utility, right? Particularly for deposit tokens and MMFs, which, as we know, are permission products. How do you grow distribution? Who can use them? How do you grow the utility on chain? Because the reason that stables are so widely adopted is because of their utility, right? You can use it as a hold asset, put it in a hot wallet so that you can get rewards, or put it in, do staking with the stables to earn rewards, and then easily go lend that, right, through these DeFi protocols. And then the lender might meet a margin at, name your prime broker. And that usability is unmatched right now with permission products. So I think growing the usability, particularly for deposit tokens and MMFs, will be key. And then stables, it's going to be growing, continuing to have usability, but also doing so, particularly for institutions, in a way that we can get comfortable with the compliance posture. So how are you managing sanctions risk? How are you managing money laundering risk? How are you making sure that this isn't in the hands that an institution would not want to face? So I think that's the other part of it. And that usability goes hand in hand for the last thing with all three, which is liquidity, right? Like the most adopted stablecoins are the highly liquid stablecoins. Distribution is key for the other two types of assets. So I think risk management, liquidity, usability are the three things to build towards for the winners.
And Raphael, to you, how do you think the winners will emerge, and which winners will emerge?
Well, I think that's what DeFi gave us. As finance is now easy to access, you can buy the S&P 500 directly on chain, you can do lending, you can borrow, you can access DeFi, you can access payments directly without intermediary. This really changed finance because now institution that wants to stay in place, stay relevant in this market, they have to provide value added. They have to provide this value added that maybe some of them before weren't at all bringing to the market. They were just protected by their regulatory umbrella, and they were sure that people had to use them to access finance. As of now, people don't need to use them. So I think the winners will be the institutions and the companies, the protocols, and everyone that just show up and provide added value to the customer that in any way can access let's say, the same raw functionalities without intermediary. But at some point, we'll always decide to choose an intermediary because there is so much value added in having maybe advisory, insurance, and any other advantage that it has to just go through an intermediary.
Yeah, I can't help but notice on stage right now we have Benji, the tokenized money market, we have JP Morgan, JPM coin, and we have myself at CAP, the stable coin, each represented here. Emma, do you have any final words? Like, where can people learn more about JPM coin or tokenized deposits?
Definitely. I mean, of course, you know, you can always stay connected with me on LinkedIn for what we're doing with JPM Coin. We also have, you know, a number of research and white papers that we've put out. So normally you can get them from the Connexus website. We recently, or I guess last year, did also some work on building institutional grade payment token standards with the MIT DCI. And for those of you who are builders in the audience, we've, you know, looked at evolving existing ERCs and building, you know, composable standards and acknowledging where there's gaps. So interesting reading as well, and happy to connect on any of these topics. I'll be around for the next week.
And Raphael, to you, where can people learn more?
Yeah, well, let's just connect. At Franklin Templeton, I think we've got more than 100 persons working only in digital assets. Most of them are building infrastructure on-chain, wallets, asset management platform, tokenization infrastructure. So let's connect and let's see how we can help.
And capmoney_ on Twitter and cap.app online. Thank you so much, guys. I will see you out there.
Thank you.
Thank you. And next up, we have a continuation about learning about CAP. We have Benjamin, founder of CAP, who will be talking about private credit and the evolution of on-chain yield.
Great job, guys.
Hi everyone, my name is Benjamin and I'm the founder of CAP. Today we're going to talk about verifiable credit. And this might seem like a new word, and it is because we're presenting a new framework by which we can improve the current infrastructure for private credit with the goal of making it safer for investors and making it safer for lenders. So first of all, before we talk about what private credit is, and how we are tackling that problem, we have to think about why is this important for this room? Why is private credit important for crypto markets? And the short answer is that crypto needs real yield. Right now, yield in crypto is a circular economy. We have not escaped the Bitcoin markets. So all of the major yield platforms in crypto, and I'm talking about yield that's above $1 billion in AUM, revolves around Bitcoin markets, whether it's Bitcoin-backed lending, inflationary incentives whose tokens are highly correlated with Bitcoin, or perpetual basis trading, which is also reliant on the market for Bitcoin. So the problem is we're focusing too much on these crypto-native markets, and so when the Bitcoin prices are up, we have a lot of yield. When Bitcoin prices go down, we have the current scenario in which most yield platforms in crypto can barely beat US Treasuries rates. So we need some way to connect our yield markets to the productive economy, an economy that is not just tied to this circular economy that we've built within crypto. And we think that private credit could be an interesting opportunity to do that. Now, why? Well, what is private credit? Private credit largely is a large umbrella, and it covers direct lending to any sort of private company. It can be to manufacturing firms, it can be to trading firms. It's a very wide range of lending to private companies. And today is one of the fastest growing ways of traditional markets to earn yield. Obviously with its problems, which we'll discuss, but we think that this is a very good way for crypto to get yield. Now, if we can, for the purposes of this presentation, agree on two things, that crypto needs real yield, and that private credit is a good opportunity to get that yield. If we can agree on that, how should we bring it to on-chain markets? Should we just tokenize it? Well, so far, many players in the space have taken that approach. Let's just tokenize existing private credit and bringing it on-chain. I think that's a terrible idea. Why? Because we would be exposing crypto to some very key and important drawbacks that exist in private credit. We have an opportunity to use smart contracts, to use crypto technology to improve private credit instead of just bringing it on-chain to our users. Now, if we wanted to improve private credit, in order to bring it to our users, in order to improve the yield in crypto, we have to address some key drawbacks. Now, these are the drawbacks that us as a team at CAP, we think are the main ones and the ones that we should solve. Obviously, we cannot fully solve all these problems. We can try to mitigate them as best as we can. And so I'm going to explain what these are and how we want to mitigate them. The first one, and the one that I'm personally most interested in, is scalability. So we have to understand how credit is underwritten in these private credit funds today. So what you will have is obviously all of the borrow demand, the different types of companies that want to borrow from these private credit funds. And all of them are underwritten by the employees of these private credit funds. Obviously, implementations vary. Each company will have their own investment committees, their own portfolio managers, risk committees. Depending on the jurisdictions, there might be different requirements from regulators. But what binds them all together is that no matter how many loans are being processed, let's say 2 loans, 10,000 loans, 1 million loans, they will all go through the same people. And so obviously, people can't, you can't, if you have 10 employees, you can't do 10,000 loans. Maybe you can do 50 loans a year. And so as a result, out of all the opportunities, you will have maybe a few that you actually enter into. And so 2 things will happen. Either you will underwrite too many loans, more loans that you can actually do diligence on, or you will just focus on the big loans that maybe are not as competitive, but allow you to deploy. In practice, it's a bit of both. Some loans get fast-tracked when they shouldn't have. Some loans that are not that profitable pass through the cracks. So how are we at CAP trying to improve that system using smart contracts? Well, what I want to have you guys focus on is this role of the underwriter. We're bringing this new role that does not exist in private credit, and it's new, and we're bringing it with CAP. And so what is it? Well, these folks come from different types of industries. We can have risk-takers like EtherFi, like Renzo. We can have credit insurers like Travelers Insurance, Liberty Mutual. We can have credit funds like RockOAX. We can have crypto funds like Antalpha. Now, very wide range of companies. What brings them all together? Well, what brings them all together is that they have assets that are not that productive compared to the US dollar. So for example, a credit fund that has Swiss francs. Swiss francs is a wonderful asset, but the yield is not great compared to the dollar. For example, risk-takers, EtherFi, they have ETH. ETH is a great asset, but it's not as productive as the dollar. So why do they come to CAP? Well, we bring them to CAP because we tell them you can now underwrite individual loans, and you can get a premium for underwriting these loans against your assets. And the premium will come from dollar loans, which is way more productive than the assets that you have. And so they come to CAP in order to get yield from these loans. On the other side, you have the same loans that private credit has. So anybody that's borrowing from Apollo would be borrowing from us here. The difference here is how the underwriting happens. So any number of these underwriters will have their own set of skills, their own industries that they're comfortable with, and their own relationships that they have on the borrowers. So for example, a risk-taker like EtherFi, maybe they know a lot about the business model of FalconX. So they will underwrite FalconX. They will put their ETH and say, I vouch for FalconX to borrow from CAP. So the result is that now EtherFi gets a credit spread for underwriting that loan that they would not be able to access otherwise. And our dollar lenders now get a secured rate on their dollar, which is higher than they would get otherwise in crypto. And this is a real example. FalconX is actually getting liquidity from us. Susquehanna is actually getting liquidity from us. And so you can see here that, unlike in the traditional model, where you have all the loans going through the same people, here you can have an unlimited amount of underwriters, an unlimited amount of borrowers, all being underwritten at the same time. So that's how we address scalability. The second problem, or the second issue that we identify with private credit is misaligned incentives. The people that are responsible for underwriting credit at these private credit funds are not completely aligned with the lenders. And because of this, it leads to some outcomes that are not favorable for the lenders. For example, many private credit funds continually change their accounting practices in order to manufacture yield where there's no yield. And so this is bad for lenders, obviously, because you think you're getting 9, 10% APR, but it's really that accountants are playing accounting games. And here's some details about why the incentives are misaligned. Well, the lenders, they want to protect their principal, number one. Number two, they want to get some yield. Whereas the private credit funds, they want to have more AUM, they want to deploy more so that the capital is sticky because it's deployed. The private credit fund employees, very different. They want to advance their careers. They want to make more money. And so you can see that these are not exactly all the same incentives. Similar slide to what we saw recently. How do we try to address this using smart contracts? Well, the decision maker here is the underwriter. If a crypto fund with their Bitcoin underwrites Susquehanna and Susquehanna defaults, well, who's losing money? Is the underwriter, is the decision maker. And because the underwriter doesn't want to lose their money, they're going to make a better decision because it's, they're dealing with their own money. The next one is opacity. Opacity is a bit complicated because there is a lot of information when it comes to loans. There is the return on these funds, there is what is being used with the money, there is the collateral. So there's a lot to get into. I want to focus specifically on collateral. Why? Because a staple in private credit is collateralized loan obligations, where you have the borrowers that put up collateral as recourse in case they can't pay back the money. I want to tackle that. That's what we're trying to focus on at CAP. And in TradFi, in traditional private credit spaces, we see that there's large-scale fraud. There's an issue where the same borrower will pledge their collateral to multiple lenders. And so when there are issues and somebody needs to get that collateral back, they find that there's no collateral, right? Because all this collateral is either hard to price, hard to identify. Maybe it's based on NAV, maybe is some sort of other very complicated collateral, or it's been pledged to multiple people. And you would think regulators are tasked with making sure that this doesn't happen, but in reality, that's not the case. You can see First Brands and Tricolor lost a lot of money to a lot of lenders, and regulators were not able to protect these lenders. So how do we solve it? Well, we're in the blockchain, right? If all of the assets are on the blockchain, it's impossible to double pledge. We see MakerDAO, which is now called Sky, and Aave. They've been doing over-collateralized lending for many years, and it works. If you have your ETH at Aave, we know it's at Aave. You can also put it at Morpho. The other part is automated recourse. If we do need to liquidate, if we do need to get recourse from the collateral of these underwriters, it all happens automatically. I don't need to make a phone call. We don't need to go to court. The smart contracts will execute the logic without asking anybody. And that keeps the lenders safe. It keeps the borrowers safe. It makes sure that there is no room for misinterpretation. The next and the final one is illiquidity, which is another complicated problem that we obviously cannot fully solve, but it is very problematic right now in private credit. Right now, a lot of retail investors are trying to leave private credit because they're scared of everything that's happening now with all these large-scale frauds. And we found out that all this capital is deployed. And so if you're retail and you're trying to remove your liquidity, you really can't. And maybe it will take you several years to leave because there are caps on how much you can withdraw each quarter. And so as a result, a lot of people are getting pennies on the dollar and they're incurring a lot of losses. The way we solve this, well, not solve, but the way we try to mitigate it is two different ways. One of it is relying on code. If you want to withdraw your liquidity from CAP, we don't need to call somebody. There's no emails. There's no human interactions. We're almost like a vending machine. And this is the way a lot of decentralized finance works. Everything's automatic. You say, I want to remove my capital, and everything beyond that happens based on code. The second part, which is a bit more of a complicated discussion, is how we price the capital in our protocol. Historically, if you have a mismatch of liquidity between how much you're lending, how long you're lending, and how fast your depositors want their capital, you're going to have to make some trade-offs. Are you going to favor the borrower, or are you going to favor the depositor? Well, in traditional private credit, you favor the borrower. You just want the capital out there because you want it to be sticky, and you really don't want people to remove their capital. In traditional decentralized finance like Aave or Morpho, we're favoring the lenders to the detriment of the borrower. And the way that works is with these very steep utilization curves. So if people try to remove their liquidity, the utilizations will spike. Now the borrowers are paying so much in interest that they have to bring back the capital. CAP, we're trying to meet in the middle. So normally, the way we lend money to these traditional institutions like Susquehanna, like FalconX, is that we have near fixed rates, so that there's no large volatility in the interest rate that they're paying, and they can plan their capital markets based on that. However, if we get to a point where there is extreme volatility or extreme competition for the capital, everybody's trying to leave, or a lot of people are trying to borrow, and the utilization of our capital reaches beyond 90%, at that point we switch, and we're no longer favoring the borrower, now we're favoring the lender. And so at that point, we do kick in the interest rates, which either force people to repay or allow new investors to come in that are interested in that higher yield, and then we can swap new lenders for the old lenders. So as a summary, I think that private credit is a necessity in crypto in order to tie us to the real economy. We need real yield, and private credit needs blockchains. Clearly, markets are not happy with private credit today, and we need a better solution. And I think CAP addresses these needs. So if you want to learn more, you can go to cap.app, and I'll be around the conference, so happy to chat. Thank you, guys.
Thank you, Ben. Next up, we have Adam Sadowski from Llama Risk, who will be talking about accelerating RWA adoption in DeFi with risk-managed oracles. Welcome, Adam, everyone.
Working. Ah, there it is. Hey, everybody. So I'm Adam Sadowski. I am the founder and CEO of Llama Risk. Llama Risk is a DeFi risk manager, and we work with some of the biggest names in DeFi, like Aave, Curve, Aave Horizon, and Athena. So today, I'm going to be talking about this topic of risk-informed oracles and how this is an essential piece of infrastructure that is going to allow the safe onboarding of RWAs into DeFi. And I'll be talking about this topic in the context of our solution, LlamaGuard Nav. So we're at an inflection point of our industry right now, where RWAs are poised to redefine DeFi. We've been seeing unprecedented growth of different financial products that are coming on chain right now over the past year. And in the face of that immense growth, we still have a total addressable market that is astronomical compared to what's been tokenized so far. So the upside continues to be huge. But despite this rosy picture, we have to look head on at the persisting challenges that are continued barriers to adoption for RWAs into DeFi. And this stems generally from a problem of composability, but for the purpose of this talk, I'm going to focus in on one aspect of this, which is that of asset issuer reported NAV. So that's how we value these assets as collateral in DeFi. If we have a mispricing in DeFi, that means that borrowers can be instantly liquidated. It means that the DeFi protocol can expose itself to insolvency. So this is a critical dependency that we can't allow any mispricing to occur. And in the case of these RWA assets, which are highly regulated and have little to no secondary market liquidity, it means that we're forced to rely on the asset issuer themselves as the single source of truth for the fair value of that fund. And of course, this is a single point of failure. And we have observed that there have been anomalies in pricing that have occurred in the past, and we can be certain that this will continue to be a problem in the future. So here's some examples of historical pricing anomalies that we've seen. We've seen occasional zero values that have been pushed as updates. We have seen instances where there have been extreme dislocations in pricing updates that far exceed the behavior of the underlying assets of that given fund. So this is why I come to you today with my thesis that risk oracles are the future of oracles, and how my bold thesis for you is that within the next 2 years, we're going to see that the vast majority of the ways that DeFi protocols are ingesting external data is going to be through this mechanism I'm about to describe. If we look at how the Oracle stack has been constructed over the past handful of years and how it exists today, there's basically 2 layers to this. So the first layer is the raw data, the data provider supplying the data. And that could be an exchange or a data aggregator combining multiple data sources. And almost always, that is market price data because that is what has most direct utility to power DeFi today. And that data gets fed into the Oracle network, which is handling data transport. And it may be taking inputs from multiple data sources, and it's doing validation and achieving consensus. Maybe it has a decentralized network of nodes that's achieving consensus. And it needs to maintain the level of integrity that is expected of on-chain finance. So then those values get pushed on-chain and can be consumed by the DeFi protocol. What we're seeing now is that there is an immense need for a third layer. So that is the risk layer here. And you can see right away that when you introduce the risk layer, the categories of raw data that you can consume greatly expands. So there is an ocean of data available for us that has not yet been harnessed. That includes things like liquidity and volatility data, macroeconomic data, derivatives. It could be credit ratings. It could be fundamental information about the underlying assets of a fund. There's so much potential out here. And what the risk layer is doing, it is ingesting all of those diverse data points, and it is interpreting risk signals from them that can be used as an actionable response that affects change on the DeFi protocol. So the risk layer can define one or more trigger conditions that are pushed on chain, and that can be risk-managed pricing, and it can be risk-managed responses, so things like circuit breakers or protocol parameter modifications. So with that brief introduction of risk oracles, I'm proud to be introducing you today our work on LlamaGuard Nav. LlamaGuard Nav is already live in production, and it's powering the Aave Horizon lending markets. Aave Horizon you're probably familiar with. It is the platform where the convergence of DeFi and TradFi is happening today. It's a lending platform where users can supply a variety of RWA collateral types and borrow stablecoins against them. And it has a total supplied value, something in the order of $450 million. And all of that TVL is being powered by LlamaGuard Nav feeds right now. So let's just do a little thought experiment and imagine if we were to build a proprietary risk oracle, what would that look like? Well, we'd probably have to build a homegrown solution with our own backend service. So we would probably use Amazon AWS, and we would have all of our logic and data pipelines sitting there. And we would probably have redundancy across geographies for uptime guarantees. We would select our data input sources, and then what are our trigger conditions? How are we delivering that on chain? It would be a fully encapsulated proprietary solution. So if I came to you with a solution like that, and I said, I have this great risk oracle, would you like to integrate it into your protocol? You would take one look at that, and you would say, well, I don't know what it's doing under the hood, and I don't know if I can trust you to operate that fairly and reliably and honestly. So get the hell out of my office. And you would be completely right to have that attitude about it. But there is something that is changing the game for this right here. There's a critical piece of infrastructure that we are building LlamaGuard on, and that is this right here. This is the Chainlink runtime environment. So Chainlink CRE is the same Chainlink infrastructure that has powered data feeds since 2019 and is trusted by the majority of DeFi. It is validated by a decentralized network of Chainlink nodes. And what it offers that is a very powerful feature for teams like LlamaRisk is it is an open development environment where we can encode our risk management methodologies on its off-chain computation. We can have access to the vast ocean of data that is made available through the Chainlink IO network. We can distill that into an actionable way that can be used by the DeFi protocol. And what is the real paradigm shift of what we're able to accomplish with LlamaGuard built on Chainlink CRE is that for the first time ever, off-chain dependencies that DeFi protocols rely on to operate safely and reliably don't have to be delegated to a third-party service provider. The DeFi protocol itself actually has full transparency and control over the entire stack, on-chain and off-chain, from the integration to the logic that lives off-chain to all of the data sources that are encompassed in that solution. So this becomes an extension of the DeFi protocol to the off-chain environment. There is no other solution on the market that is offering this level of transparency and control to the DeFi protocol than what we can accomplish here. So let's look at what the actual architecture of Lombard Nav looks like. We have two key inputs that we use. So firstly, we have, of course, the asset issuer reported NAV. And secondly, on chain, we have a parameter registry, and that has unique configurations depending on the underlying assets of the fund that we have a Lombard Nav feed for. And those configurations are governing how the logic runs in CRE in the off-chain computation. So when we have those two pieces of input, we run a bounding logic within CRE, and that assigns an upper and a lower bound that are safe NAV values. And if we receive a NAV value that is outside of those upper or lower bounds, then we consider that an anomaly that requires risk management action. So one of two things can happen here. If we receive a good, safe NAV value, we simply pass that on chain. Just like any other price feed, it's read by the DeFi protocol. If, in the unhappy case, we receive a NAV value that is outside of safe bounds, firstly, we'll bound the NAV feed according to the allowable bound and push the bounded value on chain. And secondly, we push a bounds breach state update. So back on chain, Aave Horizon has a unique capability here. It can delegate risk management to a third party. In this case, it's delegating freeze functionality to the Lombard workflow. So when it receives that bounds breach state update, it interprets it as a market freeze event. So no more supplying collateral to the market, no more borrowing stablecoins against that collateral. And that allows us to have a manual review process and determine what was the root cause for the anomaly that happened, and how do we handle the market going forward. Can we reopen the market? Do we need further risk mitigating action against that particular collateral type? So if we look a little closer at the bounding logic that we use, we have dynamic bounds here because we're interested in funds that are yield-bearing debt instruments, and they fluctuate in value over time. We need our bounds to be able to fluctuate with the change in value of the underlying assets. We want to set the bounds such that they're wide enough that they allow for this organic fluctuation, but we want to set them tight enough that we have a strong assurance of pricing stability. So users can supply their assets to Aave Horizon and have a strong assurance that their assets are safe, there's not going to be influenced by any mispricing event on the protocol. And similarly, the protocol team, Aave Labs in this case, they can have a strong assurance about pricing stability so they can push exposure of that collateral type far more than they would otherwise and make their venue the preferred choice more competitive than venues that aren't using a sophisticated risk management strategy. And this right here is a screenshot from our dashboard on our website where you can see all of the historical bounds values that we've generated, any bounds breach events, and all kinds of metadata, including the parameter registry and contracts associated with Lombard Nav for all the feeds that we support. So you can check that out on our website. So what is next for Lombard? I think what I've described here is a very straightforward problem that is in need of a solution, and we've found a good solution for it with Lombard Nav. But actually, the Lombard suite of tools is an expansive set of tools that are solving real bottlenecks in our industry. So those can be broken up into two major categories. Firstly, we're using Lombard to create risk-managed price feeds. Like what we've done with Lombard Nav, we want to onboard new categories of financial products into our industry. Things like equities, long-duration credit, commodities, custodial accounts. New types of, well, for our industry, new types of financial products that require knowledge about certain fundamental information about the underlying assets in order to generate risk signals that allow them to be safely onboarded into DeFi. And then over here, we have DeFi risk automations. So you can imagine that a DeFi lending platform like Aave, as it's growing, it could potentially have hundreds of assets across dozens of chains. So when you have a protocol that is scaling in breadth and in the amount of value it's securing, you need to have risk management that scales with that. You need to be able to affect change in real time based on real-time input data on certain parameters on the protocol, such as the supply and borrow caps, liquidation parameters like loan to value and liquidation threshold, the interest rate model adjustments, and using POR as kind of a solvency check and circuit breaker for those markets. So I really want to emphasize that what Llama Guard can accomplish by introducing the risk layer to the Oracle stack is access to the vast ocean of data types that are available in the world and converting them into risk signals that are usable in DeFi. And what's more is that we're able to accomplish this in a way that isn't delegating management to a trusted third party out there. The DeFi protocol itself actually becomes an extension to the off-chain environment and has full transparency and control over the off-chain processes, the logic that's running, and all of the data sources that they're ingesting. I got into this industry because I saw that DeFi represents a fundamental upgrade to the financial system. And I wanted to live long enough that I could see that come to fruition. And I think that for whatever the details of the reasons that everybody here came to this room, we're all bound by that same vision. So Llama Risk exists to support the builders in our space to make this a reality. To the asset issuers, to the DeFi builders, come talk to us about how risk management plays a role in helping you to achieve your mission. And talk to us about how scalable and sophisticated risk management tooling can help you to achieve growth, to achieve scale, to achieve trust, so that we can work towards the convergence of DeFi and TradFi together. Thank you.
Thank you, Adam. Next up, we have Xavier Lavassier, who will be talking about stable value, unstable compliance. Welcome, Xavier, everyone.
Great. So talking compliance when it's lunchtime, that's perfect. The name of this talk is Stable Value and Unstable Compliance. My name is Xavier Lavessière. I work mostly as a consultant to the public sector on tokenization, central bank digital currencies, and yeah, all these kind of topics. Stable value. So if we look at a stable coin, how it works, we have typically Alice that has money and she wants a stable coin. She will go through a dealer, giving her money to the dealer. That will give it to an issuer, that's the one actually issuing the stable coin, that will deposit it to the financial institution, that we save that money on one side. So that's the stable part on the financial side, and it works pretty well. We have this money stored in safe assets, and hopefully we can retrieve it at the right speed when people want to get their money back. On the technical side, the issuer is creating the token. So for this, it uses a smart contract on the blockchain that will credit Alice with its stablecoin. Once Alice has a stablecoin, what she can do is to send a message to any of the blockchain where the stablecoin is and transfer the asset to Bob. So and in that case, it can be without any financial intermediary. So it's important to see that the stablecoin process itself has necessarily a lot of intermediaries, but just the transfer can happen without any. If we look at the smart contract a bit more closely, we have always the same pattern, and that's an important aspect about this stability. We have a financial stability, but we have also a technical stability of the basic functions. Typically, the smart contract will have a token name, a ledger that represents the different value that different participants have, and some internal logic. So that's the smart contract part, where we have typically function like mint or transfer that will allow the issuer to mint new assets, and a transfer function that will allow Alice to transfer money to Bob. So all this part is stable, but the compliance part is unstable. So first, to understand why we talk about compliance, we have to understand that there is a lot of illegal activity happening on-chain now. So it goes from hacks, and there have been several hacks over the last decade of different heights. There have been sanctions, so for geopolitical reasons, for criminal activity, like forbidding to use certain addresses or to interact with certain actors. I feel like sometimes we see this, and there is a geopolitical dimension to sanctions, and but there is also like really nasty activity that's using currently stablecoin, and we know from the latest report that now stablecoin are the favor way of moving cryptocurrency and moving value for criminal actors. And in terms of nasty things, I'm thinking, for instance, of human trafficking, you know, like people that are lured or captured in a different country, moved to another country, they are in this prison camp. And crypto serves both as a method to acquire money, like creating crypto scams, but also as a mean then for this type of center to operate. So there are really awful things happening using crypto. So who can apply some compliance and apply some controls in this ecosystem? We have the dealer, of course, so the one that gives you the stablecoin can do some checks on the clients. We have the issuer also, which can both look at what kind of dealer it onboards, but also like look at what's happening on chain. We have the wallets. So of course, if it's a self-hosted wallet, you don't have any option. But if it's a custodian and any financial institution using a blockchain, use it through a custodian. Monitoring companies that will monitor on chain and will help enforce this compliance. Nodes also, so that's rare on permissionless blockchain, but now we have some nodes on permissionless blockchain that enforce some sanctions. We have also on all the permissioned setup where the validator will contribute to these controls. And also even the bank that has the asset could play a role, but we could have many other actors. When we have compliance, there are three main strategies that are being used. First is permission. So I'm using the analogy of the medieval strategy. So permission is like the walls and gates. So we only allow certain actors to access to the stablecoin. We create block lists, LO lists, or even a transfer control. So when there is a transfer, we create some controls. There is monitoring. So here I'm using the tower analogy where we check what's happening on chain. And there is data that's directly on chain, but there is also travel route data. Now most actors that are doing payments using crypto, they also have in parallel a network by which they send some additional data on the person sending the money, the person receiving the money, and usually after a certain threshold, it becomes a lot of information, even like the address and so on. And then enforcement, so what do we do if something illegal happens? Do we freeze some address? Do we destruct some funds or bring them back? Or do we seize them for different reasons? So that's some of the options that we have. There is also some, this is using smart contract function, but we know now that also at the mempool level there can be some action. But these are the methods, but they are fragmented at the moment. And that's the full problem. They are fragmented by jurisdiction, so the general rules of what should be applied are recommended by a body called FATF, a beautiful name, but every jurisdiction applies it differently. So in the EU, in US, we have some differences, but also especially some more emerging countries, they don't apply necessarily the same framework, and some don't even care at all, and that creates different ways of doing it. There is also a question of interpretation. For instance, one thing that's I find interesting is the analysis on hops. So after how many hops you consider that funds that were tainted, that were used in a criminal activity, you would consider that now it's okay. So there have been different debates, different doctrines. For instance, you could have 1,000 different transactions, but they are done by the same actor just to hide a bit what's happening, and so you cannot really consider that the funds have really moved. So here you have a lot of discussion on how to interpret this. You have also fragmentation by the internal strategy of different actors. So we have discussed the issuers, the exchanges, the wallets, and even the networks. They apply differently their rules. For instance, when they decide to act, when they consider that something is really illegal and they need to act. So some are really proactive. They want to protect their network. They want to protect their reputation. And every time something happens, they will proactively block the funds. Some are more passive, they wait for court orders, and some are totally rogue, they don't care at all, and they don't apply any rules. Finally, there is the technology, and there is a fragmentation in how it's implemented compliance. So, for instance, there is no real standard on how the function regarding compliance are done. We have also various ways of analyzing. There have been some studies showing that companies that provide data analysis on chain have sometimes missed clear red flags or also false flags. So depending on how the algorithm work, they have different results, and there is not enough knowledge or competition to make sure that it's really the highest quality in the end. And finally, so an interesting case also is the multi-sig delay. So that's a case for one of the stablecoin issuer. When they block an address, so they ban it, there is a time between the moment that they announce that they want to block it and the message is visible, and before it's fully implemented. And in that delay, of course, bad actors can see that an address will be banned and move the funds. So that's obviously a problem. And yeah. One example, simple, is how many bans have been done on USDT, USDC. So that's two dashboards on June. And you can see that on the first, you have USDT that has thousands of addresses that have been blocked, and on USDC, it's just a few hundred. So does that say that USDT is more proactive in how they implement compliance, or does that mean that more bad actors use USDT? I don't know. And also, they have a lot of ban address on Tron, so that's only for Ethereum. You have really new actors that are fully not applying compliance, and one particular example is A7A5. So it's a ruble-based stablecoin that's based in Kazakhstan apparently, and they have already 100 billion in transaction value, 500 million in total amounts that's on the stablecoin, and clearly has a different strategy than other stablecoin issuers. So that brings us to this table. We can see some of the current stablecoins, and they have different strategies regarding compliance and regarding, especially for instance for MiCA. USDT notoriously chose to not be compliant with the European regulation, MiCA. USDC chose to be. USDS is kind of a gray space at the moment because it's kind of a DeFi project, and DAI was definitely really light on compliance. USDS is already one step further, but it's still in this gray space. A7F5, I mentioned, is definitely, it has been, I think, even explicitly sanctioned as a smart contract. And new actors, so USDG, which is a consortium based in Singapore and in Europe, and a bank-based stablecoin, Euro convertible. So the consequences of this, and then brings me to my conclusion. First, we have seen stablecoin have standardized the transfer functions and have a stable value. So that's, I think, a success because it was the purpose of stablecoin. There are still some risk lingering, but the main objective has been achieved. Compliance remains unstable across laws, operations, and implementations. That leads us to the consequences. The consequences is a lot of legal risk because all the different actors now involved in proceeding with stablecoin transaction cannot be fully sure when they help the transaction. They want to be as compliant as possible, how they can apply all the different rules, how enforcement from a different country could be required to apply, and so on. So that creates a lot of uncertainty for the intermediary. So it's probably a lost economic opportunity for these actors. There are technical failures. On this, I've read really interesting audit reports showing that some DeFi protocol have to be audited and think about if the stablecoin is blocked, can we still function? And if you have a function that requires a certain transfer to happen and you don't expect it to be potentially blocked, then you might have a problem, and that happened in some DeFi protocol. And of course, more illegal activity because there is no uniform way of doing. There is a lot of regulatory arbitrage and a lot of different illegal activities that persist in stablecoins and damage the space in general. I think the problem is entering a worse phase, so that's my intuition, because there is a lot of new actors that are entering. Illegal actors understand well the technology. Coordination from the public sector is probably hard to obtain. There is awareness about the problem, but it takes time. And so I'm guessing that we're entering probably the worst phase of all of this. With this, thank you very much for listening. And we have 1 minute if you want to have one question, otherwise happy to discuss after.
Any questions for Xavier? No? Okay, thank you, Xavier. So please give us a few minutes. We'll set the stage for the next panel. Okay, next up, we have a panel on balancing consumer protection and global competitiveness through regulation with our moderator coming back again, Xavier Lavassier. We have Rodolphe Baruch from BPCE. We have Jan Eggelson from Monerium and Julien Niveau from ESMA, who will be speaking on this panel. Welcome our speakers, everyone.
The stage is so big, I feel like you're far away. What's the weather over there? So, thank you for this panel. We will discuss how we can balance consumer protection and global competitiveness through regulation. I will jump in, or maybe should I present all the speakers? So maybe first, let's do it yourself, so if you want to introduce.
Okay, yeah, good afternoon. My name is Julien Niveau. Actually, I'm working for the European Securities and Market Authority, so the ESMA, where I'm in charge of digital finance topics. So basically, what we are doing is that we are working on the regulation applied to digital finance, for example, on the crypto asset market, but also on the tokenization more broadly. So happy to be here.
Yeah, hi. I'm Jon. I'm a co-founder of Monerium. Monerium is the company that issued, licensed and authorized stablecoin in 2019. First company to do so, and the first digital euro in that sense offered by Monerium. Now we're focusing on the euro is of course our focus. But as we know, then the US dollar is denominating the stablecoin market, so our focus is now on how do we become more successful with the euro in general.
Hello everyone, I'm Rodolphe Baruch. I'm part of the strategy division of BPCE, the French banking group. And previously I was part of the French Treasury, so I was part of the team negotiating the MiCA regulation. I was part in charge of the regulation of crypto in France.
We have a really qualified panel today, and we go into a lot of geeky details, but let's start with some iconoclast question for you, John, to start, and you can jump in after. So are the current stablecoin regulation, in your view, like really protecting the consumer, or are they more designed in the end to protect the financial system as it is today?
Well, the question is the consumer protection and competition or competitive advantage in a conflict. My response to that is always no, because it's basically the same thing. You have to make sure that your product is protecting the consumer. And if that is the case, then you have a competitive product. So I think that's really important. Now, your question, Javier, is, is the current regulation basically protecting the incumbents? Yes, it is. We can go through this in detail, and as we know, then MiCA was a response to Libra, and the unofficial aim was to kill stablecoins, and voila, here we are. We have MiCA, and it is really bad, and it is becoming more and more obvious since we now see other jurisdictions moving ahead, and they do things in a different way, more rational, more progressive. And frankly speaking, then the Europeans, they will have to step up. They will have to revise MiCA in order to be competitive on a global stage. I can go into this in detail if you want, but I'm not going to dominate the talk here.
Yes, I think regulation must not oppose customer protection, investor protection, and innovation. I think the former is really the condition of the latter. And MiCA, I partly agree with what you said, but we are really far from the initial ambition. The initial ambition was really to find the right equilibrium between innovation and customer protection. Now it's much more complicated, and to rebuild a fully fledged regulation based on the traditional regulation, MiFID, the DSP, and so on. So it was really complicated to find the right equilibrium. For instance, about the electronic money token, it was based on DSP and the electronic money regulation. So it was really difficult to find the right border. But now MiCA has not been completely implemented. That we are still calling into question MiCA, in particular about sovereignty, and much less what you're saying, but about sovereignty and financial stability. Now financial stability is really the key word, but based on fallacious analysis, maybe sometimes about the sovereignty and because regulation cannot by itself makes really a comprehensive strategy. It's a pillar, it's really important, but it cannot be build a comprehensive strategy. And I think, and the best example is retail CBDC, the digital euro, that is partly useless and costly. And I don't speak about the wholesale CBDC, that is important, but the retail CBDC is really a question. And so now we have entered a new world, a new kind of application of crypto and blockchain application for financial sector. I think because before it could be considered as a scam or as a passing fad, but now it's really implemented. Banks and other institutions find that really as a concrete example, and so we need to implement the digital technology in the current universe.
Maybe just one detail on this is why there is the e-money token regulation that doesn't follow just the e-money directive that already existed. If I'm correct, you already had issued your token as the e-money using the directive that already existed. Why there has been a new regime?
Yeah, this is a really good question. So for 26 years, Europe has had e-money legislation, which is basically regulating a digital version of cash. A very good regulation, and when we started, we saw, okay, this is really good for controlling stable coins, and we thought that this would be the foundation for that, and it turns out to be. MiCA doesn't add anything to that legislation, and it makes it worse. Now, if we think about it, then if you're an issuer, if you're a stablecoin issuer, you have two main responsibilities. You issue at par and you redeem at par. You have to do it in a secure and safe way. That's the important thing. The e-money legislation from introduced 26 years ago basically says, well, you have to have it in segregated accounts. You can hold it in high-quality liquid assets. That is the credit risk part. Really good. We welcome that. That's good for the consumer. It's good for competition. Okay. What MiCA did was that they fragmented this legislation because of technology. Hold on a second. E-money legislation was supposed to be technically neutral, and that's really important. But they wanted to kill stablecoins, so they invented a new set of rules. By introducing fractional reserves banks in between, you have to hold 30 to 60% of the underlying safeguarded assets in banks. You're making it less safe for the consumer. And why is that? Because these are risky institutions. And not only that, when you have, and I'm not saying if, I'm saying when you have the next banking crisis, then that will spill over to the tokenization of stablecoins. It will spill over to stablecoins. Now compare that to the US or the UK, as it is proposed now, then that is not the case. In the US, you can hold the underlying in high-quality liquid assets. That is Treasury. And if there's a banking crisis in the US, it will not spill over if you hold it in Treasury. So what the regulation did was it introduced systemic risk into this market. So all claims that this is about making sure that there is less financial instability is not true, actually. That's one thing. Another thing, which is really important, is that you have to issue at par, and you have to redeem at par, and immediately. So you have to be able to give the consumer their euro when they ask for it, immediately. Okay. So how is that? In the US, there is a possibility of repoing the high-quality liquid asset, meaning that in times of stress, you can basically say, well, the underlying assets are here in high-quality liquid assets. I need to redeem now, and I need to borrow against, qualified collateral. And that is how you maintain and secure liquidity. How is it in Europe? Well, that was really interesting. In January 2025, the European Central Bank made a decision publicly saying that non-bank authorized and licensed stablecoin issuers will not have access to the central bank, okay? Will not have access to the central bank. Okay, why is that? Well, they provide the explanation as well. And what was the explanation? The explanation was, well, if we would allow stablecoin issuers to have access like we allow banks to have access, then there would be too little difference between stablecoins, which are then synthetic CBDCs, and what we, the central bank, are going to issue in 2029. Imagine that. You have a European central bank which has the main objective of making sure that there is financial stability. They publicly claim that they don't want to allow licensed and authorized stablecoin issuers to have access to the central bank because it will make the product almost as safe as central bank money. This is really, really interesting. And I think, honestly, that Europeans should ask themselves, is this what we want? In the end of the day, the European Central Bank is supposed to serve the people of Europe. But the European Central Bank has decided, basically, to go out and compete in this market, offer a digital euro, competing with the private initiative in Europe. And because of that, they are also now not only overseeing this market, they are creating rules and regulation to make it easier to compete. This is really not okay. And I think, honestly, that people of Europe should, voice their opinion about this.
That's all good points. Julien, you want to add something on this, or maybe to discuss? We have seen what's the current state of MiCA and regulation. What should be the next step in your view?
Yeah, no, perhaps just to react quickly, and then we can talk about the next step. Of course, I'm not working for the ECB, so perhaps you are better positioned, Xavier, to answer on your point, John. But Yeah, agree with you in the sense that MiCA was created, at least the stablecoin provision were created in reaction of something that disappeared, which was Libra. So we built that on the fear of this project. It's totally true. Regarding the e-money directive, I mean, it is based on the e-money directive, but with stronger rules applied to DLT, of course. Whether these rules should be revised, I mean, yeah, perhaps we should work on that, and perhaps in the next negotiation we're going to have something, I don't know. But in any case, we need and agree with you to check what happened elsewhere. It should be, this benchmark exercise should be at the heart of what we are doing in Europe. Not only the Genius Act, but of course Genius Act is one of them. Regarding the next step, yes, I think next step now would be about, of course, issuance. We talk about it. It's an important step to when actually you want to regulate. But now we've got MiCA since it has applied since June 2024 for stablecoins, for asset reference token and e-money tokens, and December 2024 for crypto asset service provider. I think issuers are heavily regulated, so perhaps we don't need more regulation at the issuer, let's say, level. But now, I would say that emerging risks are increasingly downstream, if I may say so, to distribution, I would say, to the distribution level. And this is where I would emphasize, I would say, the next step of regulation. It's at the distribution phase. Because what we see here, it's new types of risk, I would say. It's at the level of the access, at the level of the marketing, and the reuse also of the stablecoin. I mean that access, because now the crypto asset service provider are becoming the kind of gatekeeper in the market. So they are listing stablecoins and they are providing stablecoin to the retail clients. So the distribution part here is super interesting. And we're going to talk about it later on, but we published a statement in January 2025 at ESMA regarding unauthorized stablecoins. So stablecoins that are not compliant with the MiCA rules, and not gatekeeper, crypto asset service provider, which are gatekeeper, play an important role on which one they can actually make available to the EU clients. You've got also the way you market it, the way actually CAS present it. And here we've got some risk. For example, one of them is, the mislabeling thing when it comes to tokenization. We have seen some product named, labeled tokenized securities. Well, actually, it was definitely not a securities. It was more a derivative product of this kind of thing. So it is an issue linked to distribution channel. And by reuse, I mean, when crypto asset service provider provides stablecoins, but provide also this kind of stablecoin products with yield linked to DeFi protocols. And here we've got also, I would say, an issue because, as you know, it's impossible to have any kind of interest at the issuer level, but also at the intermediary level. But then you enter into a gray area when it comes to DeFi, and we need at least clarity on that. I don't say that we need to actually make it impossible or forbidden that, not at all, but we need clarity. I think it's key. So the distribution channel is a very important one, and I would say this is I would prioritize this part now instead of the issuance part. And there is another point also that goes with distribution, by the way. It's enforcement, because by nature, I mean, all these tokens and stablecoins also are cross-border by nature. You can issue a stablecoin in Germany, and you can trade the stablecoin in France, and you can have put them on DeFi protocol, etc., etc. So rules regulation is great, but mindset is also important, and cooperation is also super important. That's what we call supervisory convergence actually for the European authority at the European authority level. So we need actually to face the problem that we have a European regulation, but we've got 27 other member states, 27 other countries. We have their own view sometimes on how to apply the rules. And here we need to work on that, and ESMA actually is helping to have a more, let's say, harmonized approach when it comes to enforcement. So yeah, so I would say that indeed we've got a regulation. Definitely this regulation is not perfect, I agree with you, but regulation is not all. We need mindset also, and we see that in the US because a lot of crypto projects, stablecoin projects develop in the US under the Biden administration where actually nothing was clear, nothing. And the ECC, the CCC, it was possible for them to knock at your doors and say, oh, by the way, your thing, your crypto thing, is a security at any moment. But it did not prevent, actually, the development of a market. So here in Europe, we should also, let's say, have this kind of mindset, and we need to make it possible for the private sector to develop projects on stablecoin, on crypto in general. Yeah, that's the...
Yeah, I agree, Julian. Of course, legal clarity is really important. Europe pioneered that. That's a good thing. That's very positive. We just have to realize that we can improve. We see the global market, how it has been progressing. And the title of this panel is Balancing Consumer Protection and Global Competitiveness Through Regulation. I think there is a huge opportunity in Europe to improve MiCA in a way that we are better than the US, okay? Because if we get that right, and we make sure that we have the safest and the best product for the consumer, we are better enabled to compete with the US dollar, okay? The US dollar is 99.7% of the US dollar denominated stablecoins. We want to change that, but we cannot do that if we have a regulation that doesn't adapt, so we have to just change it, we have to improve it, and then we need institutions that trust the 400 million people of Europe, because in Europe you have fantastic companies, you have many fantastic entrepreneurs. Trust the private sector to innovate in technology and business, okay? Back those entrepreneurs up with what is needed by the institutions of Europe to enable them to compete with the rest of the world. Don't fall in the trap to think that there is a centralized planning that's going to solve all of this. It's not, in my mind. I mean, I used to be the chairman of the supervisory board of the central bank. It's not a role of a central bank to innovate in technology and business and so on. Back those companies, the private sector, up to do it out of Europe and enable them to compete. That is my message.
Yes, maybe just to react to what I said just before. Really, MiCA was really the first step because it's just a reaction of Lima, and as you said, Julien, it's really the first step, but we could not have anything, but it was just the first step. It was a result of a compromise among all different parts, and I clearly see what you're referring to about the 30% of deposit in banks and so on. Yes, it was a compromise. It was an equilibrium really to embark and really to join all the bank lobby and all the banking system to propose this. And I agree that it's not perfect, and we can improve this, and really the first step. And maybe just to tackle the effect of stablecoin on banks is totally ambiguous. It's not clear, because when you look at deposit, credit, or financial transformation, it's totally it's unclear. It depends on if you are a retailer or international. For who claims the stablecoin, what are the assets that are converted when you claim stablecoins, and how you manage all your reserves. So maybe banks are afraid about this, but it's not clear. There is not eventually a leak of deposit. Depends. And we have the same debate about the MMFs in the 70s. What will be the impact on deposits? So the compromise will progress. Maybe we can we'll get something new. But I totally agree that it's really a huge opportunity for Europe. We are profitable, a huge, massive market compared to the US. We can compete with them. We have a preferred market with Africa, for instance, for remittance, for instance, and we can really level up our level. So yes, so maybe the regulation will improve in the coming years, and there is a huge potential for banks.
That's a very interesting take, I think. So because you don't see it as necessarily a threat, but maybe an opportunity. What interests me is maybe where do you see banks play their strengths? Because every company is trying to do everything, but at the end there is something you do better. So you think that banks especially have experience with dealing with customers and so on, so maybe they would be able to provide better services and so on, or more being a financial actor, like in the sort of second tier, providing services to stablecoin issuance, on how you see more opportunities?
Yeah, I think there will be a move of unbundling of banking services or changing of services, because for banks there is really an association of payments and all banking services, and now on the payment leg it's different and much more complicated. Or there will be an evolution, for instance, about payment. I think banks can compete at the national level. We've seen with Wero and so on. For the French, on the European point of view, there is no so much difference between the stablecoin or not. For the customer, it's fast, it's reliable, and so on. So there is no really a massive difference. There is a basic difference for cross-payment, remittance, and so on, to really streamline the process and change and less costly, faster, and so on. So banks can integrate much more this part of remittance, and all the part of settlement and financial markets. There is nearly a massive change to have and to implement. So it's really a major change for them. But I think banks will play a significant role even with stablecoin and even for deposit, even if each stablecoin issuer will put the money in HQLA and other funds. With the regulation, there is a limited part to put in deposit, but it imposes to banks to change their banking management and cash management, because we have much more concentration of stable issuers. So for managing a deposit, it will be much more complicated. With a part of unsecure deposits, so how do you deal with this? And for the leaking of a part of deposit, how to find new capital market instruments to channel to a credit offer. So it's also a challenge. So just to answer to your question, I think banks will still remain the cornerstone of the relationship between retailers and the financial market and all the other system. But we need to improve and to level up our game, improve our system, and to really adapt to the newcomers and new stablecoin systems.
I see you reacting internally a lot.
So what we very often hear about stablecoin is that, well, in Europe it's already fast and cheap and everything. We there is not much to add, but. Monerian was the first company, as I told you, that issued a licensed and authorized stablecoin. And the number one reason why we wanted to do it, there was just one reason in my mind. We wanted to be able to hold the money outside of the banking system in a legal and authorized way. So we wanted to create an alternative to the banks, okay? If you think about why are stablecoins so popular today, it's partly because of cross-border payments. It's cheap and easy and so on. But mostly in LATAM and Africa and so on, it's because people can hold the US dollar in their wallet and they don't need a bank account. So those people have the same motive as I had. I wanted to be able, I come from a country where the whole financial banking system collapsed, okay? I wanted to be independent of that. And imagine what kind of a change that is. What I want to focus on is that there is a huge potential to improve the financial system. It doesn't mean that you are competing with the banks, but you are providing an alternative, and you can provide a safer system, financially safer system. And I think it's about the mindset of people. You can react to some new technology and say, we have to kill it. That was, what was done initially here in Europe. Where we can say, well, this is interesting. We can potentially improve something. How can we do it? And I think there is a huge potential still to improve the financial system, the banking system, and so on, using this technology. And I think the regulators and the ECB and so on, they have to maybe adjust their thinking in that sense that, this is a big opportunity. But it might require that we do things differently than what we have been doing so far.
Just a minor remark. Yes, I agree that to keep your money safe and so on, but we cannot really compare the financial system of Latam and Lebanon, for instance. You don't need to take a hostage your banker to withdraw your money. But I totally agree that it's another possibility to really keep safe your money and to have another approach and no mindset about financial systems. So I totally agree.
Yeah, so what I'm saying is that banks are obviously concerned that there will be a flight out of bank deposits. I understand that. But for the consumer, well, they are subsidizing lending for the banks. That's not optimal for the consumer. So the consumer can now, via stablecoin, they can say, okay, I have a stablecoin, and now I want to basically place that into a money market fund. Money market funds were fought. I mean, the banks didn't like money market funds in 1971. They wanted to ban it because it was supposed to be, destabilizing for the banking sector. Yes, because it's basically a threat to the deposit. The same thing is for the stablecoin. But it doesn't mean that it's bad. It's competition, and competition in my mind is healthy, just like competition between jurisdictions.
So talking about competition between jurisdictions, what do you think, Julien, should be done in Europe regarding non-euro stablecoin? Because I know that there is US issuers that have also issuance in Europe. There is totally foreign stablecoin that are going on. So, what should be the strategy regarding this? Because we can only regulate where we are.
No, sure. But I mean, the position is quite clear in Europe. I mean, you need to play by the rules. So if you can comply with the MiCA regulation, then it's impossible for you to actually have EU clients and to target the EU clients. And this for several reasons. So as I mentioned before, we issue a statement that is very clear that crypto asset service provider, it's impossible for them to offer, to market not even non-EU stablecoin. Non-EU stablecoin is not the problem. The problem is non-compliant stablecoin. It can come from anywhere in the world. But you need to comply with MiCA. You need to play by the rule. So the crypto asset service provider, it's impossible for them to market, to trade, or even to execute or to offer to their client non-compliant stablecoins. I mean, here we need to reconcile actually two, let's say, mindset to problem we've got. We need to protect ourselves as European against the hegemony of the dollars. Against the USDT, for example, because there is at stake, and it's not ESMA saying it, it's the ECB, it's the BIS, there is a monetary sovereignty risk, and we need to take that into account, of course, and we need also to think about the role of the euro. So I prefer that your clients held, euro stablecoins than US stablecoins, of course. Even it's the stake of the market is very, it's not impossible to compare the two, but. Anyway, so we need to think about that. We need to have that in mind. And we have also to reconcile this with competitiveness. We need actually to make it possible for our European company to develop their business model, as you mentioned before. We need that because otherwise we're going to have a situation where regulated EU entities will bear the cost, if I may say so, of the regulation, while actually third-party company or company coming from abroad will, benefit from the scale without being, let's say, compliant with MiCA. So it's not, this situation is not possible. That's why actually for non-compliant stablecoin, it should be impossible to market them or to offer them in Europe. I mean, it's quite clear. But we also need to work on the fact that we need in Europe to have, as much as possible, let's say, a kind of web of European companies that can actually scale, that can propose their business model to the European consumer. Because my view is that the best way to protect EU consumer, but even to protect, and Rodolphe, you mentioned it before, the EU market system is to have European companies. So, yeah.
So that's a great ambition, but we still see that there is a deficit. So maybe in one sentence, each of you, what should be the one priority we should have in the next month and years to help that happen, in your view?
Clarity, regulation clarity, and maybe much power for ESMA, and to have really one point of entry and really clarity for competitiveness is clear. As I said before, there is a regulation and customer protection will be the basis of innovation and the development of the market, and really create trust. Yes, regulation clarity.
More than one sentence, but okay.
One sentence? I think we need to weaponize the private market in Europe by the right regulation. We have to revise the current regulation. And then we need the institutions to back it up.
Okay. And for you, Julia?
Simplicity for firms, clarity for EU consumer, I would say, and supervisory convergence or harmonization of the practice in Europe.
Great. Thank you very much for this. Thank you for the audience.
Thank you.
And yeah.
Thank you. All right, thank you for that. Next up, we have Mike McCabe from OXBO, who will be speaking on what your crypto card shows the world. Welcome, Mike, everyone.
Yeah, so hi, everyone. As announced, my name is Mike. I am the product lead at OXBO. Thank you all for coming to my talk here. At OXBO, we build privacy tooling such as privacy pools, and we also build compliance tooling to support said privacy. So yeah, we're here at StableSummit today, and we're obviously all very excited about stablecoins, as am I. One thing that I'm curious about is that I'm guessing a lot of you have one of these as well. This is a Gnosis Pay card, which is essentially a self-custodied crypto debit card. And so I use mine quite frequently. I'm a big fan of the product. But I think, yeah, there is also some design choices we need to make about these kind of products that I think we can kind of improve on a little bit. And today with this talk, I'm looking to demonstrate why we should think about this quite carefully. Yeah. So let's take a look at Gnosis Pay in and of itself. So it has over 31K weekly payments. It has 3,500 active cardholders. It does 2 million in weekly volume. These are not huge numbers, but you can see there is also 420% year-on-year growth, which is really quite significant. And well, with all the hype around stablecoins, we can kind of expect this to increase. And so every one of these transactions is permanently stored. This is all public data on a blockchain living forever. There is no opt-out. There is no, I mean, we're in Europe, there's no GDPR request for removal. And so this is public forever. And so what can we do with that, right? Why is this a problem? So let's first take a look at how Gnosis Pay works. What happens is you tap your card at a merchant, and Visa sends an auth request to Gnosis Pay, which then triggers an on-chain transaction from your Gnosis Pay account to the Gnosis Pay settlement safe, which is a public transaction. And then that settlement safe balances out with Visa, and that happens off-chain. So what happens here, right? Like, what can we learn from this? Well, we can see the exact amount in euros. We can see the exact timestamp. You can see your wallet address, your current balance, and your entire transaction history. What we don't know is the actual merchant, the purchase category, and the geographic location. But in all honesty, we don't really need that, and I'm going to show you why. So first, what I did here is I created a June dashboard, to which I'll share a link at the end of this presentation. And what I did first was identifying all Gnosis Pay cardholders. So as I mentioned previously, this all links back to a single settlement safe. So as soon as you find that, you basically find all transactions coming into there and thus all accounts. So here is some sample data. As you can see, there are active accounts here with a lot of transactions that spend, quite a large amount of money. So yeah, let's dive in. What can we learn? I pick one wallet from this list, and I have to give a small disclaimer here. I used a hypothetical wallet because I felt a bit bad about really doxing someone like this. So this is fake data. I will share the query to the June dashboard. If you want to snoop yourself, you can see all of this. Well, let's look at an average Tuesday, right? We can see there are around 8 transactions happening here. First one is at 7:42 in the morning. I mean, it's a €3.80 transaction. We're making an assumption, maybe it's a morning coffee. Next one, we have maybe a public transport ticket. Then we see lunch, and the list goes on. There's quite a few transactions here from different amounts, so we can take a few guesses at what's actually happening. So from one day, right, we don't know anything for sure, but we can make some assumptions here. We can assume this person, for instance, lives in CET time zone, that it, has a 9-to-5 job, it has a lunch break at 12:30, and it takes public transport, wakes up kind of early. So yeah, as I said, this is one day, it's guesswork, but once we start diving into the bigger picture by, for instance, looking at all the transaction history from this account, we can create a far more granular picture. So what if we multiply this one day by 365 days and look at a year in the life of this wallet? Well, we can see very clear spending patterns, and we can create a very accurate financial fingerprint. As you can see, we observe a very consistent pattern with regular activities across basically your Monday 9 to 5. And on the weekends, there seems to be a lot of social activity in the evenings. We can see that most transactions here are pretty small, between like the 0 and 5 euros, and then it gradually decreases as the amount gets higher. So such a financial fingerprint is really quite unique. This is very sensitive and valuable data, and it can really be used to create a pretty detailed picture of your life, of how you behave and what you do. Yeah, so we can go a bit further too, right? Because this is all on the spending side. We can see, for instance, there is a $99 recurring payment every month. It's probably a subscription, $39.99 as well, probably also a subscription, and we know you like to get a daily coffee. So this is on the spending side. However, the income side is public too, right? Like, we're assuming this user uses Gnosis Pay as their primary payment method. and it also receives their salary there. So then we see a monthly transaction coming in of approximately 3,000 euros. We can trace that back, and now we know this user's employer as well, especially if that employer is identifiable for like ENS or something like that. We can see that there is another wallet giving infrequent transactions into this safe, and so we can also know, okay, this is probably your crypto wallet that you use for, well, your crypto life. And we can also see you top up from Binance from time to time. So we know you trade on Binance too. And so these are all little puzzle pieces through which, you know, we can really start to paint a picture of who this user is and what their habits are. Yeah, this is one user, but we can do this for the entire Gnosis Pay user set. You can profile all these people that are in the Gnosis Pay list all at once. You can see it paints quite an accurate picture of what kind of users Gnosis Pay has. It's got 4% of users that spend a lot of money. They average more than 100 euros per payment, more than 5,000 per month. We have 22% of users that are daily spenders. It's quite a high amount. It's quite impressive, actually. We have a few people that only use it on the weekends. We have a few, other people that only use it during weekdays, so they probably only use it for their business. Then you have people like me, tourists, visitors. I usually use my Gnosis Pay account when I'm traveling, so I would fall into that bracket myself. And I've assumed, because I've only looked at your e-transfers, so I've kind of assumed that everyone that is in this bracket is located in CET. So then final category, we have some people that for some reason only use it at night. Yeah, now you can see, I know all of this just for like 5 simple June queries. This is a lot of information. This is a lot of competitive intelligence. Yeah, so not all crypto cards are equal. We've now looked at self-custodied wallets, and self-custodied wallets are probably the most exposed right now. You can also, of course, use a centralized exchange crypto card. I'm not a big fan of centralized exchanges myself, but in this case, they do definitely provide more privacy than the alternatives. And you can also obviously still just use your regular TradFi payment card. Yeah, I mean, if you look at TradFi, you really have quite a lot more protection than you have in crypto now, you know? Like, banks are supposed to protect all of this by law, whereas here, if in your self-custody card, everything is basically on-chain. And so this is all fun and games, this presentation here, but I wanna make it a bit more relatable in the sense that, you know, like, this data truly is very sensitive, and people are looking at this data right now. We obviously have like the Chainalysis, TRM Labs, Elliptics, your blockchain analytics firms who offer this as a commercial service. They have probably indexed every one of these users as well. And what I personally think is a pretty scary thought too is that hackers and scammers also see all of this. And you can imagine that, like, well, we obviously have loads of data breaches in crypto, from centralized exchanges to KYC providers. If your data is compromised in any of that, and that is then linkable to your Gnosis Pay wallet, you are a target, realistically. And so you really have to think about, yeah, designing these kind of things. Then data brokers look at it, your employers, partners. I mean, this is open to anyone. Yeah, so how do we solve this? How do we fix this? I'm going to do a little bit of shilling here. We are going to release Privacy Pools v2 on testnet basically this week. Our goal is to create privacy for consumer fintech products such as Gnosis Pay. Essentially, what we do is we use zero-knowledge proofs to break the link between deposits and withdrawals, transfers, all these kind of things. So how this would work in the case of Gnosis Pay is a user would simply deposit into privacy pools. So that deposit part is still going to be public. However, you're not going to be able to see who receives that money. So you just see money going into the vault, and you cannot link it to a recipient anymore. So it's already a little bit better. Then if you spend money at a merchant, you make a private transfer to the private settlement vault, and so nobody sees anything. Yeah, I think privacy is extremely important. The way that public blockchains are designed is great for some use case, and I think it's truly one of their strongest capabilities, but I don't think it's great for everything. Privacy isn't a feature, it's really a right. I think that especially when it comes to things like stablecoins, payments, consumer products, we should really think about how we can embed privacy by default and yeah, ensure that we don't leak our clients' sensitive information publicly to anyone on the internet. That was my talk. Thank you very much. And yeah, if you're interested, you can scan the QR code, see the June dashboard for yourself, and do a little bit of snooping.
Thank you, Mike. Next, we have Ivan Fartunov, co-founder of Generic Money, who will be talking about privacy and compliance in on-chain payments.
Hello. It's a bit of a continuation of the previous talk, to be honest. It's very similar topics. Hello, everyone. My name is Ivan. I'm a co-founder at Generic. We're building confidentiality stablecoin infrastructure, and this talk is about a bit of the mismatch of where it's needed and what a solution looks like. I realize I don't have a clicker. Do I get a clicker? Nice. Okay, cool. So, as anyone that is building privacy and confidentiality on chain, we get very excited. There are like a lot of nerds talk about this. You just heard the previous talk. It's one of the verticals that is still seeing VC interest alongside RWA. Everything else is basically dead in terms of like fundability at the moment. So we went out and we spoke with like actual potential users, which is enterprises, PSPs, custodians, etc. So something that came across, which is, at least for us, it was unexpected when we started doing this, is that like a lot of the demand is not really coming from like an end source, but it's intermediaries and infrastructure providers preparing for the arrival of actual demand. And those like end organizations, so enterprises and institutionals that actually take privacy seriously, they're not looking at it from leaking competitive intel perspective. They're looking at it from, okay, I have a like user protection regulation that I need to comply with on behalf of my clients, and that's why they're thinking about privacy and confidentiality on chain. So it's more around regulatory obligations. And why is sort of like nobody too worried about this at the moment? So currently, this is roughly what the stack would look like. A lot of the enterprise clients and frankly, a lot of like the more traditional institutions, they would go through like a PSP that provides a hosted wallet and through a custodian before they hit the network, right? So from their perspective, I mean, some of them don't even realize that transactions are going on a public chain where everything is visible. But something else that is like relevant at the moment is if you look on the network, you would see, I don't know, cross-mint paying BVNK, or just like a transfer between two cross-mint wallets, because this payment processor basically provides abstraction of who's behind this. This is, however, at the moment just on like UX level, basically. And we believe that that sort of abstraction is going to run its course in terms of usefulness, and at some point, like more and more of the flow would be visible on chain. Why do we believe that? Glad you, I mean, you didn't ask, but let's assume you did. Basically, there is like $1 billion industry around on-chain analytics. We have Nansen, we have Chain Analysis, we have Arkham. Like those are players that have something like 500 million wallets labeled on chain. The infrastructure around this sort of analytics is getting better and better by the day. The gap between technically public and practically readable is shrinking. We have AI, which drastically decreases the cost of running these analytics, and soon enough, basically all your flows will be visible to someone who doesn't need to hire a team of financial forensic analysts. They just need a $200 subscription. And something that is sort of, again, like if you're just a user of the network, not necessarily intuitive, is a lot of people would use a centralized exchange as a mixer or a confidentiality bridge of sorts, right? The thing is, in a centralized exchange, a lot of the funds get commingled because you're dealing with like end consumer funds. If you're dealing with a custodian or a PSP, from an institutional perspective, you have segregated accounts. So a custodian would spin up often multiple wallets that are just for you, and they wouldn't mix assets of different clients, which actually results in better traceability on chain. And then something else that actually is a reason why organizations are going towards future-proofing is that the more history you have on chain, the easier it becomes to decode behaviors. As we just saw in the previous talk, it was just the perspective of a consumer, but if you think of enterprise pay flows, things look quite similar. It just, the counterparty that is interested to understand what's going on is different. It's not someone who wants to sell you something, it's often like a competitor or someone who wants to get better negotiating power knowing your behaviors. So although most of it is future positioning at the moment, there are undeniable signs of demand arriving on chain. So we have regulatory clarity, we had the Genius Act that mandated what a federal level stablecoin would look like. We had the FSAB treatment of stablecoins, which was a big unlock. It basically means that if you have stablecoins on your balance sheet as an organization, as an auditable organization in the real world, these stablecoins would be treated on par with cash or cash equivalents instead of being written down to zero, which was the previous treatment. And this means that it becomes practical for companies that are subject to the GAAP, which is the American standard or it's the global standard for auditing, financial reporting. They can actually hold stablecoins now without getting punished for it. And lastly, there is the Clarity Act that is currently undergoing final touches. Yes, the treatment of yield is not exactly what we hoped for, but it adds, as the name suggests, some clarity on how these things would be handled, which inevitably creates less friction for an institution to come on chain. We've seen also volume picking up tremendously, 730% in a year, and this is B2B volume specifically. We're also seeing large players spend serious money on acquisitions of infrastructure in the space that show conviction into the future of on-chain payments. So we spoke that a lot of enterprise use cases don't really care too much about privacy today. There is one quite notable exception, which is payroll. So we have global leaders of payroll, not just within crypto, just generally global leaders of payroll, like Remote.com, Rise, Deal, even ADP, which process something like double-digit percentage of all the payroll in the US. They are pushing a lot of volume already on chain. It makes sense because a lot of these organizations, they deal cross states or cross countries. It's cheaper, it's faster, it's 24/7. It makes sense to push the stuff on chain. The thing is, in the legacy setup, oh yeah, cool. Okay, so in the legacy setup, usually you had, an employer, this payroll processor, and then a bank wire or ACH wire, and then you have the employee. So basically everything is sort of hidden except for the processor's internal database and the regulators. When you move this on chain, after the processor, you push it onto a public network, and then it arrives with the employee. And if it's like outside of our industry, if it's like a normal, everyday Web 2 employee, you still have enough abstraction. But one of the main reasons to do things on chain is, well, there's like a lot of other things that I can do, right? Some of these providers are thinking of like, okay, how can we bake in, tap into some of the yield that is on chain for our clients? And this way, money spends more time on chain, which means you have more information leakage, and then you run into security concerns about, sometimes, in France, you might lose a finger for it, like if people know how much money you have and how you make them. So we're seeing that these type of payment processors are actually at the forefront of doing pilots around private payments. So, confidentiality and compliant confidentiality, it's not a response to a demand, it's a prerequisite for this demand to actually come on chain. So how does that look like in practice? Basically, there are, broadly speaking, 3 approaches. We've seen a lot of projects come out and secure like pretty decent funding to build a dedicated network for handling on-chain payments confidentially and privately. There isn't a one-size-fits-all. So like this usually gives, this sort of solution gives you like a full stack control, which is great, but the main problem there is that you need to basically bootstrap ecosystem from the beginning. This means like yield sources, DEXs, but also integrations with on and off ramps, asset issuers, et cetera, et cetera, et cetera. Another solution, a popular solution are mixers and pools. Those are like mostly services that we might be familiar with. Privacy pools, Railgun, et cetera, et cetera. One of the main challenges there and why we believe that it's not the best solution specifically for payments is that every transfer to achieve compliance, it basically has to pass a KYT test, KYT check, and that takes between 3 hours and a week. So you can't exactly run payments on this sort of speed. And the approach we're taking is on-chain encryption. This basically means that you have confidentiality, which is not full privacy, obviously, but it hits a better balance on the other trade-offs. So you can tap in existing liquidity and infrastructure. You have high settlement speed, and provenance of funds is easily provable, and also you have auditability, which is a prerequisite for a payment service provider, for example, to integrate this sort of stack. So why am I talking about this stuff here? I'm building generic, and we're a compliant confidentiality layer for stablecoin settlement. So basically what this means in simple terms is we encrypt amounts and balances, but addresses remain visible. So you end up with proven provenance. You end up with compliance, readiness, and with compatibility with existing infrastructure and liquidity. And we believe that this sort of solution slots in the most easy and natural way into an existing flow. This is broadly how it works. We believe that the next wave of adoption is not going to be people holding their self-hosted wallets, whether we like it or not. It's just the way that new capital and new users are coming on chain. So they usually have a payment service provider or custodian handling this. So you have somebody sending money, goes through a payment service provider. At that point, this gets converted into USDC, goes through a privacy pool. The receipt from the privacy pool is GUSD, generic dollar, which is an FHA encrypted confidential token. Transactions on the network happen using that token. And until someone wants to exit the system, you can not see who is sending how much money to whom. So you see start point, end point. You don't know the exact volume of transfer, which basically means not everyone on my payroll is going to know exactly how much each of their colleagues is making in a simple practical terms. This allows us to deliver payments at a speed that makes sense and is compatible with the way that people think about payments today in the off-chain world. And that's pretty much it. We are building this for the real users that are out there. It's a very unopinionated design. If some of the problems that I highlighted are something that you face in your daily business, come talk to me. Would love to hear about what you're building and what problems you're facing, and maybe validate if our solution works for you. Thanks.
Thank you, Ivan. Next, we have Michael Igorov, who will be joining us remotely, and he will be speaking about his new project, Yield Basis, and giving a deep dive on that. You can welcome Michael on screen, everyone.
Hi, everyone. So, well, I guess it wouldn't be about how yield basis works, I would say, but more about about research I did recently, and well, figured out how to make it better. But anyway, to start, I still need to explain how it works a little bit. So let's dive in. As you're probably no stranger to using automatic market makers. Most of you, I'm sure, provided liquidity in different protocols, and probably the most OG AMM would be the constant product AMM, which was used in Uniswap 1 and 2, but later was kind of replaced with concentrated liquidity, and Curve always was about concentrated liquidity, but still constant product AMMs are the foundational. And well, basically how they work, you have let's say 2 coins in an AMM, let's say some wrapped Bitcoin and USD stablecoin, and you have product of 2 balances being constant if fees are 0, unless users deposit more, right? So you have let's say constant square root of product, I would say, of 2 balances, the same per user, but growing all the time. And well, one disadvantage of this kind of AMM is impermanent loss, which is essentially the pricing of these deposits. So if you deposit funds in such an AMM, then price of your portfolio, which is constantly rebalanced in fact, would be proportional to square root of your asset price. So let's say, well, if you express everything in USD terms, it would be proportional to square root of Bitcoin price if it's BTC to USD liquidity. All right, so that's how constant product AMMs work. And if you have this pricing function being square root of your crypto price, then it's actually not good, because it appears then that if you held these Bitcoins and US dollars somewhere aside, you would have essentially almost always a bigger value if price of the asset changes if you neglect the fees. So there was some belief that the fees can overcome this impermanent loss, but well, so far it wasn't true, because at least Bitcoin was growing all the time, and you know this liquidity in these AMMs always underperformed compared to doing nothing. So, well, it appears that it's possible to to get rid of this annoying dependency. You just want to get rid of this square root, right? And to do that, you need essentially to construct some position which makes a square of your of price of your liquidity. And well, question is like how to construct it. Apparently you can. We have all the tools. The simplest way would be to essentially borrow against your liquidity, and you have size of the loan equal to half of the size of your liquidity. So then it's like, and you know, using this loan, you just buy more of this liquidity until this ratio of loan to liquidity is 50%. Then it appears that you have factor of 2 leverage. And if you leverage this thing by factor of 2, you get exactly square root disappearing, and you have liquidity price, the eventual position price being proportional to Bitcoin price. So it's like a little bit like staked Bitcoin. But anyway, this is a rough idea, which apparently doesn't quite work for this constant product. I mean, it works for removing square root, but it doesn't work for making money. It appears that this liquidity should have concentrated liquidity, and it should be automatically managed. So if you take automatically managed concentrated liquidity, its pricing will be also similar to this, but when you remove this square root by taking a loan against, by leveraging your liquidity, you will have essentially like almost Bitcoin, which is up only in Bitcoin terms, right? Anyway, under the hood, we have a pool with concentrated liquidity, but concentrated liquidity in curve way. So what does that mean? You probably noticed that since year 2021, Curve had crypto pools. And crypto pools, they were not constant product. They were actually having concentrated liquidity. They still are. And this concentrated liquidity is automatically managed. So let's say if you had current price being somewhere here, then you are in a good spot. Concentrated liquidity works. But if you move to the new price, then, you are here, so liquidity density is not good. And it's good to adjust your concentrated liquidity to move to the new place. Problem is, when you do it, you have some losses happening. And what the curve pools do, they actually measure profits and losses, and if they earned enough profits, they move concentrated liquidity to the new place. Well, what's interesting, we actually started very actively trying this for foreign exchange use case for non-dollar stablecoins, and it actually works. But we need something more than just spending fees which the AMM earned. So, well, how the OG crypto pool works, we have 50% of it earns fees. 50% of these fees go to LPs, admin fees, and so on. The other 50% go to rebalancing, right? So they subsidize, sort of, refuel, I would say, rebalances, right? So, and this is how it was. And then the question is, why wouldn't we add a little bit extra, right? So for example, in yield basis, we are borrowing Curve USD against liquidity. So why wouldn't those Curve USD, let's say we take interest rate, why wouldn't we spend all that interest rate also on rebalancing, right? So then we have a bigger stream of funds going into rebalancing, and then we rebalance more efficiently, and the liquidity becomes more dense on average. Or if it's done with let's say foreign exchange use case, I don't know, we have tokenized Swiss franc, for example, ZCHF and Curve USD. So why wouldn't ZCHF guys and us stream some funds to essentially make rebalances more efficient, and then liquidity density will be high, and hopefully hopefully the pool will earn more fees. So anyway, that was implemented, and in yield basis, this is going from the rate which you set in yield basis itself, right? So liquidity providers pay this rate essentially. Anyway, so how did it work? Let's find out. So this is a graph from a real pool. Looks like it's been following, what gray line shows is the position where liquidity is concentrated. Ideally, you want it to follow Bitcoin price. And, Bitcoin price is the black line, so you see that it actually, in reality, did not quite follow. Bitcoin price dropped, so it started moving to that direction, but didn't reach it yet. Well, do simulations predict that? Let's find out. Yeah, well, it looks like simulations show similar behavior, but reality is actually better. So it followed better in reality, but still, well, could have been better ideally. So simulations do predict things. Simulations, which we do on Curve, simulate arbitrage, but just arbitrage. They don't simulate anything else. So if you have natural flow, which is coming into the pools, or some liquidations happening, our simulations don't see that. They look only at arbitrage with external price source. And this is why simulations probably earn a little bit less than the actual pool earns, which is good. We want to be on a pessimistic assumption, right? So on a pessimistic assumption, the adjustment of this liquidity concentration is happening slower than in reality, but still we want it faster, right? And anyway, what does it affect? Well, first of all, let's actually zoom out. It looks like it would have followed actually pretty well over year 2025, but then volatility become a little bit higher than before in the short-term volatility. But this is comparable to what we would have seen in 2024. So clearly it looks like our volatility in 2026 is a little bit similar to 2024, and 2025 was kind of a low volatility time, ironically. But anyway, we should be optimizing for like something more volatile, it looks like. And well, what it affects also, when you have the liquidity concentration point moving away from the current price, the concentrated liquidity becomes imbalanced. So you are sitting at the edge of this concentrated liquidity distribution, and this makes your pool not 50-50, not 50% USD, 50% BTC, but let's say 25-75, which is probably not too great, right? And in simulations, it shows kind of similar, but as I said, simulations are a little bit worse than reality. Reality is better, which is nice. Anyway, and this is just this imbalance plotted in the graph, so you can see that indeed in 2026 imbalance is kind of similar, shows similar deviation from 50-50 as in 2024. So we don't want that. How do we deal with it? And here are several ideas which were validated in which were validated in simulations. But let me also show, like probably the most important for yield basis part, how the deposits grow, right? So if we work with pools like they currently work today, we have, well, the fundamental growth part, the line to which we actually will return eventually, right? And the redemption value, which is good, like corresponds to fundamental value when pool is balanced, but when it goes out of balance, we have essentially this, right? So so this is real data simulations, and simulations over 2 years and a little bit. So we want to avoid these these regions. So they happen when pool is very imbalanced, right? And we also want to avoid these little drops here. They are not very good. They happen when pool suddenly adjusts the liquidity. So we want to do it more smoothly, which was already implemented in ETH pool, but it's not actually enough. So what do we want to change? One thing you probably noticed is that we spend 50% on giving back to LPs and 50% on rebalances. But who said it should be 50%? It could be anything, right? So it's, after all, it's us writing code, so we can check what happens if it's not 50%. So let's do it. Let's replace it with something else. And that's what I did in simulations, along with that improvement of moving the liquidity in a little bit more smooth manner. And here is what I found out. It looks like if you plot the, I started measuring not just the APR, which the pool is making, but adjusted APR. So, first of all, it's APR minus donation rate, right? So minus refuel rate. So refuel rate is an expense which goes back into APR, but we want to subtract it because it was an expense. So I subtracted it, but I also adjusted the APR by imbalance. So if the pool is imbalanced, I discouraged the simulator to treat it as something big, right? Anyway, it appears that if we had 50% split, 50% to refueling, 50% to LPs, we've been in this spot, right? Which is actually not very stable. Like, you may get into this dense region, but if conditions change a little bit, you apparently earn less or become more imbalanced or something, right? So not a good spot. And if you are able to adjust the percentage which you spent on rebalances, you apparently can move to this spot, which is much, much better. You earn more, and you can actually choose a more stable point. So you can, the whole algorithm can earn more and be more balanced at the same time. Probably we want to really, if we have a compromise between more stable and earning more, we probably want more stable, actually. So let's see what it turned out to be. So same kind of graphs, following like liquidity concentration, following the price graph, right? So you can see it's going much better. So it's following, well, pretty much here, right? And the most recent drop, well, you can, depending on where you start, it either follows it ideally or follows it like here. So it's, even if it detaches, it kind of repegs fairly quickly, which is what we want. This appears to have pool imbalances up to, well, what is it, 65, 35, right? Or maybe, well, here it would have been like 30, 70, right? But it's much better than 80, 20 or something, and for a shorter time. And this also means less pressure on curve USD peg. Earnings would also look much, much better in this case. So fundamental value doesn't have these drops, but it's for a different reason. And redemption value, like the value you actually can withdraw, doesn't reduce for too long. So it's sometimes the pool goes out of balance, so you get less withdrawable for like some time, but not this long time. All right, so this graph looks clearly much better than before. And yeah, well, if you look at the summary, so following the price, like liquidity following the price, goes from this, where it didn't follow these peaks at all, right, to this, where it would follow pretty much everything. And the earnings, the value you can withdraw when you deposit it, right, would pretty much go from this gray line to this. So significant improvement, I would say. And also the stability of well, the effect on stability of stablecoin, which is used under the hood, Curve USD in this case, is also reduced, so it stays much more stable. Anyway, so this is kind of the brief summary of what I've been researching recently for yield basis, and probably also very important, this finding. So it's a little bit of a research which helps also the FX pools, because it's essentially the same code. This part also applies to FX pools, and I think we are going to see pretty much the same effect if we are able to tune this fraction we spent on rebalances for FX pools as well. So anyway, a little bit of a appears a little bit as a test in prod, but that's kind of well, a DeFi ethos we've got anyway, and I guess soon these improvements are to be expected to be live. Yeah, that's all. Thanks for listening.
Thank you, Michael. Does anyone in the audience have any questions for Michael? Okay, no, they don't. But thank you, Michael, so much for that talk.
Yeah, thanks for hosting me.
Of course, and hopefully we get to see Michael in person at the next StableSummit. We'll see. And
sure.
Thank you. And so now, please give us a moment as we set the stage for the next fireside chat.
It's red on.
Okay, thank you. Now, for our next session, we have a fireside chat, and the topic is on architecting singleness of money, clearing settlement at par value in a multi-issuer stablecoin system. This session will be moderated by Redwan from the Enterprise Ethereum Alliance, and with our speaker, Tony McLaughlin, CEO of Ubix. Welcome our speakers, everyone.
Here is the entrance. Good afternoon, everyone. I see a very furious crowd right now for Tony and I. I hope we're going to keep you awake and hopefully have a little bit of fun. I met Tony a couple of months ago at Sibos in Frankfurt, right? And we were together at a panel. And after the panel, he told me some good advice about how to keep the crowd engaged. And one of those advice say, don't prepare a question, just grill people on stage, and that's how it's going to be entertaining. So this is what we're going to do today with you guys. Thank you very much for being here, Tony.
Nice to be here.
Well, I'll start maybe by asking to introduce yourself a little bit, but I guess I have a little bit of echo, but I guess it's just on our side. Can you hear us well? Okay, awesome. So Tony, you spent 20 years at Citi. You're probably one of the most TradFi person today, and at that conference, maybe you could walk us through what was your haha moment, and how you came up with Ubix.
You're right. I spent 30 years in TradFi, so you know, you can burn me at the stake as an offering to the DeFi gods, if you like. I mean, I'm up for that sacrifice if it will be, you know, help the cause. But my epiphany was, look, I'd been working in a big bank, Citibank, and the banks had been told by the regulators, the US banks had been told by the regulators, don't touch public chains. So the OCC, the Fed, the FDIC said, keep off the grass. And then in November 24, there was the US election. And it was clear to me the morning after the US election that that picture would change. So the first realization I had was banks would have to start engaging with public chains. Now, there might be some people in the audience who don't think that's a good thing, but actually, I think there's a very productive place that these two things come together, Web3 and TradFi. It doesn't take away from anything crypto or DeFi or peer-to-peer, it adds. And that point, the point at which I'm working towards, is when every bank and fintech on the planet offers wallets that are connected to many chains. If you want to have a self-custodial wallet, have it. But if we really want there to be mass adoption, then we have to recognize that banks and fintechs have customers that trust them. Yeah. In today's world, you cannot get a wallet from your bank or your fintech. Generally speaking, there are exceptions to prove the rule, but generally speaking, you cannot get a wallet from your bank or fintech. I want that world to come into being where you can get a bank wallet or a fintech wallet connected to public chains.
Wow, superb. And what do you think right now are the blocker for that? Because, as you said, after the election, the Clarity Act is still having a little bit of bump in the road, but we've made so much progress on the regulatory side, so.
Stablecoins. So you can imagine that the banks were in an environment where there's a big keep off the grass sign. Now, if the regulator removes the keep off the grass sign, do people start having picnics? Do they start having barbecues? It takes them a little bit of time to get overcome. But there's a forcing function, and that forcing function is stablecoins, because the banks don't want to be disintermediated by stablecoins. Stablecoins live on public blockchains, and therefore the banks and the fintechs have to occupy that space or they get disintermediated. So stablecoins are the forcing function that make banks and fintechs offer wallets.
That makes me think, you know, how do you sell stablecoin to banks? Because as you said, it can be disintermediated. And so how do you sell that to them?
The easiest sell in the world. It's easy to sell stablecoins to banks and fintechs. And to the extent that people in the audience want to join in this mission to get banks and fintechs to adopt Web3 technology, here is the sales pitch. You know, how do you get a bank to do a wallet? Here's the conversation with the bank. Do you believe we're entering a world of tokens and chains? There's nobody who says no. Do you know which token will win or which chain will win? There's no one who can say yes. So the insurance policy, these people are risk managers. The cheapest insurance policy is you get a wallet. Because once the bank or the fintech can offer a wallet to its customers, whichever token comes, whichever chain comes, it's able to transact in those instruments. So this is a very different go-to-market than the crypto industry has been trying in the past. Here's what the crypto industry has tried in the past. I am a chain. I go to a bank and I say, I'm the best chain.
Yes.
Right?
Exactly.
And they hire the most charismatic salesperson that they possibly can. So when you're in a bank, you hear 15 charismatic people saying, I'm the best chain. And what that does is it creates a computation that needs to take place on the bank side that takes 3 years. So a far superior go-to-market for the industry is, we don't know which chain will win. We don't know which token will win. But if you have this wallet infrastructure, you're prepared for a world of tokens and chains. Again, I know it's a DeFi audience. Use your self-custody wallets. I use self-custody wallets myself. But just allow your second cousin and allow the corner store and allow the big business to use a wallet provided by a bank or a fintech. All that does is it creates the acceptance network that we need for our instruments to flourish. If we want stablecoins to win payments, not just within crypto, but the whole payments target market, the forcing function for that, or the thing that enables stablecoins to win payments, $2.5 trillion of opportunity, is if every bank and fintech offers a wallet. So this is the go-to market from this industry to TradFi needs to be done in a different way. Don't try to convince a bank that your chain is the best chain. This is a very narrow and dumb way of trying to get finance on chain.
Yeah. I remember also you saying to the bank, go where your users are, and in 5, 10, maybe even shorter, like they're going to be on those systems. And so you better, be in here. And I heard that actually last week when I was at DAS in New York, when there's other institutions and people saying, well, actually the banks are really listening to where their users are. They're like I would say a product company like anyone else, but if people are using this, they're going to start positioning. And it's very interesting so what you're saying is really like not the Trojan horse, but I would say really like the entry point for institutions and banks is through like the wallet infrastructure.
The wallet infrastructure is the common denominator. It's the cheapest insurance policy that a bank can buy. It's the first thing that they should buy. But then on top of that, they always want to know what is the use case. For some reason, we've taught ourselves, like the banks have the senior people in the banks, they think a smart question is, what is the use case? I think when you're dealing with a general purpose technology like blockchain, it's a really dumb question, but they want to know the use case. So again, we need the simplest use case possible, and that use case is receiving stable coins, not issuing stable coins. So here's the dynamic. One of the favorite ways for banks and fintechs to make money is foreign exchange. Any bank or fintech outside of the US that catches a dollar stablecoin and converts it into local currency makes FX. There's a ton of FX to be made. There are billions of dollars of FX to be made. And you might say, well, I don't want that revenue to go to the banks. But that's the business case for them to get wallets. Once the banks and the fintechs have got wallets, there's a global acceptance network for tokens of all kinds. Then the games really begin. Then Web3 wins. Why does Web3 win? Because ours is the general purpose technology. The bank account, SWIFT, ACH, credit, debit cards are the special purpose technology. The special purpose technology doesn't win when the general purpose technology is ubiquitous. So we all want, do we want finance to come on chain? Well, I think a number of parties do want finance to come on chain. Let's get our shit together in terms of go-to-market. Don't give the traditional institutions a computation that takes them 3 years. Give them a computation that takes them 5 minutes to say yes. We want to get them to yes.
But then how do you, because usually, you know, like the banks, they want to also like own the infrastructure. So
who does? Who wants to own?
The banks, they're going to be willing to have, you know, ownership of the infrastructure. And we've seen some of those moves in the past, you know, with Quorum and some other of those, you know, I would say consortium chain. And they can be a little bit frisky, say, well, we're going to deploy some assets on a public infrastructure. And so how do you answer to those concerns when they come and say, well, whatever is going to be that chain, L2, Ethereum, or even another ecosystem, they might not be very confident about deploying their asset on those public infrastructure, and they want to own it. So
let them go through their stages of realization. You know, if most of the banks, well, who are doing anything at all, they start on private permissioned. Again, the keep off the grass sign has been removed. You're starting to see them, okay, maybe I can have a barbecue in the corner, or maybe if I can picnic over here. They're not really occupying the space yet. But the entry point is, once they can give wallets to their customers, those wallets can connect to multiple different chains. The door has been opened irreversibly. So we need to plot how to get these wallets into every bank and fintech on the planet. They don't want to be disintermediated. Stablecoins are coming, they're scared. We want to give them something easy to say yes to. The wallet is the first thing. And the use case of make foreign exchange is extraordinarily compelling for them. So that's, look, this isn't just talk. Whatever we say on the stage doesn't matter. This is happening in the world. There's the forces have already been unleashed. The banks and the fintechs already have the sniff of fees and FX in their nostrils. If you're friends with the wallet providers, you'll know that the RFPs are like that from banks and fintechs. This is already happening. So my firm belief is that within 3 to 5 years, it's going to be very, very easy for you to get an address from your bank or your fintech. And what that means is the world of tokens and chains, the general purpose world, wins. The old special purpose rails become less used. This is firm prediction. This is math. This is the commercial interests. This is the future is the migration of traditional finance to Web3 rails. Now, we can go about it the easy way or the hard way. And what I do think is that a lot of people in the Web3 space, they got a shitty go-to-market. They don't know how to sell to banks. Is swearing allowed?
I think there's definitely some challenges, but we're getting more and more used to talk to institutions. At least that also like the work that we try to do at the Enterprise Ethereum Alliance, and that's why we go to those events. I think one of the thing I was talking to you before is I preach to my industry, which is like Web3, Ethereum in general. I say it's time to get off your bubble and to go and see the world. I think there is of course that at those values, you know, like the cyberpunk movement and everything, it's very important where it comes from, also fundamental research. But I think it's also very like important for us to start going and do like the normal sales cycle. Go on the floor and talk to those institutions, re-explain why do you need a blockchain? Go to some PSP that never heard about a wallet. I was last year, you know, at NASHA, ACH conference in $86 trillion is like SEPA of the United States in New Orleans. And I would go on the floor from booth to booth and ask, you know, like, how do you look at that technology from your perspective? And some people, they just like look at me saying, what, those scam stuff, those NFT, those whatever you can. But I feed out of that because I think it's super important, like those people that you talk to, and when you get to, after maybe 5 or 10 rejection, there is one that's going to be, interesting. Yeah. I would like to know more. And that's I think what we need to do more, like collectively.
Well, talking is one thing, but in Hollywood, they say show, don't tell. And lots of the folks in traditional finance have never seen a stable coin. You know, the people who are regulating, last week I saw a news item that the Deputy Governor of the Bank of England, Sarah Breeden, was talking about banning unhosted wallets. She's never seen an unhosted wallet. She doesn't have a wallet on her phone. So there's a fundamental experiential or empirical gap. The folks who we want to take on a journey, we have to show, don't tell. And I think we're very good at white papers and telling, and less good at show.
Well, speaking of showing, you like founding like Ubex about like 10 months ago or a year, right?
Incorporation 12 months ago.
12 months ago. You raised like some money recently. I think, I'm curious, can you tell us more about what stage you are right now?
Sure. So I had this realization that banks and fintechs would adopt wallets, and so the other key thing is what people were saying around that time in terms of the market structure of stablecoins was that stablecoins they have a power law that means there's only going to be a few issuers, and US dollar stablecoins were going to take over the world. I knew this was bullshit. I knew this was nonsense. I knew that the market structure for stablecoins would be many to many and pluralistic. So this is like, I knew it because every time in history when a new form factor of payments has come into being, that's how the market has developed. So if there was a time, let's say in the late 1960s, where there were only 2 credit cards, and they were American US dollar credit cards. Now, if Twitter existed then, everyone would be saying, oh my God, the world is going to be dominated by 2 or 3 or 4, and there's no space for anyone else. And how can we have more credit card issuers? Otherwise, there would be fragmentation. And how are we going to make these things interoperable? All this bullshit would be talked about the credit card market at that point in time. But if you fast forward to 2026, there are 16,000 issuers and no problem. And it's a pluralistic market structure. And every currency has its credit cards. And you took your credit card from New York, from JP Morgan, you spend it in the hotel here, no problem. The hotel doesn't give a damn about the issuer. So believe it or not, the market structure for tokenized money is going to be many to many. And what does that mean? Many issuers and many people who want to accept it. And this is the key insight about singleness of money. Singleness of money means the person who accepts an instrument doesn't give a damn about the issuer. When you take your JP Morgan credit card to pay the hotel bill, the hotel doesn't give a damn about the issuer.
True. They didn't give a damn.
So tokenized money will be a many-to-many network. We need to get to the place where the issuer doesn't matter to the receiver of the tokenized money. And that's the point at which they will become ubiquitous. That's the point at which tokenized money will take the entire payments TAM, the full $2.5 trillion of market opportunity. You know, people think that stablecoins are profitable at the moment because the big couple of players make $20 billion. You know, whoopie-doo, what's $20 billion compared to $2.5 trillion? So the place for us to drive the industry, everyone on the planet can use a self-hosted wallet, or a wallet provided by a bank, or a wallet provided by a fintech, or a wallet provided by an exchange. Those wallets connect into multiple blockchains. Then whatever token is the best is going to win. Stable coins, tokenized deposits, tokenized money market funds, other real-world assets, all. The beautiful thing about our world is that we have a general purpose technology where the tokens can represent whatever the hell someone wants them to represent. The adoption of that technology is a function of access to wallets. access to self-custody wallets at the moment is infinite, but there's a barrier from lots of people and businesses who don't want to use self-custody wallets. So when we bring the hundreds of millions of account relationships, the billions of account relationships into the wallet world, then tokens win and chains win. And by the way, it's not chain versus chain. There's plenty of room for lots of chains. The chains will find their own niches. So this makes it all the more ridiculous when 15 charismatic salespeople go into a bank saying my chain is the best chain. They're just pushing back adoption.
So I guess you said one thing, like we have.
Sorry, you were going to ask me about my company, but
yeah,
more interesting.
No, but the like the best stablecoin, and it's like I'm curious to know like what do you think is a good stablecoin? What is a good stablecoin and a bad stablecoin? And maybe also another point is, we have a lot of people that are building like cutting edge, DeFi product in here. And I would be curious to know like what would be your advice of like a mindset and framework if they want to address more institutions and banks,
right,
to, for their go-to-market.
The good stablecoin is the one which is accepted everywhere. So here's the thing. There's probably lots of stablecoin issuers, and they all think they're competing against the other issuers, and they can, except on acceptance. So the thing that needs to happen for issuers to be successful is they have to realize that there needs to be a mutualized acceptance network. Mutualized acceptance network. Now, let me give you some, Love, Circle, USDC, great. They've had to pay people to accept their coins. Coinbase, $900 million, Binance, $60 million. The crazy comparison is in the stablecoin world, the issuer pays for acceptance. In the credit card world, the accepting network pays the issuer. When you take your JP Morgan coin to the hotel, JP Morgan get paid 1.5%. They didn't pay the hotel to accept JP Morgan credit cards. They pay JP Morgan. So we need to move to a world where the issuers wake up and realize that we need to build a mutualized acceptance network. Now, in the history of payments, the alternative is this. So you have this thing called Circle Payments Network. In the best case, it's American Express. American Express is single issuer proprietary network. That's a one-to-many. Worst case, it's Diners Club. Diners Club was laughable because it was you could never guarantee it was going to be accepted because a single issuer can't build global acceptance. So the network that works, the network that hyperscales, is many-to-many. Any off-ramp can accept all tokens. And then you get you get quadratic scaling, you get telephone network-like scaling, and then tokenized money wins. So, eyes on the prize for the industry. The prize is the $2.5 trillion of revenue available in the payment space. The prize is reached when we have mutualized acceptance for our instruments. And it's very hard for an issuer to get their head around this. The issuer cannot matter to the recipient. The issuer matters to the sender. You chose JP Morgan credit card because it's given you certain attributes. So you care about the issuer. You're the holder of the token. But when you go to the hotel shouldn't give a damn about the issuer.
Yeah, well, right on time. I think, I don't know if we have time for a question. Do we? Okay. Well, thank you very much, Tony. But I guess if there is any question in the audience, we'll take any. And You see, you've been crystal clear. There is one over there.
Sure. What do you view as the biggest blockers to this mutualized acceptance network today?
One significant blocker is banks and regulated players have to figure out whether using a blockchain is an outsourcing from a regulatory perspective. You know, so if a bank wants to use Amazon Web Services, it sends Amazon something called a third-party risk management questionnaire, and Amazon have to get all the questions right, otherwise the bank won't use them. If I want to use Ethereum, where do I send the questionnaire? So the answer to that is regulators should make it clear that banks and fintechs are welcome to use public permission networks and don't have to apply those third-party risk management frameworks. If that blocker were removed, I believe we would see a huge wave of adoption. So for anyone who's involved in policy, this is a very important rock to crack. We have to make the argument that banks and fintechs can use public permissionless networks without treating them like an outsourcing.
That's a long education path. I was with a bank recently on a dinner, and we were discussing about the upgrade of Ethereum. And one of them well, you know, when there is the upgrade like Fusaka in December, well, like, how do we know that the $1 billion that we have here is still going to be here tomorrow? And I was like, well, you get the point. I never thought about this perspective because I know the whole process, how it's super thorough. I have friends in protocol development team, and I know that space. But then I took his position. I said, well, indeed, you know, how do you know? Do you have guarantee if you're a business that you deploy asset, do you have real money on that public infrastructure that when something happens is going to be present tomorrow? And I guess it's on us, the industry, to bring, you know, like some confidence in those institutions by education and more discussion. And I think going to them, explaining how it works and how like the counterparty risk is reduced and not increased. But it's also what is exciting about the ecosystem. It's completely novel. Never been something that public infrastructure like.
Can I tell you something also which the traditional finance has known for a long time that the blockchain industry hasn't yet figured out? In traditional finance, people clearly understand what's in the competitive domain and what's in the community domain. And I don't see that much evidence of that distinction being made in the blockchain domain, because there is clearly a point at which everyone can agree that we want to get to. All banks and fintechs have merged with Web3. That's the point that we want to get to. So there are strong elements of that which are a common endeavor. And knocking over this type of issue, like, let's win this, if we win this one argument, that is a major obstacle removed. That's something that the whole industry should rally around. Let's win this one argument. And let's think about the go-to-market, because the industry at the moment, has created a lot of heat and not a lot of light. Meet the customers where they are, take them on a journey, ask them things that they can say yes to in the short term.
Is there more? Or no? Oh, okay. Well, thank you very much. Thank you, Tony. It was a pleasure, as usual. And you can see us off stage if you have more questions.
Thank you.
Thank you to Red One and Tony. Next, we have a keynote by Token Bryce, CSO of Polaris, on flipping USDC, why decentralized stablecoins need a new collateral thesis. Welcome, Token Bryce, everyone.
Hello, hello. Glad to be here at StableSummit, like every year, never missing one in Cannes. So yeah, today I'm here to tell you about decentralized stablecoins through the lens of Polaris, trying to highlight how this is a critical problem for the space. And it's actually connecting pretty well to the previous topic. We're going to talk about counterparty risk, trust minimization, and a lot of other cool things. So yeah, I am involved in Polaris. We're building a decentralized stablecoin infrastructure, and we're going to be running you through the model today. But before we get to that, there is actually tons of progress being made in terms of realizing we have a problem. Because a few years ago, nobody really cared. Decentralized stablecoins were really niche, and even the higher ups, if we can call them like this, were not really taking the problem seriously enough. But recently, Vitalik started looking at the problem more seriously and essentially cornered the situation pretty well, where he summarized those three main issues that need solving in order to build a credible, decentralized, and scalable stablecoin. And so the three are essentially, first, the USD dominance, the dollar dominance. So right now, it's like 99% or something of the stablecoin are dollar pegged. You have a bit of maybe 5 billion circulating of gold-pegged stablecoin and 500 million of euro-pegged stablecoin for a grand total of $310 billion. So that gives you an idea of the proportion. Everything is a dwarf except dollar stablecoin. The second one is a big and long-going one for decentralized stablecoin, and it's the Oracle problem. There's several approaches that have been experimented with here and are pretty interesting. So Liquidity V1 has an Oracle switching logic. Protocol shipped like 5 years ago, so that was really good for back then. More recent protocols have interesting approaches, like FX protocol is using a medianizer, and that's a very credible way to approach the problem that is going to be harnessed in Polaris as well. But yeah, the Oracle point is a pretty technical one. We're not going to be focusing too much about this one today. The third one is also interesting, and it's a question of providing a competition to staking, right? Because essentially, if you use ETH as collateral, then you're in face of a bit of a dilemma. Either you accept the stake ETH as collateral so that your user have maximal yield, essentially. They don't have to forego the staking yield in order to use your protocol. But then you add a counterparty in your system, and that makes it a bit hard to build a trust minimized stablecoin with this assumption. Or you don't take staked ETH, Rocket ETH, whatever staked ETH variant, as collateral in your protocol, but then you have a situation where essentially a user will start by default thinking, okay, so if I put my ETH here, I'm foregoing my 2.67% that it is right now of staking yield into your protocol. And so how do you make up for that? So that's essentially your scope. And as always, I'm long, so I'm going to speed up a bit, sorry. So quick situation on the stablecoin. Essentially, USDC, everybody's pretty aware of it, super centralized stablecoin, no surprise here. Where there is a bit of surprise is maybe the counterparty risk. Everybody loves to forget about this one. On the USDC, we got an event 3-4 years ago to remind us about it, the SVB bank shortage. USDC was actually trading at 90 cents or something for a whole weekend. So people love to think, you know, USDC, USDT, they are super sturdy, they will never fail. Well, USDC himself just failed a few years ago and will fail again in the future because it has massive amount of counterparties. Some of those counterparties over a long enough time scale will eventually fail, and maybe the system will survive, maybe not. Maybe it will just be a temporary disturbance like we saw with SVB, but the risk is real and we cannot ignore it. There's been approach in the space to build more or less decentralized stablecoin with MakerDAO, now Sky. It started pretty clean with what we now call SAI, that was only ETH-backed, but essentially every update of DAI introduced more counterparty risk and degrades the collateral even more. So when they switched from SAI to DAI, they introduced a USDC dependency and a lot of other not so interesting things. And then when they switched to USDS from DAI, they introduced the possibility of having a blacklist and even more dirty collateral in terms of real-world assets and so on. And the new kid on the block, the USDE, is a basis trade stablecoin, or so most people think, because it did start like this, but it's essentially mostly, I like to call these a risk blank check stablecoin, because it started as a basis trade stablecoin, but as the basis trade compressed, it switched to essentially being a real-world asset wrapper, and most of the holders are not even aware of it. So their risk exposure evolved completely over a few weeks, and most of the users did not even realize when they used USDE, they signed a risk blank check. So what we're building at Polaris is a full infrastructure to address all of these issues. It's built over 3 tokens that are synergetic with one another and make the core system. So you have the PEs. We're going to go deep into this one. That's the focus of our presentation. But that's essentially the collateral of the system. The system is then able to output different kind of stablecoin. We will focus on PUSD for simplicity. And there is the Polar token, which is our stewardship token. So stewardship will also detail that. It's somehow a bit like governance, but quite different because our system is immutable and massively constrained. So the governance, which is called stewardship, cannot change as many things as it can on a DAI, and you cannot have an update that transforms the system completely like we've seen on Maker. So this is probably the most important part to understand. The key innovation we found to be able to use ETH as a collateral in the system, have a yield that is competitive with the staking yield, and at the same time have an interesting asset in terms of what we can do with it for the CDP system, is using a bonding curve that you can see on screen. So essentially, users are coming in with the ETH, they are swapping against this bonding curve, and they're getting PEs. The PEs is then the asset that is used as collateral in the system, and as we envision it, to be used more broadly into DeFi. This has a lot of advantages, especially even compared to a stake system, because the bonding curve acts as a permanent, always available liquidity provider. So essentially, the liquidity available on the PEs grows as the system grows, and there is no question of what if the liquidity provider don't provide liquidity anymore, or withdrawing queue like you can have on the stakees. One of the most interesting mechanisms with this PEs is how it's designed with forever rising flow against ETH itself. And there is 2 main mechanisms to feed this flow rising mechanism. So the first one is pretty straightforward. Every swap made against the bonding curve is charged a fee, and this fee is used to raise the flow up. So over time, as there is activity on that bonding curve, the flow simply goes up through this first mechanism. The second one is a pretty novel mechanism on the Polar token itself. So essentially, the only way to bring Polar token into existence is to burn PEs, which pushes the price up. And it's an elegant way to connect Polar to the whole system, because essentially the Polar token are brought into existence by performing the most synergetic action possible to the whole ecosystem. In terms of, I was telling you about PEs is used as collateral in the CDP, but it goes beyond it. We see a life for PEs in DeFi because it's a product with competitive yield on ETH, with different risk and compromises than a stake is. And so it makes for an attractive hold for any ETH bull, essentially. And this table recaps to you the main difference, but they're mostly in terms of the liquidity, because on stake ETH, you do have liquidity on Curve and other exchange on the wrap stake ETH, but you're at the mercy of liquidity provider, which can withdraw their liquidity if a crisis happens, and then you're left with the exit queue that have a delay and other constraints. On PEs, you're swapping against the bonding curve, and you have a predictable capacity in how much you can swap. The exposure itself is also different because PEC is not involved in validating the network in any way, so you don't have all the risk associated with that. So to go back to Vitalik's first point, because we go beyond the dollar with Polaris, we are putting a whole infrastructure to output any kind of stable, and we're going to build ourselves, the Polaris team, the PUSD and the P-Gold, but we're going to make the model, the CDP model, available to any relevant team to use and harness to output, for instance, PCHF or P-Euros, or the one we like to use as a joke, but could happen probably is the P-Big Mac tracking the Big Mac index. Those are essentially synthetic assets. The infrastructure is able to handle any kind of debt asset as long as there is an oracle providing the price for it on chain. The infrastructure is flexible enough to even support negative interest rate. That's why we are envisioning a PCHF or a P-Gold, simply because the borrowers are incentivized. And so depending on the specificities of each asset, you might have negative borrowing rate. And just quickly on the stables themselves, because this is also one of the key innovations of Polaris in how they stabilize, and it's enabled by the bonding curve. So essentially on the stablecoin, you have both a redemption mechanism, similar to what you could have in a liquidity V1 or V2, but with its specificities, but a completely novel mechanism, which is the minting, and it's essentially the inverse of a redemption. So if the stablecoin is to be overpegged at some point, an arbitrager can trigger this minting function, and it will mint stablecoin against existing position in the system that can then be sold in the market to restore the price to its peg. The novelty of this is now that we have essentially on-chain arbitrage action happening when the coin is under peg, that's a redemption, or over peg, that's a minting. So the volume of those two activities can be used as a signal to achieve something that the whole space have been stumbling ahead against for years and never really succeeding, which is fully autonomous, market-driven interest rate. So on this slide, I give you some overview of how it works for other systems, but all the stablecoin systems either have manually defined interest rate by governance or very constrained user-defined interest rate on liquidity V2 or other kind of constraint. They're not able to dynamically adjust to the market conditions like we can see on this Polaris model. It's essentially a way to have an idea of the price of PUSD in the system without using an oracle. Do I have a bit more time to wrap up? Yeah? Okay. Just quickly, because this is also an important point, the vision we have for Polaris is we want to have a system where there are the strongest guarantees offered to the users. So we were talking about the DAI, USDS example, where the system essentially degraded over time through the various updates, and the risk increased massively. It completely changed of nature from 5 years ago to what it is now. So stewardship is essentially one answer to address that. The core of the system is immutable with parameters that can evolve within hard-coded range, and the periphery of the system has a bit more flexibility. And the stewards, the holders of Polar token, are the ones who can govern those parameters. So they are essentially here to help the system fine-tune its parameterization to adjust to long-term trends, but the system itself self-stabilizes, and the stewards are, as the name will suggest, more stewards in terms of deciding which type of partners to onboard into the ecosystems, and decisions like this that really requires a human touch, but the key core system function, like the interest rate decision, are fully automated. So yeah, that's the core for Polaris, and I think you'll understand why it matters. It's a key time for tackling this problem, because again, now the space is dominated with centralized stablecoin, all the risks that comes with it, seizing of assets, freezing of assets, sometimes even illegitimate freezing of assets. Imagine if you wake up one morning and your 5,000 USDC are frozen by mistake, by Circle. Do you see yourself going after Circle and arguing your case so you get your assets unfrozen? I want to say good luck if that's your situation, because it's probably a tough fight. There are other concerns as well. We see issuer launching layer 1. the plasma chain, and so on for tethers. And so Polaris is an answer of a lot of problems at once. It's essentially a massive ETH sink. It captures tons of ETH. It will capture tons of ETH into the bonding curve and use them as collateral to output trustless stable, starting with PUSD and PGold, but essentially offering an infrastructure that anyone can harness to deliver stablecoin adapted to their local situation. So if we have people here that are very keen on having a resilient counterparty free euro stablecoin, they could harness the infrastructure to do so. Thank you all for your time. I don't know if I have time for questions. No, I overlapped too much already, I'm sorry. You have QR code here you can scan for more info on Polaris, or the Telegram channel for announcement. And me and Lawrence right there, we are at the conference StableSummit for the next 2 days, so you can catch us up. We'll be at ECC as well, so if you have more questions, just run into us. I'm pretty easy to spot. Thank you for your time. Have a good day.
Okay, now our next panel is going to be about FX market structure and on-chain design. It'll be moderated by Tessa Ho from Flashbots, with our speakers, Ivy Schumacher from Deutsche Bank, Martin Krung from Curve, and Danny Kwok from Mento Labs. Welcome our speakers, everyone.
Hi.
Am I in the right spot? I'm in the right spot, okay. Hey everyone. Okay, who has made a stablecoin transfer? Raise your hand. Everybody on this panel should be raising their hand. Okay, maybe not you, Ivy. Who has made an FX swap or transfer? Raise your hand. Oh, this is pretty good. You know, small sample size, but still good. I'm Tessa. I'm the head of market research at Flashbots. We have a great panel today. Just to give you a heads up, $9 billion worth of FX stablecoins are traded annually, and we're going to compare that to the $9 trillion FX that trades off-chain. So this is a great market. We're going to get into it. My panelists, please introduce yourself and your company.
Hi, everyone. Happy to be here. Ivy Schumacher. I'm from the digital assets and currencies team at Deutsche Bank.
Hi, I'm Martin. I'm doing BD for Curve. I have original tech background, and I'm sitting here because we have something called FX Swap, who is doing well for FX.
Hey, everyone. Danny Kwok. I'm from Mento Labs. I lead product here. FX stablecoin platform enabling what we're talking about today. Yeah, I build all things product here.
Cool. We're going to deep dive into, I think, FX market structure at first. So we'll start with Denny. Denny, with Mento, you use a hybrid model for your stability. Do you want to kind of briefly describe what Mento does differently and the stability mechanism that you have in place for your major FX pairs?
Yeah, awesome. For those of you that don't know Mento and what it does, we're a stablecoin platform. We have, similar to what Polaris talked about earlier, we issue decentralized stablecoins backed by USDC, USDT, and other prime stablecoin assets, fiat stablecoin assets. And what we have is this novel mechanism called FPMMs, fixed price market makers, which leverages Oracle price. So instead of doing price discovery on chain, we bring the 9.5 trillion FX market from TradFi on-chain and bring that rate so that you could swap with no slippage. There is still this dichotomy of what happens when traditional FX markets close. So the FX markets, for those of you who don't know, are open 24/5. So basically from like London to Japan to Sydney to New York, etc. What we do is we flip to a hybrid AMM model over the weekends, and we have circuit breakers to ensure that like trades go through and that there's no losses for LPs and things like that. So what we've really done is, instead of having price discovery on chain, what we do is we enable we bring prices on chain, and that allows you to swap, for example, a BRL for a JPY at the given FX rate, or we're in Europe, so 1.15-ish plus or minus euros for USD at any given time, with no slippage and not relying on market makers and arbitraging to bring what we all know is like Uniswap or other AMM models, Curve AMM models. So it's just a different approach. There's pros and cons to each, so yeah.
Martin, you're part of the Curve OG concentrated liquidity pools for stablecoins. How have you modified what Curve has done for FX stablecoins?
Yeah, so the initial, I would say, our founder invented StableSwap, but even at this time, FX was some kind of dream or target market, basically, and then we had like a CryptoSwap, who is for non-correlated asset, who worked pretty well, but we made recently an iteration on this, and we call it FX Swap, and yeah, we are like all in, basically one of the reasons we are in the camp of have auto-managed liquidity, basically, so the system is basically rebalancing itself on the spot where the trading is happening, and it's a very good solution for low volatile asset, basically, also for real world asset, but also for FX, and because FX is now, yeah, we see more and more non-US dollar stablecoin coming to the market, basically that's the first market we want to move into, basically. And yeah, I think we are in the, yeah, it should be auto-managed, basically. We see system where asset issuer has to manage or liquidity provider has to manage the system themselves, and I don't think that's the future. It has to be simple and reliable, and yeah.
Cool. Ivy, you're from the banking world. Deutsche Bank is one of the largest FX currency, I think, banks. What needs to happen, I think, for the banking side to actually come on chain? Like, what is missing in the FX market structure on chain today?
Yeah, I think I start with maybe the positive side. What we already see, like there's a like a tech side, there's a solutions, which is, let's say, think about the FX transaction life cycle, then the price discovery. Let's say it's for especially like major currency pairs, it's easy, let's say, to quote or import a quote from the off-chain market, right? Because it's a fair rate. And also we can also regarding the AMM solution, it's quite stable, right? And the question is really when we move into more emerging markets. And also under stress situations, then it gets trickier. And to your question, I think bank in the traditional FX transactions, right, as a, let's say, a liquidity provider, we don't just quote rates, right? There's two key topics I think we are still dominant, to be honest. One is the liquidity provision. It's our balance sheet that how we kind of either through internalization or through certain hedge strategies, we basically transfer that risk from the clients and to our balance sheet, and we do have the capability like to absorb, right, especially for largest institutional tickets. So this is one thing. And second thing is, I think there's these controls, right? So all types of execution controls. I think Tony just mentioned in the previous session to say what happened. So we need to know our counterparties, who we are trading with. What if tomorrow they are gone, right? What if I cannot trade as the supposed to be kind of rate, right? Because of the DPAC risk, because of the illiquidity and so on. So I think this is where we do a lot of validity check, we do credibility check, so that to ensure really, from a last look perspective, that we are offering a firm and executable quote that will take place, right? This is a kind of certainty kind of from a bank as a liquidity provider perspective we can offer.
And this is for a group question. Right now, you're seeing major stablecoin FX pairs. For emerging market FX pairs, how do you anticipate bootstrapping liquidity in those markets? Or what have you seen? Or maybe for you, Ivy, what normally happens in TradFi for emerging market?
Do you want to go first?
Yeah. It's just interesting. What I see is like for the very deep liquidity, big pairs with low volatility, on-chain is not really competitive right now, but what we see, or we have pools with more like second quality currencies basically, and they have product market fit in the sense that they bring the flow themselves. So it's more like emerging market because it looks like people have much more need or are willing to transact on-chain because some of them also have like the hedge back into USD basically. So, and these pools have quite a good traction, and the dirty secret of this is because it's more, sometimes it's not a mainnet, so it's not competitive. So basically they're the only venue who this token can be traded, and then you don't have to set the fee very low. So basically you can set the fee where you make some revenues on the capital. So it's like, I think the more competitive it gets, mainnet or also other chains who have like a deep liquidity of different non-US dollar coins, then there's almost no money in this market basically. But if you go more out to more like, not exotic, but other currencies, then it's a different landscape. And I think some of the push will coming more from this side basically and less from the institutional side, on-chain side.
I think that's a very good point. Looking at the major pairs, so like Euro, GBP, JPY, so on and so forth, on-chain liquidity just can't compete with fiat liquidity. There's literally trillions, which is like exponentially more than the Bitcoin market. I think the way I would look at like on-chain utility for those pairs is that you can do certain things that you can't do in TradFi markets. So you can settle on weekends. You can actually use, Circle has this like instant redemption rail where you pay a little fee, but it's still like cheaper for you to get into fiat instantly through stablecoins as opposed to like through the international wire system. So you can send money from like Europe to Japan much more seamlessly, although it's capped by the liquidity limits, obviously. I'll touch on the FX stuff, but I want to give Ivy a chance to, or the emerging market stuff. I wanted to give Ivy a chance to.
Right, I think we covered like different models, right? I think there's one maybe I can add to is, traditionally we have this RFQ or RFS kind of style, basically dealer-based, right? So we, for example, as a bank, we can be one of the dealers, but then you also have other, let's say, regulated and non-regulated financial institutions and so on. I think this is probably something, it might be a solution, let's say, for emerging markets, because it's, let's say, what happened there is really, there's a capital control as example, right? So basically you cannot, you actually don't know what's a fair rate there. And most of the cases, as mentioned, you might have a big dealer there already internalize the flow. So actually not every flow is pushed to the pool. So even if you have the access, that whatever the rate you access is not really the fair one. So I think this, let's say, this dealer approach is similar to what the TradFi currently is, applying. And if you're a little bit like a positive, like solution-oriented thinking, I think this, I think we all appreciate like the smart contracts based flows and also leverage stablecoin in terms of post-trade. But for the pre-trade piece, we can think about near-term, maybe some hybrid approach, right? So in terms, especially for certain stress scenario or emerging market, you know, I do feel like this RFQ and RF, as at least short-term, it can be a really attractive offer or alternative. Yeah.
I think that's super interesting and super compelling because I think we oftentimes live in this world where it's, you know, binary, where it's like one way or the other way, like on-chain or TradFi or whatnot. I think the RFQ model is really, really important, and I see there's this like hybrid approach as we kind of like develop these markets where the blockchain kind of becomes like the settlement layer, but like liquidity can come from anywhere, and if like firms like DB or other firms kind of plug into these systems, it really enables like a lot more things to happen and a lot better capital efficiency, and it just becomes kind of like a settlement layer where things happen, and there's this like trusted layer that sits under all the liquidity from whatever source it is.
Yeah, exactly. And just also to add, it's not just a capital, right? It's also, especially for emerging markets, there's also about expertise, right? You have certain scenarios that you really need such a manual intervene. I completely agree. I really appreciate all types of, I think bank perspective, we really appreciate all types of automation, where you're kind of in the era of automation and blockchain. But just but we need to think about whether we can build in such like controls, you know, like manual override capabilities, right? Instead of let's, yes?
Okay, that's yeah, challenging.
So on that topic, what happens during volatile events? Martin, what happens to Curve? Like, how does Curve's internal oracle protect LPs during volatile events?
Yeah, that's interesting because if you're a DeFi, on-chain guy, it's different. And one of the models we see with the tick-based model, basically Uniswap V3 and many copies of it, the issue there is you own liquidity or somebody owns liquidity. You set your ticks where the trading is basically. And every time there's volatility, the price moves out of the range. So basically trading stops, and that's worst case basically. So this means the market just disappears. And the reason is also, even if you're like decent, assume that you are a liquidity provider who wants to basically guarantee liquidity all the time, you have to withdraw, you have to reset to some range, and at this point, you also lock in loss basically. So it's always a decision. Maybe you think, yeah, the market's coming back tomorrow to the same price, so I just stay out. It's not that our system, Curve system, it's not that you also can go out of the market anytime, basically. But because you don't have to manage it, so the liquidity is unified, so all liquidity of all the participants basically is treated the same, and is also shifted the same way, automatically. So basically, what we do, and we also do this in backtesting, we backtest 5 years volatility, and then we see that basically in this condition, it should be, if you assume the future will have the same volatility, it will always be in the best tradable range, basically. And yeah, our system is not disappearing in these adverse scenarios. And we did see this in many, on the USDC, DPEG, basically, Curve then basically is a secondary market for on-chain liquidity because sometimes it's the only venue where it still gets traded assets. Even possibility, people could also withdraw the liquidity and not expose them to this kind of risk, but you also make a lot of money in these markets now because then, yeah, there are a lot of trades, so you make a lot of fees. So I think because our system is more passive, it allows you to, you don't even have to manage it yourself. So of course you can monitor it and then go out of the market, but that's not what we're seeing basically. So we are more resilient by design basically because the friction to disappear is like higher than to stay in basically.
Denny, do you have any sort of features that in your FPMMs for high volatility situations?
Yeah, so we actually take kind of a different approach to a lot of what on-chain builders take. We actually take a more similar approach to like TradFi and equity markets. We isolate each of our pairs and we kind of have like a quantitative circuit breaker set to each one, similar to really highly volatile times in equity markets, where trading halts. But for us, we see this as a feature, not a bug, because in those times, each of those pairs are isolated. And one of the things we've seen in DeFi happen a lot is, especially because we rely on oracles so deeply, we've seen like Oracle attacks, we've seen Oracle failures like completely drain LPs. So this is a feature to actually protect LPs under the hood until kind of these circuit breakers are lifted. So yeah, it's a slightly different approach to most of DeFi, but we really see it as like another mechanism to protect LPs. During several of the kind of black swan events over the last several years, we've been able to maintain our peg and come out without any losses for our LPs. So yeah, we're pretty proud of that.
Ivy, since the banks are mainly, I guess, prop trading on FX swaps, what are, I guess, the legal, credit, and capital conditions that need to be in place for you to feel comfortable to be able to scale your FX business on chain?
Right, so we talked about the liquidity provision, and now it comes a little bit like dry legal side, which is very important for, as a regulated financial institutions. I think firstly, legal certainty, as you mentioned, right? So I think for, let's say if our clients is a large corporates, right, they need to really understand, okay, if I have a dispute, if in case of insolvency of my counterparty, so which law is governing this transaction, right? And I think in general, there are some development from regulatory side, right? I think English law is generally very open, like they do allow like embedded, let's say, smart contract, in their law, and also ISDA is working on some, let's say, tokenized collateral framework, yeah. But again, this is just, we only see like silos, right, currently in terms of the reg development. It's one jurisdiction. If we're talking about FX, cross-border transactions, you actually need to really align the standards, and it's really about in all the relevant jurisdictions, right? And I think you mentioned also capital requirements, right? Because this is probably more like a bank perspective, because whatever the role we are playing in the future ecosystem, right? Whether we are issuing, let's say, stablecoin ourselves, so it's on our balance sheet, or we just like, let's say, pass through. So for example, we offer some like wallet infrastructure and so on. It's a client stablecoin and so on. It's gonna somehow land in our book or pass by, right? And the regulator, from the prudential requirement perspective, they are very strict, right? They say, okay, what kind of tokenized money are we talking about right now? Is it a regulated stablecoin? Then we probably categorize them, let's say, under Basel currently as 1B, right? Then we don't have a very harsh, let's say, capital treatment, right, for us, like in terms of, the buffer and so on. But if, let's say, certain criteria is not fulfilled, right? For example, redemption, standards is not there, or there's no strong governance of the issuer side, right? So then they might end up at a very like unregulated stablecoin category. Then we are really talking about like a huge capital like buffer that we have to reserve for such a product, right? So this is something like, it's not a showstopper, but it's something like we definitely want to look into before we just like say, yes, we are on, we want to bring everything on chain and so on.
And then this question is for the group. If you wanted to trade, I guess, in emerging market currencies, you have a very wide spread in just natural TradFi. How have you seen on-chain kind of minimize this spread? And like what sort of ways, or like what is the mechanism that has kind of decreased the spread that you've seen?
I can take that. This is actually like the killer use case for Mento and Mento's platform. Looking at the major currency pairs, it's really hard to compete with what a lot of like the TradFi firms offer their like enterprise clients. But for end users, and what we're really trying to build is like democratize access to these markets. Because we take an aggregated rate from the global FX pool, we're actually able to offer a very, very tight spread on a lot of these emerging market pairs. So We have several African currencies. We have several Latin American currencies where we're able to offer it at pretty much like the best rate you can get from an enterprise client of like a Deutsche Bank or any of the GSIB banks. If you look at like one use case, just to like put this into perspective, like I'm from California. A lot of folks send money back to like Mexico, back to their family or friends. Remittances, that's a tighter corridor, but remittances to some more emerging markets can be up to like 6 or 7% to pay. And there will be fees on platform side on crypto applications or DeFi applications or fintech applications, but we can get that down tenfold easily. We have a partner in Opera, the browser company. They have a wallet called MiniPay, and they've basically enabled this through like P2P transfers with stablecoins in 60 markets globally. So and they have like 10 million users on that wallet. So we really feel like that is one of the killer use cases, in addition to kind of like B2B and enterprise flow as well. But I think it really hits home when you see like the spreads that, or the money that you can save from spreads for like an everyday person.
I would also, that's also the argument basically, because if you send money on a traditional raise, you have to pay much more fee on other places, so the spread is not your main concern at this moment, I guess, if this is the use case basically. And what I see, but this is more like in general, the difference between TradFi and DeFi, on FX, if you have asked for higher quote, you get a smaller spread. But on-chain, in a way, it's different. The higher the trade size, the higher the slippage and the spread. And I think there's also need some learning experience. I guess if TradFi wants to adopt DeFi, they need to DCI and basically hope to either DCA over time and then hedge the position, however you do that, or you just have a different mindset, because otherwise you always, that's a little bit the question we got many times. This is the trade size, and trade size is high, and then the slippage is so high, and it's like, why are you doing this? Because it doesn't make sense. You should basically trade over, 30 minutes, and basically hope that that the pool is good arbitrage, and the price basically, you get the mid price over the next 30 minutes, and not just trade in one go, basically.
Which brings me to Ivy. Ivy, what sort of features or what needs to happen to bring TradFi to DeFi? What sort of design mechanisms or features do you need?
Right. Just to comment shortly on the spread part, right? Because that's one of our, let's say, revenue like model, right? We as the like a liquidity provider, we earn from the spread and so on. But I don't disagree, right? For certain markets, let's say the major currency pairs, we do see advantage, especially from user perspective, that might be really a fee perspective advantage, right? So like on-chain, it's less spread. However, if you're talking really about the institutional use case, right, with a large ticket, because that spread with the bank as a liquidity provider, they offer, that considers really the ticket size, and especially also whether the market's liquid, so for emerging markets, and the current situation, right? We do believe most of the TradFi, let's say FXs, they're actually bilateral, right? It's very discrete, I would say. And under that kind of setup, the client actually gets a certain quote and gets a really good spread offer. So why? Because it's a lot of things they are internalized. They are not really about like open to the entire market to say let's just exposed to the volatility, like it depends really on how deep the liquidity pool is and so on. So it's again like really leveraging our network, leveraging the whole, let's say the balance sheet, right? So we internalize it, we hedge it and so on. So this is why I don't disagree, but for some markets I do feel we have advantage in terms of, this offer. Maybe, I think we covered quite several points, right? Both from liquidity provision, controls, and also legal perspective. Maybe just to call out to say, when we talk about bringing, let's say, FX flows on chain, the solutions might be really vary depending on use cases and also on regions, right? For example, in Europe, we have SEPA instant. So then if you talk about within Europe, you make a transaction, then the question is it really beneficial, let's say, to leverage stablecoin? Because we do have other, alternatives, right? And also, let's say there are also from central bank and also BIS, I think there's a project Agora, and the ECB, there's also like a lot of pilots about the wholesale central bank money, right? So these are all like, let's say, tokenized money formats that from institutional perspective, we can consider as alternatives. So it's really depend, and they all have, compared to, let's say, stablecoins, both pros and cons, right? So it's in the end really about which use case are we talking about, which corridors, and which rail that will make really most sense, for both the clients and the bank perspective.
Look, I think we'd be kidding ourselves if we said we have FX solved on chain. It's still really, really early. And I think like trading is one use case, but I think like I want to put this as like a call to action to all like the builders and partners out there. Like this really only works if we can build kind of a network of different endpoints where, the blockchain is kind of the central node, but if you're talking about remittances, if you're talking about cross-border payments, if you're talking about international payroll and all these things, this really only works if you can get good partners in each jurisdiction, because regulation is really tough in each jurisdiction. There's no one platform or no one like company or protocol that's going to solve all of that. I don't think a protocol literally can solve that because of like regulatory issues. So I want to say it's like really, really early for this, and network effects compound, and it's really only going to get more efficient and better as like more partners, that TradFi firms that look into it, on and off ramp providers. We're in Europe, like we really need SEPA rails to get like a Euro stablecoin to be really like effective and have utility.
So what do you think the biggest pain point is for, say, Mento specifically in each of your respective projects or businesses?
Yeah, just like really quickly, I think for Mento, we're an infrastructure player. We really rely on like partners. Like MiniPay is a great partner. They have enabled us to access like all these rails in Africa, which are really tough for a lot of people. If you look at the most used stablecoin in Africa, USDT, I think by all measures, how do people access that today? It's Binance pretty much, I think. Someone can prove me wrong, but I'm pretty sure that's still the case. MiniPay has built out like, what is it called, mobile money wallets, integrations with specific rails in like Kenya, Nigeria, South Africa, et cetera, et cetera. Until we see that type of integrations through like every other part of the world, like infrastructure players can only do so much.
Martin, what's been your bottleneck or pain point?
Yeah, not enough non-US still stablecoins, basically. It's a little bit true, because we have been waiting for them like since ever, and every time it's like, yeah, they will arrive now, but yeah, we see there's some growth now, so I guess we are over this, basically. And yeah, we in a way, we are more like an infrastructure for others to use. So many problems we don't have to fix, basically, so others have to fix it, asset issuers. And we are more like, we are like a deep tech company who have good solutions, and we like offer this to everyone, basically, because we are open system, and we are protocol. So basically, many things we don't have. So we don't care about regulation, AML, all this kind of TradFi things, which is a good place to be. But we also need like people building on top of us, and many do this in different things. So. Yeah, I guess it's how to scale this, basically. That's for everyone, yeah, the same question.
Yeah, I would really push a little bit more like collaboration kind of way. So yeah, of course we worry about regulations, right? Not just worry, just because we are kind of in between, right? It's a relationship we're offering to our, let's say, corporate clients as an example, right? It's not, we cannot say it's your risk, it's your decision to use the coin on chain, everything. Then we just facilitate. It's not, it's a really long-term relationship. And also, we are a regulated financial institution. That's why we do care about regulation, right? So I just want to make a point on one thing about transparency. I do see that on that front, there was a really good virtually collaboration between like the tech team and also traditional TriFi, right? Because I think a couple of years ago, we were talking about moving TriFi for even some sort of pilot, let's say, like an on-chain exercise. We would definitely say that has to be permissioned chain, right? It has to be closed. And we just don't want to expose to risk and so on. But then because of the privacy concerns, the confidentiality, particularly for the pre-trade, right? Because otherwise it would be really counterproductive, and then you have the upside kind of market move and so on. And for the last couple of years, and there's a lot of like tech development, right? So for example, ZKP, it started to solve the privacy issue, and you do see like a lot of tech providers, they try to install, let's say, really bespoke compliance or like a control stack on the permissionless chain, right? So this is something like, I think we are open. In the end, it's really about, let's tick the box. Does it really offer what our clients and we ourselves also as a client are looking for? And then this is something that we do believe there is a potential.
Yeah, just to add something to transparency. Yeah, I think DeFi is very much built on transparency, and it's a good thing in a sense, because if there's like the resolve issue, you see in like a day, basically it's visible who is exposed to what, basically. And yeah, I'm just saying, as a DeFi guy, on-chain guy, as soon as we start taking away this transparency, we basically lose also part of the potential of this. So it's like, we as an industry, or the DeFi builders, we need to solve part of this, maybe at some point, but it also has like huge side effects, which basically is damaging part of the value proposition we have, basically.
Yeah, agreed. I'm not saying taken away.
No, it's not. I don't say it's not a moral judgment. It's just a fact, basically. I don't know if DeFi works well with privacy built in. I have high doubt. I guess we will lose, part of the value proposition. So basically, it's just more like this.
Yeah, I think transparency is very, very helpful, right, for post-trade. Let's just pick this FX transaction as an example. For post-trade, it's great. It really enforces, let's say, traceability, auditability, right? This is what we want, basically. But for the pre-trade, it's really, especially for large ticket, think about like a big corporate, they want 500 million pay a hedge US dollar, and then everyone knows there's a move, and then they're gonna react, right? And that's,
Like these outsized oil positions in the last couple of weeks.
Okay, we're down to a minute. I want to open it up to the audience. Does anybody have any questions for our panelists? None? Panelists, do you have any questions for the panelists?
I have a question for Martin, because I want to circle back to the point you made around needing more stablecoin issuers and more liquidity around that. Like, how do we grow? Over the last year, I think I've seen like a lot of really good teams in many jurisdictions issue stables. How do we grow adoption and liquidity as like a ecosystem and as like protocols? I think about this a lot.
I don't know. It's a hard question. As a protocol, you mean? Oh.
Yeah, just like as like we're both like infrastructure layer. We provide like a service to these guys. I think one of the things that they've struggled with is getting adoption, getting liquidity. Like there are no USDC, USDT, right? With like billions of dollars in circulation.
Yeah, I mean, we as a protocol, we can't manage the demand side in a sense. We don't see the market. We are not like, we are like, they have clients and they need basically to find, product market fit basically. So for us, it's hard as a protocol. We can give them good technology and they can use it, but at the end, we are just like, infrastructure, it also means the user should not see that we are used basically in the back end. They just should get a good service basically. Yeah. So it's like, we should disappear at the end. That's the goal basically.
Yeah, same here. We've issued decentralized stablecoins as a means to an end, but I think like my future vision is that, there's fiat, deeply liquid fiat issuers in every corridor in the world.
Well, thank you guys. Thank you, panelists. This is a great conversation. If you want to discuss more with them, I'm going to push them out to the side or somewhere else, and then you can chat with them. But thank you.
Thank you.
Thank you.
Thank you.
Okay, and our next and final panel before the pitch hour begins, it will be about deploying capital across stablecoin and on-chain finance infra. It will be moderated by Peter from Namu Capital, with our speakers Celine from BPI France and Daniele Pina from Gnosis VC. Unfortunately, Connor is stuck in Paris, and so he is unable to join us for the panel this time, but he is still making his way down to the event. He'll be here all day tomorrow if you still want to meet and network with him. But yeah, we'll go ahead with the panel with Peter, Celine, and Daniele.
So, hi everybody. Welcome to the last panel of today, deploying capital across stablecoin and on-chain finance infra. I will have these two amazing panelists joining me today, but before that, I just briefly introduce myself. I'm Petr Hluze from Namu Capital. GP there, we focus on early stage projects across stablecoin infrastructure and projects. Okay, guys, can you just briefly introduce yourself before I frame the panel and we jump into questions?
Of course, happy to. Thank you. Hello, everyone. I'm Céline Sontay. I work as a venture manager at BPI France. BPI France is the French sovereign fund. They have 72 billion assets under management, and 300 million of it is over blockchain and crypto.
Hi, I'm Daniele Pina. I'm an investment partner at Gnosis VC. We invest across three-stack vertical of involving decentralized infrastructure, real-world asset issuance, and we call it payments middleware, which kind of captures everything between payments rails, on-ramps, off-ramps, heavily focused on emerging markets.
Okay, perfect. And just to frame the panel a little bit in the beginning, I think both of you, but everybody in the room also, is well aware of that last year was quite clear proof that stablecoins and on-chain finance is here to stay. And I mean, we saw 35 trillion in transactions and stablecoins. We saw, I think, over 1 billion into investments into stablecoin projects, regulatory clarity increasing for sure, enterprise is going into the ecosystem as well. So that's clear. What's maybe less clear is where the value is going to accrue, or is accruing at the moment, and when it's going to accrue in the future. And that's something we will try unpack here together. So we'll talk about yield, we talk about stablecoin stack, and about regulatory allocation, and which is influencing everything basically. Okay, so let's start with that value accrual and stablecoin stack. So for me, because I'm investing also, it's quite clear that for now the value is accrued heavily into still into issuer side, but it's slowly changing. Middleware, orchestration layer, applications, it's capturing more and more. And so my question on you guys, it's where do you deploy capital now? What do you avoid, and is it going to change in the future?
Yeah, I mean, I'll go first. So the yield sources, I mean, are quite heterogeneous on chain. Although the last year has clearly shown that TradFi yield origination is growing incredibly fast, just purely by virtue of the stablecoin market becoming bigger and bigger and bigger. To answer your question, where should the money be deployed? It should be, I mean, who can capture that flow? Because even though the yield is being generated off-chain, I would argue in the real world where humans live, where the economy lives, and where credit lines are originated in partnerships and business dealings. However, the distribution of this yield does get on-chain, where products can be packaged very dynamically and permissionlessly. Obviously, yeah, we can add the whole layer of smart contract risk, but let's ignore that for a second. That's not the scope of this panel. So I would say I would invest in whoever can capture these flows as they trickle on chain and get repackaged.
Okay, makes sense. Yes, Salim.
We are a very specific investor, I would say, being state-owned and public. Our mandate is obviously a big. Yeah. So on the issuance, we've looked a lot internally also. At the time, there were works around us launching our own stable. However, as you know, as a bank, we are regulated by the ECB, and the work has been fortunately taken by the ECB as well. So we have stopped, but still very convinced that this is the path to go. And today, as you say, we see issuers everywhere. In France, however, in the market of issuance per se, the reference today still remains Société Générale Forge, who has been upfront into the issuance landscape. But obviously, we haven't invested in Société Générale. It's just a good partner we have. However, I would say that there are different theses that we've taken. But it hasn't been only focused on, infrastructure or orchestration. Of course, it has been covered, but we have had investment from Ledger, so very B2C hardware, to async, Lightning Bitcoin. I mean, we have had different type of investment, and it has been in the infrastructure, orchestration, and all the other layers as well.
Okay, what about the application layer? Is it something you're looking at or not yet?
Today we are obviously looking at the solution that already, I would say, embed stablecoin in their own infrastructure. That's for sure. There is, I would say, still a maximum exposure into what is infrastructure. Mostly because also it's linked to the fact that on the ground we have a lot of tech schools that are like showing a lot of great tech talent as well. So infra has been a forte in France for long, and it has been reflected on our portfolio as well.
Okay, clear. And just maybe a quick question on your mandate, because I know that it's influenced by the bank origins, and also that the fact it's French, like sovereign fund. So can you invest outside of Europe as well, or just within Europe, or it needs to be some element of French founder?
Yeah, so being state-owned, obviously we have a mandate to support first France. That means that every startups that comes to us has to have a link to France, whether the founder nationalities, whether it's center of activities, biggest clients, it has to have a certain substance, I would say, in France, but this is given to interpretation. Obviously, it's a case-by-case kind of analysis.
Sometimes it can be more loose.
Of course,
very lucrative.
Yeah, and we are a VC, but we are also LP. And on our LP side, we have no borders, I would say. It's mostly on the VC side, and when investing in startup, this thesis around France is obviously more pushed. Yeah.
Okay, clear. So of course that this value capture, like not just crypto and Web3 projects notice or players notice, and we see massive investments from TradFi and fintechs. Last year, Stripe. This year, MasterCard buying BVNK, and Revolut making a lot of waves as well, and everybody's like flowing capital into it. So my question to Daniel is also to Selin later is, in your portfolio, are you noticing, or are you a bit afraid of this competitive play? You know, the fintechs maybe taking part of the pie of your investments.
Yeah. So. I mean, I don't want to speak for all the partners because we have different opinions on this. But from my opinion here is that it's not that they're eating the space. It's value additive. And the reason why I think so is that, well, I guess we're going to talk later about regulatory loopholes, the Clarity Act, Genius Act, MiCA, and so on and so forth. But aside from putting those aside, the other thing that the on-chain space allows is to aggregate extremely heterogeneous sources of yield, which, again, they don't always exist. They're volatile. They pop up here and there. So it creates a need for a last-mile player that, again, captures or integrates the yield flows as they appear on-chain through interest rate arbitrage opportunities and other such flows. And so in that respect, I don't see how they remove the last mile player. Also, they're bigger, so there's an inertia element to how quickly they can move in a quickly evolving space.
Yeah, definitely, especially banks. But fintechs move a bit faster than banks. But yeah, it's
I don't know, man. You haven't been able to withdraw crypto assets from Revolut until what, I think this year. So
right.
like, I don't know how fast they actually move.
Okay, agreed.
I've always been a bit interested in this topic around opposing fintech and crypto. I started in fintech in 2016. I saw Revolut being like this at the time. And then I deep dive into crypto in 2018. And it was for me a subset space of fintech because it was finance and tech. Why should we look at crypto as being something different? Indeed, fintech, cloud-based fintech have started with the first use case that has been payment. Crypto has been trading. But I mean, in the end, it's still fintech. So are fintechs eating the pie? I'm not sure. I think the fintechs that we see today entering the space are mostly using the stack, the infra. I will mention Formance, which is initially a cloud-based settlement solution. And eventually now they have integrated stablecoin just for the infra. They don't do any crypto whatsoever. And I don't think that those players are actually eating the space. I think they leverage the technology for the use case they have, which is the best approach that should be when innovating in finance.
Yeah, okay, good. Yeah, I agree. They're scaling the pie, if anything. They're definitely scaling the pie. Like they're definitely bringing in the big players, they're the big monoliths. They're going to bring in the liquidity. And yes, of course, when certain tools that operate on the tech stack, like was just said, become very standardized, of course they're going to be incentivized to introduce them in their nicely polished, user-facing, like B2C framework. But there will always be other stuff being built on top that is going to capture the majority of the value in the last mile, precisely because it's not easy to package in a simple final product. And so, yeah, the space just keeps evolving that way.
Yeah, I agree, and I think that ties back to the stablecoin stack. There are some layers which may be disrupted more. Some it will actually works other way. They will just make the pie much bigger, and there will be distribution coming from those fintechs. So it's kind of different play for different part of the stack, and also different by jurisdictions. Which brings us to other question, which is more because the product or success of the project is not influenced just by product, but also these days more and more by regulation and jurisdiction they operate. So my question is, if it's something you consider when you're investing, where the project is based? For example, let's say you want to invest into neobank, probably you invest more into neobank in LATAM than neobank in US, right? So that's where I'm trying to get.
Yeah, so to what you just said, absolutely. Like I said, we have a strong focus on emerging markets. Obviously, more than where they're based, also the team. It's obviously very project dependent based on what you're investing in, but like you look at the team a lot. Do they have a distribution strategy on the ground in certain cases? Who else do they have backing them? Do they have support on the ground? Yeah, so it's hard to make a general rule out of this, but absolutely, you definitely look at specific jurisdictions, what's hot, what's not, where are you seeing flows, who can capture remittance flows to, like Southeast Asia, for example, who's capable of really entering that space and grow fast. We definitely want to see traction, some form of traction before we invest. It's not just pie in the sky projects. You don't want to see crazy ARRs, but obviously, because if we invest in a seed in early stage, obviously, but like seeing some form of traction and a well-defined strategy to retain that traction and grow that is very important. And in last mile solutions, it requires an on-the-ground presence. So where you're based, where the team is based, what is the experience the team has is crucial in that case.
Okay. Maybe, yeah, just to add to this, because I think it will nicely contrast with the approach of BPI. So, because you invest into emerging markets, and those are often, the regulation is maybe not in the same stage as the regulation in Europe or US. Depends on the country, but in general, I think Global South is like that. You as a VC, are you like more adventurous in that, meaning like you're gonna go there even if the regulation is not super clear in some countries?
The valuation of the project?
I mean, the regulation of the jurisdiction where the project.
Oh, the regulation. Sorry. The regulation of jurisdiction. Yeah. I mean, obviously, the more clarity there is, the better. Like if it's a project that is in a heavily regulated environment, you have to show something for that. Like how are you planning to tackle this? You should have already got moving on this. You should have a clear idea of what the costs are going to be to comply with the regulations of that jurisdiction. Yeah, absolutely. That's totally part of the equation. You can't ignore it.
Okay, and Celine, I guess you will have maybe more conservative.
So for BPI France, obviously we are regulated by the ECB, so investment we don't invest in company that goes in Virgin Islands or stuff like that. So that's the approach that is being taken, and it's just regulatory requirement actually. This question is interesting in the sense that this industry has always been has started against regulation in general, let's be honest. But more and more we see this industry becoming like fintechs. How fintech started, this regulatory dance between jurisdiction has always existed. We knew at the time that when a cloud-based fintech was going to Malta, they might have a problem with BD. Why? Because they might have some clients that say, I can't sign a contract with you, you are in the gray or blacklist, so it's done. And we have seen some fintechs coming back to Europe because, coming back to other state members because they couldn't do business in Malta. That happened. And that was in fintech based. Today with crypto, at the time, I remember being at a AWS forum and a VC saying, guys, in front of Standard Charters, Santanders, all bankers, and the VC was saying, guys, I can't have a portfolio that is not represented halfly in Virgin British Islands. So I have to go there because this is where the industry is. And you had all these banker eyes being like super wide and thinking, what is that? What is this Wild West? And I think that more and more innovation has been enabled because we have been able to push these boundaries without regulation. But today, the fact that regulation is coming is because we also see this industry being consolidated. And when we are at this stage of consolidation, it's only normal that banks and other financial institutions are going to ask those players to have the same requirement or at least the same standards that they have. So it's not surprising, but I think today we still see, as we've seen in fintech, some jurisdictions that are like, I would say, advantaged by the fact that they have, let's say, a strong regulator, and we know that when you have a stamp from that regulator, your company is supposed to be like a good running business and things like that. That hasn't changed, I think.
Yeah, I'm going to update my answer because sitting next to her, no, we definitely take a lot more risks than that. For us, being in a gray zone, a regulatory gray zone, is a value prop because obviously, if you're investing in something that the regulatory framework already considers, you either have like a very strong distribution strategy so we're investing in the distribution strategy, or it's not a seed investment. You're not doing anything particularly new, right? So whereas if you want to invest in something new, you have to take advantage of the gray zones. Obviously, we think of we have regulations in hindsight in our minds. It's like, how is this gray zone very likely to fall into the regulatory process further down the road? And we do think of that. We do think about this and we ask the founders questions about this, see how they think about this. Obviously, when you're dealing in it's hard to call them unregulated markets, but just poorly clarified markets, you can't have certainty on anything, but you have to take your chances. Also, because there's a lot of technical solutions that simply aren't even conceived by regulators, and even though they are really incredible solutions to pretty obvious problems, really obvious problems, like ZKID, privacy pools. You can make them regulation compliant functionally regulation compliant in the sense that there isn't a regulatory framework right now that these things could be made regulatory compliant for. It's more like these technologies are compliant and respect the spirit of the compliance rule if only the regulators expanded the regulatory approach to include these technical products. And so in that sense, even though they're in a gray zone, you do consider them because they do have a viable theoretical pathway to become regulatory compliant, even though regulators are nowhere near to even considering these tools as compliant.
Yeah, we don't need to go that much back, right? Like in the US a year ago, it was basically the similar environment you just described.
Yes, stablecoins are a classic example. Stablecoins are the first example that people kind of see because it was a technical solution that regulators just needed to adopt. But I'm trying to make an even finer distinction because stablecoins were actively being used. So there was economical value flowing through stablecoins before they obtained regulatory clarity. There are technologies that cannot accrue any value whatsoever without regulatory clarity on them, simply because they revolve at the end of the day between some interface between the real world and the blockchain. And the real world, if you think of the real world, I like to call it the meat space, like the space of human meat, like skin and bones, right? It has its own, you can think of it its own blockchain with its own, the consensus rules, whether you think of it as the judicial or monopoly of violence, becomes philosophical. But the point is that if you're building a product that lives at the interface of these two chains, like the blockchain and the meat chain, the real space chain, you cannot avoid real world consensus. Real world consensus has to be integrated for the whole flow to work. And so there are a lot of technological solutions there are solutions looking for regulatory inertia to dissolve.
Yeah, 100%. Basically, any infra touching banks directly will need regulation to succeed on scale for sure. Okay, so we discussed the regulation in general, but maybe let's bring it to one of the most interesting aspects of stablecoin and on-chain finance, which is yield. So we see these yield wars almost, the discussions and regulatory approaches to how to regulate yield. So Genius prohibits yield on issuer level. Clarity Act may prohibit it even more. basically any passive yield, including lending and maybe even a reward, maybe banned in US. MiCA is also not super supportive. So what's maybe Celine, because I know you were previously in the regulatory space, right? You worked in regulatory space.
I was a lawyer in banking and finance.
Okay.
Congrats. Yeah, but no. So I think we don't really depart from the general rule that is same activity, same risk, same rules. It's always the same. So it's the approach is going to be different depending on the country, but in the end, we are always going to look at a financial instrument per analogy. What is this instrument look like? How does it look like? And what is the analogy of this instrument in the TradFi? That is how the regulation today, do regulation since many years. And I think that over yield, on the passive side, indeed, issuance has been clear. On the other side, they will just look at what is the underlying. Is it payment? Is it an investment product? And then define and put the rule that is according to it. And we are always we will need always to look at the underlying of each activity, because it's not asset-based, it's activity-based. And if we look at it from that respect, we can't be really taking risk in a sense, because we will always work per analogy. Let's take an example. If I decide to offer yield that depends on a specific action from a user, I would consider this yield being either a reward, either an investment product. Generally, because it's digital asset, they will say investment product, but I believe that with time, they will even make the nuance, and we will have probably rewards as they are being seen for, I don't know, Starbucks point, let's say. The same analogy will be put at yield that is earned in the same way. That's what, I don't know if it was clear, but.
Okay.
Wait, I lost track of the question.
The question?
Yes, can you mind repeating it?
Yes, so for Celine, it was more about the regulatory side of it. For you, it's maybe more about, so first maybe, what do you think about this regulatory approach of basically banning the any kind of yield?
Okay, so I'll keep playing with playing in the dark gray zone of crypto. Someone has to represent that. So I mean, crypto is obviously in the business of finding loopholes. That's the whole premise of living in a gray regulatory zone, is figuring out what loophole you can get away with. Obviously, the big hot topic right now is the debate on the Clarity Act in the United States. Is it okay for Circle to pay yield to Coinbase that then Coinbase redirects as rewards to its users? The banks don't like it. That's the narrative right now, right? As someone, I'm going to speak from like a cypherpunk. It just feels like unnecessary Luddite friction. The technology wants to be free. The yield wants to flow. The yield will find a way to flow. If you cannot define every possible way the yield flows. What if you say, Circle, you can't give the yield to Coinbase anymore. Okay, so who does this yield belong to? It belongs to Circle, right? They earn. That's the whole point of the issuer. It's like you're earning a yield, right? Am I allowed? Let's say then this yield is. Is yield in treasury bills, right? Can I mint more USDC with this yield that I'm making since I own it? Yes, no, yes. Okay, fantastic. Can I deposit it on Aave and lower the borrow interest rates for USDC on Aave and thus activate a whole machinery of interest rate arbitrage players that are going to try to arbitrage that interest rate? So in the end, did I not flow the yield to the ecosystem? Sure. I'm not paying it directly to USDC holders, but I'm paying it to USDC incentivizers, right? Sure, it's not guaranteed, it's not well structured, it's not like the simple, if you hold USDC in your wallet, you get USDC, right? But Coinbase could then say, okay, fine, your USDC gets directed to lending opportunities in the DeFi space, and in one way or another, this yield reflows back to these holders in some indirect, convoluted way. You cannot preclude these convoluted ways from being found. The market will find them because the yield wants to flow to the recipient, and so the path of least resistance will be found. You can put obstacles along the way, but the water will keep on flowing, and this will not stop.
If I can add on it, I think that the perspective that we are looking at is mostly, of course, startup and innovation, right? Obviously, the ban is coming from the lobbying of banks, I think. Like, it's not a surprise. It's just about saying, okay, we have been given this mandate of giving credit to people. In order to pay those credits, I need interest. And this new feature that you guys are having, it's actually going to kill my source of revenue to offer credit. So I can acknowledge that the approach should not indeed be killing the new use case that we see in DeFi and the reason why DeFi has been actually been so much developed today. So I agree on that point. But on the other side, imagine a world where if everyone was coming to sell their assets, and what do you do after that if a dump happens and this is completely private and there is no guarantee indeed? And today the concerns are coming from people that have known systemics issues and systemic risk. I don't say that regulation have been perfect around this, but we've seen already problem happening in 2008. And I don't say that blockchain is going to replicate. On the contrary, I believe the technology is going to show transparency and what we need. But also, pushing it too far, I'm also afraid we forget those kind of safeguards we've been working on over the past years.
Yeah, so I mean, okay, I'm not going to argue with someone coming from the banking sector over like the risks of using tools in DeFi. That said, because again, there's the whole argument of smart contract risks, which were completely. It's not a scope for this panel. But that said, I would argue that DeFi has been a lot more stable than centralized players in the last couple of years. I mean, we've seen major implosions in crypto, and we have over-collateralized lending protocols that are still solvent. That they handled 80% market corrections. They've handled major liquidity players completely blowing up from one day to the next. Think FTX. The FTX disaster, $8 billion, poof. It's like the centralized players are the problem, because they hide the risk effectively. Whereas the whole point of DeFi, if it's built, the principle of building these financial primitives on DeFi is that it makes the risks apparent. You can simulate you can stress test. Everything is transparent and available for you to explore. I would also add that there's a distinction to be made about a lot of the risk. I think the systemic risk is borne by rehypothecation, and specifically under collateralized rehypothecation. I would argue that is the biggest source of systemic risks, because you have some big market stress, and then suddenly you're stuck in this leveraged credit scenario that is just not unwindable. That's the whole premise of where in the fiat system you have the lender of last resort, the central bank that can step in. You turn on the printer and you make it go away, right? Obviously, DeFi is all built with the idea that this doesn't exist. It's like how do you build financial primitives with the idea that there isn't a lender of last resort? And yes, of course, this means building things such as over-collateralized credit lines, which implicitly are less capital efficient than under-collateralized credit lines, but they're also more secure, like way more secure. As long as putting crazy smart contract exploits and insolvencies created that aside, which is a real thing, but again, out of scope for this panel. Like the mechanical principles are legit, and the proof is in the pudding. Aave still exists, FTX does not.
No, I agree. Just like last comment on that, yeah, for me also the regulation feels a bit excessive on this. It feels it's protecting not really the retail, but more like the banks, right?
Absolutely.
100%.
Absolutely.
And
Absolutely.
Yeah, I would love to see like markets to decide, right? If the fintechs want to integrate yield from DeFi source, would be great if user can use it or not. So let market decide. Okay, we have 1.5 minutes till the end of the panel. So let's do some rapid question format. So this one I'm curious. 2030, Circle or Tether, who is winning the game, or somebody else?
Well, I mean, look, I'm going to give you the purest crypto answer, okay? As someone who's been in the space for a while, never fade Palo Arduino. This is, I know, I realize this is not like, this is very much not don't trust, verify, but typically fading Palo Arduino is a losing bet. So I'm going to say Tether 2030. Also, they're like as big, they've got reserves worth of a central bank, so.
They have a head start for sure.
No comment.
No comment, okay. Okay, so the last one, maybe something, what is like the most contrarian position in your portfolio, or if not in portfolio, what is like contrarian view on something in the space?
I mean, so one of the projects we invested in is a wallet for very, 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 very low-end smartphones. So we're talking Android phones, KOS phones, the phones you would find in like a tiny village in remote Africa or like somewhere deep in India away from a major city, like those low-end phones. I like to think of it as like a contrarian investment because how much money could people operating with low-end phones possibly put together? But you know, if you put it in the, we see it more as like a thesis bet, like a longer-term thesis bet. First and foremost, for capturing an entire audience, which right now is completely unserved because major wallets just don't run on those phones. They're just big APK files that don't run on those phones. But also because are we dollarizing the world with stablecoins? Are we going to kill? Is this the end of the euro-dollar market? It's possible. Like, the question would be, I guess the contrarian bet is stablecoins are going to kill the euro-dollar market. That would be my contrarian thesis.
Okay, cool.
Since we have a specific mandate, we have obviously invested in project that with a bit of distance, we've seen that we haven't seen the result we've hoped, as I guess every VC. But given our mandate, there is, I would say, no second guess around why we support it. Because even if it's not successful, the idea behind our investment is always dual and also about supporting the innovation and entrepreneurs. So in that respect, we obviously had at the time, some NFT-based company. I mean, we have been invested in most vertical within crypto. So we've seen during the years what sector have been dying and the others. So yeah, I would say what we've seen on trends has been reflected.
That's a wilder portfolio construction than I would think. Okay, thanks. Thank you guys for like answering and spending time and going deeper on this topic.
Thank you very much.
Yeah, sure. Thank you. Oh, there are other people now. Okay, thanks.
It'll be funny, no?
Yeah, there were these people.
We just also meet.
So you're fine. You can stay here, Peter, right? Okay, so guys, hello. We are wrapping up the day with an amazing initiative that is the second time we do at StableSummit, and it's called Zero TVL competition. And so I'm very, very happy to announce, first of all, the judges, because we have 4 amazing judges for this
competition, and how it will look like. Basically, we will have four startups presenting their ideas and projects, and these judges will listen to them for 7 minutes. Actually, 5 startups, sorry, 5 startups. They will have 7 minutes each to pitch, and then the judges will decide who is the winner, and the winner get some one-to-one sessions with our amazing judges to have some consultancies from them. So it's an amazing opportunity. So I want to call back Peter from Nammu Capital on the stage. Welcome back. Long time no see. Then Tesa from Flashbots. Hello. Hello, no problem. Amin from Gnosis VC. Welcome.
Yeah, you didn't change your seat.
And then Pietro from Chain Security. Do we have time for a 2 minutes introduction of the judges? Okay, so guys, if you want to go ahead and present yourself for the audience.
Yeah, sure. Maybe the audience changed. So I'm Petr from Nammu Capital, GP there. We focus on what we call FinTech 3.0. So it's stablecoin infrastructure and applications powered by on-chain finance, AI, and stablecoins in general.
Hi, I'm Tessa. I'm the head of market research at Flashbots. Flashbots is an Ethereum infrastructure provider. We're the OGs for MEV. And yeah, that's it.
Hey there, I'm Amin from Gnosis VC. We basically invest anything in infra, AI, FX, stables, yeah.
Hello, I'm Pietro from Chain Security, where I'm a blockchain engineer. We help secure the space since 2017. We do mostly smart contract audits, but also other kind of technical reviewing work on Node, on clients, on compilers. So thank you.
Here I am again. Thanks, guys. So now it's time to introduce the pitchers and so the projects. The first one I want to introduce is Ermin from Aegis. Good luck. 7 minutes from now, run.
Hello. Hi, I am Ermin. I am co-founder and CEO of Aegis. We are building institutional-grade yield-bearing stablecoins with DeFi compatibility. So we launched last year in March. We gathered around 50 million of TVL at peak. Right now we're sitting at around 40. We have integrations with DEXs and SEXs. Our yield-bearing stablecoins are used as trading collateral across all orderly-based DEXs, including Radium. We also have integration with UX, so it's a SEX integration. We are deployed across multiple chains, including Ethereum, Katana, Base, Avalanche, and others. We have deep partnerships with them, including some incentives for the end users. We also deployed across lending markets like Morpho, Gearbox, Euler. We worked with the biggest curators and TVL providers in the space. Most of them became investors on our cap table, including like Flowdesk. And we had one of the second biggest pool on Euler on BNB chain in terms of TVL, and we had one of the best performing pools in terms of APY on Pendle. So yeah, when it comes to the core products, we have two stable coins. The first one is BTC-backed, basically BTC basis trade stablecoin. What we do, we go along BTC and we hedge it one-to-one with BTC margin perpetual shorts. We earn funding rate on our short positions. We distribute it as a yield. We take 10% performance fee cut from that. And that's basically how this product works. Why we chose BTC margin perps to hedge Bitcoin is basically that we put risk management on the first place. So we didn't want to have any exposure to other stable coins or have a risk of liquidation on the short side. So basically with BTC margin perps, you are protected from that. In case if you are using USDT margin perps, anything happens with the USDT, let's say a DPAG, you can be liquidated on the short side. So we don't have that risk because we are using BTC margined futures. And we also have another stablecoin with a GLP hedge strategy. What we do, we buy GLP, which is a native token of Jupiter Exchange on Solana. It has inherent yield embedded into it. Basically, they're accumulating fees from the trading on Jupiter and liquidation fees. And we hedge everything that is inside of GLP because GLP acts as an index. So they have Bitcoin, Solana, Ethereum in it. So we hedge that and we have yield from GLP and we have yield from the funding rates on the short side. And on both of the products, we are delta neutral and we don't use leverage. So essentially, that means we are not exposed to the movement of the underlying assets, and also we don't have any leverage. So in case of the severe price movements in the underlying assets, we are kind of like protected from that. And the yield is, you can see the yield, the current yield on both products. So yeah, and one of the features that we introduced with these stable coins, because if you look at the overall market, in order to receive yield, you need to have staking or stake the stable coin in order to receive yield. In our case, you don't need that. So basically, we have direct yield feature. So any product, any fintech app, we have proven that with orderly network integration and VUAX. So basically, user just buys our stablecoin and holds it on a wallet or on their account, and they don't need to do anything with it. They receive yield directly. They don't need to do staking. But we have staking options as well. So if a DeFi native user prefers staking, we have staking as well. So we did multiple integrations. We are talking to some crypto wallets like Coinomi and some guys like EtherFi about this product integration. And we obviously have stablecoin as a service because we have rigorous infrastructure in place, including smart contracts and also custody infrastructure. For both of our products, we use Copper and Cephu. So that means we never move the collateral to the exchange itself when we perform the trading. So it sits within the custody, and the settlement happens off-chain through the clear loop solution and MirrorX. So yeah, the stablecoin as a service, we kind of like provide this infrastructure to fintech apps, to banks who are interested in launching their own stablecoins or even DeFi projects. We have 3 customers in the pipeline. Unfortunately, I cannot reveal the names, but this product is also getting some product market fit. In terms of the team, I'm a co-founder and CEO. My background is in finance. The rest of the team is mostly DeFi native guys and also with guys with the HFT background. In terms of advisors, we have pretty strong names as well, like head of crypto at Layer 0, and also stablecoin lead at Pendle, and the ex-director of Paradigm and UBS. So yeah, why do we have the edge, and what's our edge? It's basically our background and our core backers. It's Riverside Hedge, which is one of the biggest market makers in the space. They do around 30 billion monthly trading volumes across sexes and dexes. They are like top 4 on Aster and top 5 on Lighter in terms of volumes. And they transferred part of their team and trading technology to us. So everything that we do when it comes to trading and executing the strategies, we do in-house. So we don't rely on any external parties, what you would usually see in some DeFi protocols. So we control the risk management and the trading operation side in-house. So yeah, in terms of the roadmap, I think we are focusing on improving our risk management practices and launching new products that would diversify our yield. As you may know, the real trend is RWAs, so we're looking into that as well. We have a plan to diversify the yield and include some RWAs, specifically CLOs, tokenized CLOs, as a part of our portfolio and the backing. And we have a good partner for that. We are talking to multiple parties like Maple and Galaxy to co-launch this product. So yeah, I think in terms of the next steps, we will be focusing on diversifying the portfolio and scaling the TVL through multiple integrations with crypto cards, DeFi wallets, and fintech apps. So yeah, that's it from my side. So yeah, you can visit our website, which is aegis.im, and check out the products yourself. Thank you.
How do we start? Okay. So I will have first question for you. Thanks for the presentation. So my question is, like, how sustainable is the yield APR you showed, 10% on stable and 6.5 on Bitcoin? Because the main source is it's perpetual funding rate, right?
That's
and
correct.
That one can get even negative in certain scenarios.
That's a good question. So if you look historically, like for the past 5 years, 87% of the time funding rates were positive, and only 13% they were negative. That's actually what we see currently in the market. But if you average out for the past 5 years, the average APY was around 10% on the funding rate, on this basis trade strategy. On the GLP hedge side, that is also dependent on the market. Obviously, retail, activity of the retail dropped off significantly, so open interest on GLP dropped off as well. You currently cannot earn this 10%, but you can easily, so what the yield that we get right now is around 7%. So for the past year, it was 15%. So once the retail comes back, the yields will get back as well. But that's why we are looking to diversify into more, let's say, uncorrelated strategies, so that we have this diversification in case there is a bear market. But yeah, so the yields are not sustainable short term, but long term, they're pretty stable.
Okay, thanks.
So I've seen you've got multiple audits, but how do you handle the operational security? I guess a lot of things happen off-chain. How are users safe giving you their money off-chain?
Yeah, that's a good question, and I think especially specifically after the Resolve incident. So we don't. When we design the protocol from the beginning, first of all, we don't have any God mode admin role that can basically execute mint that is uncollateralized. And we also have different protection mechanisms. You cannot be protected from that 100%, right? But what we do systematic reviews of the operational security. We also have mint caps, so you cannot mint unlimited amount of YUSD or JUSD. We also have Oracle checks, so whenever the mint transaction is happening, there is an Oracle, Chainlink, Redstone, that are checking the price of the underlying. And underlying is only USDT or USDC, so you cannot mint with an exotic asset our stablecoin. And the third thing is basically, yeah, there is no one private key or AOA that can sign the transaction or get the rights to mint without KYC and KYB. So every minter, we basically know them because there is a mandatory KYB, KYC for that.
Thank you.
I had a couple questions for you. One is, how are you different than Athena? Two is, who is your counterparty for your perps and your futures? And what are your major risks?
Yeah, so basically how we're different from Athena. So Athena is kind of like abandoning delta neutral strategy in general. But at the beginning, they were using USDT margin perps to hedge the positions, and that's the main differentiator. So we don't use USDT margin perps to hedge the positions, so we don't have the USDT risk embedded into us. In case of Athena, if something happens with USDT, because your quote asset is USDT, BTC-USDT pair will shoot up in price if USDT debacks. And that means, and you are holding short against your Bitcoin or like Ethereum, doesn't matter. So basically the price will shoot up and you get liquidated on the short side. That means you lose the collateral. If you lose the collateral, you lose the peg. In our case, it's BTC margin perps. So anything happens with USDT or other assets, our quote asset is USD. So liquidation risk is super, super small. And the counterparties, we hedge on OKX and Bybit and Binance. These are like our main venues. So on those venues, you have different protection mechanisms. Obviously, you are not protected 100%, but that's the same for every, trader or project that is doing some hedging on the centralized exchanges. So yeah, the counterparty is basically other traders on OKX, Bybit, Binance, I suppose, yeah. And we also, one good thing to mention, we have basically the ADL, also kind of like always mentioned by investors and LPs, like how I protect from ADL. And ADL protection is already embedded into those exchanges as a feature. So before you needed to agree with the exchange, but now you have that as a feature.
Thank you a lot. Can you leave it here? Okay, so next to pitch will be Ethan from Ebisu Finance. Welcome. If you have slides.
Okay. Cool. Hi, everybody. I'm Ethan from Ebisu. Ebisu is a stablecoin credit market that enables fixed rate open term loans against blue chip tokenized collateral. So it's one of the only places in DeFi you can lock in a fixed rate and then repay anytime. I'm going to explain a little bit about how the mechanism works. So firstly, all debt issued by the protocol is EBUSD denominated. It's like a CDP protocol. And EBUSD is fully backed by over-collateralized debt. How is EBUSD pegged? It's through a permissionless one-to-one redemption function. So EBUSD is always redeemable for $1 of collateral. This means that EBUSD is always as liquid as its underlying collateral, like irrespective of DEX liquidity. And this is also how the peg is maintained. So if EBUSD can ever be purchased for less than $1, redeemers can redeem it for $1 of collateral and make some profit, which pushes the peg back up. So our unique feature is our market set fixed rates. Borrowers can come to the platform and lock in a fixed rate that is calculated by the protocol and based on the strength of EBUSD's peg. The strength of the peg is a function of DEX liquidity and premium, and Ebisu's monetary premium, and I'll get more into this mechanism later. So like with all CDP protocols, protecting solvency is key. We use JIT liquidation as our primary liquidation path. So this is like having third-party dependency on like available flash loan liquidity. If just-in-time liquidation fails, we have stability pools as a backup. Stability pools receive 25% of our protocol's borrower revenue, and this is used to incentivize EBUSD deposits, which are burned to absorb debt in the case of liquidation if JIT fails. And lastly, if all else fails, borrowers collectively act as guarantors of last resort. So I mentioned 25% of protocol revenues for stability pools. The remaining 75% is used to grow EBUSD demand. Primarily, this is for directing EBUSD, USDC DEX incentives because we're an early protocol, and first we want, like even if we offer an attractive rate, you need to be able to do something like swap out of the EBUSD you borrow. So DEX liquidity is our priority. But in the future, this 75% can be allocated between lending markets, Pendle, tranching protocols, vaults, etc. So here's the collateral that are currently available to borrow against. On the crypto side, we have Bitcoin, ETH, and Bitcoin ETH derivatives. On stablecoin side, we have Athena, CAP, Syrup, and USDAI, primarily used for carry trade looping strategies. And we have gold as an RWA. Coming soon are PTs, which are like fixed yield instruments, which are like extremely synergistic with Ibisu's fixed rate. And RWAs, like commodities, FX, credit instruments. This is like really hot. We can see it as like an avenue for new borrowing demand, but pending some R&D regarding how we deal with like liquidations, as many of these RWAs are carrying duration risk. So like zooming out, the protocol's key feature is fixed rate open term loan. Why do we think this is something worth pursuing? The goal of our protocol's rate system is to best serve the credit needs of on-chain native users and institutions. And fixed rates do this, because fixed rates are predictable in their cost. They enable borrowers to mitigate risks in terms of like incidents of negative carry and liquidation caused by interest accrual. We're also seeing an explosion of like fixed yield instruments on chain, which fixed rate borrowing is extremely synergistic with. And uniquely, like the open term allows users to repay any time and borrow at a rate that is independent of duration, which is like our unique value prop to the market. So versus like other kind of fixed rate protocols that are emerging, like Morpho V2 or some rate swap protocols, which offer fixed rate, fixed term loans at an interest rate that is typically higher than the market average variable rate, Ibisu offers fixed rate open term loans that historically has been on par or lower than the floating USD borrow rate. This is similar to Liquidity V2 because like we're built on the Liquidity V2 mechanism, but different than Liquidity. Like Liquidity only offers ETH collateral, which limits their ability to expand like borrowing demand, and also they use majority of their interest towards stability pool to ensure like solvency and smooth liquidations. But it's a little bit inefficient. We choose to rely on just-in-time liquidation, and in turn, we're able to generate like 3x as much margin per unit of debt, which we can redirect towards growth incentives like versus Liquidity. So how does this market set rate mechanism work? Like if you know Liquidity V2, it's the same, but essentially the system aims to offer borrowers rates that are as close to the true cost of capital for a given collateral without intermediation. So no one is setting the rate, it is set by the market. This is done through using EBUSD's peg as like the source. So if EBUSD's peg is like depegged, this is informing the system that the rate is too low, because if the rate is low, borrowers borrow, they sell EBUSD for another stablecoin to do carry trade. This causes a depeg, which triggers redemptions. And redemptions need to return collateral to the redeemer. The collateral comes from the borrowers who are paying the lowest fixed rate. So they're effectively like auto-deleveraged to take their collateral to give to the redeemer, which has the effect of pushing the average system's rate higher. And as EBUSD demand grows and as monetary premium improves, the peg gets stronger, which enables the protocol to offer lower fixed rates. So I've talked a lot about why borrowing on Ibisu is great, fixed borrow rate, open term, but this generates like supply of EBUSD through minting. But where does demand come from? So demand comes from yield generated from borrowers. All the interest that borrowers pay to the protocol is given back towards EBUSD holders as yield. But how do we even get the borrowers in the first place? Like there's a cold start problem here, and we need incentives to bootstrap the flywheel. So external incentives in the beginning are used to build EBUSD DEX liquidity, for example, like on Curve, and this creates a flywheel. So borrowers come, they see, wow, the rate is cheap, and there's deep liquidity, I can do stuff with this stablecoin, I'm gonna open a loan. They borrow, they pay interest, and most of the interest flows back towards the DEX pool LP to generate competitive APR. Capital sees the APR is competitive, they swap into EBUSD to earn this like stablecoin LP APR, which further strengthens the peg, enabling the protocol to offer lower rates, and like the cycle continues. So EBUSD DEX liquidity has been our key bottleneck in growth since we've launched, and I'm happy to announce today that we've secured a strategic investor who's going to be funding EBUSD DEX incentives ranging from 10K to 35K monthly, starting April 1st. So yeah, first, our priority is EBUSD liquidity, then demand-side endeavors like adding more collateral will have a higher impact. We have also been exploring EBUSD yield vaults and looping structured products. Like we have built like a fixed rate looping vault on IPOR, and this helps drive both supply and demand, like assuming that there's like deep enough liquidity to loop on. And then lastly, integration of EBUSD and these vault shares into third-party venues like Pendle, lending markets, trenching protocols will help to improve EBUSD demand down the line. So this is our roadmap, and thank you.
Quick question on the EBUSD borrow demand. How do you navigate your mechanics if there's low to no demand on borrowing it?
So the question is, if there's no demand, like what do we do? So we have currently around like 300K TVL, so that's collateral that's been supplied. It's enough to kind of like kick off the interest rate mechanism. So you can go to the website now and you can view the market set rates per collateral. So luckily we don't have the problem of like zero borrowing demand. But the main constraint is DEX liquidity. Like the rate for borrowing, let's say against your Bitcoin or against your yield-bearing stablecoin is competitive, but it can't support size because user cannot borrow and swap EBUSD to another stablecoin. That's been our main constraint. I think solving the DEX liquidity supply side is how we get more borrowing demand. I don't know if that answers the question.
Maybe a follow-up question on that. So if there is no or low demand, means also the stability pools are empty, right? Technically.
So we have stability pools. They're not empty, and just different than liquidity, we don't really use stability pool for liquidation. It's primarily through like just-in-time flash loans via MEV bots. So
this is like another level, right? Level 2.
Yeah, level 2, and it hasn't happened. Like since we made this change to liquidity, we have never had a problem. There's like a lot of flash loan liquidity versus our outstanding debt.
I have a follow-up question on this. How does just-in-time liquidation work, and how did you change Liquidity v2 to implement this?
For sure. So this change was audited by DDoB, and it involves a JIT liquidation contract that is embedded into the stability pool. So stability pool is still used for liquidation, but instead of burning EBUSD in the stability pool, it first checks whether a viable flash loan path is available. So liquidator comes, they call liquidate function on specific troves that are at the LTV, and then JIT contract checks if it's possible. If it is, the JIT contract executes the flash loan, and then the liquidator receives the collateral through the stability pool. So usual flow is that stability pool depositors, they get their EBUSD burned and they receive the collateral back. In this case, you can think of the liquidator doing like a just-in-time deposit into the stability pool, and then he receives most of the collateral from the liquidation. So he kind of like front-run the stability pool. And this way, we don't have to waste money on incentivizing EBUSD to just sit there doing nothing, because we're trusting that like Aave, Curve, Balancer is going to have flash loan liquidity.
Are you doing any OEV capture on your own liquidity pools?
So we talk to Chainlink for our assets that we support. Only WBTC has like the OEV Chainlink Oracle. It's not yet implemented, but we signed LOI already with Chainlink to implement this. And then any savings from OEV will be redirected back to Curve Pool incentive.
And then one more question. How do you set your LTV on your pools? Is that dynamic or is it just static?
Yeah, so just static for now, like most lending protocols. Set conservatively, and for EBUSD, it's like EBUSD holders bear the risk of all the collaterals. It's like socialized risk versus like Morpho, which is like isolated. So we're being a bit more conservative on the LTV side, and we work with Antheus, which is like a DeFi boutique risk shop who advises us on LTVs as well.
Do you see any peg keeping effect with redistributing the yield instead of stability pool to other pools?
Yeah, it's an interesting experiment we're running in real time. So stability pool is great because 100% of the incentive to stability pool fuels EBUSD demand. When you transfer that incentive to DEX LP, it's split between however many assets are in the DEX pool. So that hurts EBUSD demand by 50%. But it has the effect of deepening DEX liquidity, which reduces the depeg effect from selling. So it's helping the peg in some sense because there's deeper liquidity, but it's reducing demand because you have no longer the buyer who's coming to buy it for stability pool. So we're running the experiment in real time, but our peg has still maintained like within like the 99 cents to $1 range. So it's like, yeah, but we chose to make the change like incrementally. So first we reduced it to 50-50 split. Then we saw nothing bad happened. We reduced it to like 75-25, and our goal is to actually reduce it to closer to like 95-5%, because every lending protocol using flash loan for liquidation, and we're not as like decentralization maxi as liquidity to want to have enshrined liquidity for liquidation.
Okay, thanks.
Thank you.
Thank you. Sorry, guys, I need to check who's next on the agenda. Next, we have the project is called Polaris, and we welcome Lawrence on stage. Welcome.
Hello. Well, hello. I'm from Polaris, and I want to talk about why we're building it and the design choices behind it. So, when you analyze the existing decentralized DeFi stablecoin landscape, you realize that the existing solutions fail to scale. And Polaris is designed to address exactly that problem. And we innovate across 3 different layers: the collateral layer, the stablecoin layer, and the governance layer. Now, at the core of Polaris sits a bonding curve. And in the bonding curve, we have ETH that enters and mints a p-ETH asset. And with this bonding curve, what we can achieve is an asset that is tightly correlated to the ETH price, but importantly, with adoption, appreciates in value. So in other words, what this means is the more p-ETH is being used, the higher its value becomes versus ETH. Now, furthermore, the bonding curve serves as the primary liquidity layer for this asset, and it charges swap fees, which is one of the revenue sources of the protocol. So every time there's a trade, a swap fee enters. And what do we do with this swap fee? Well, we burn it. So all the swap fees are burned, and what does it mean for p-ETH to be burned on the bonding curve? It means that this part of the supply can never enter back into the market, and it gives us a floor price for the p-ETH, and therefore it's a viable collateral to be used in DeFi. Now, additionally, this part of the reserve, which now doesn't need and is not anymore needed, is free to be used as yield within the ecosystem. So what does this mean if you take a step back? The bonding curve that mints P's versus ETH is a viable alternative to Ethereum staking. Now, once the collateral layer is in place, we can build our DeFi tools on top of it. And the first one is PUSD. Now, PUSD is a CDP-style system, but with a couple of innovations that help it scale. The first one being direct minting and redemptions, such that the supply can respond to market forces directly, rather than just simple borrower demand. Now, the second thing is that the minting and redemptions, they also provide a revenue source. So CDP holders can be looked at as decentralized stablecoin issuers rather than just simple borrowers. And additionally, since the bonding curve can pay yield, we can incentivize the debt. But PUSD is only the first expression of the system. We can, once the reserve layer is in place, we can expand the system to also build P-Swiss franc or P-Gold. And therefore, we look at Polaris rather as a stablecoin operating system rather than just a simple stablecoin. Now, in this context, it's important to highlight another feature, which is that because Polaris can pay a yield to the CDP system, and we have automatic set interest rates, it is possible for the system to accommodate negative interest rates. And the way this works is if the yield is larger than the borrowing rate, you can achieve an effective negative interest rate. And this is especially relevant if you think of assets such as P-Gold and PUSD. Now, another innovation that enters is on the Polar governance layer. So how does it interlock with the system? So the Polar token can only be created via the burn mechanism, which is the same burn mechanism that was used in the swap fees. Now, so what does this mean? For every p-ETH that is burned, users can mint Polar, and this happens via a Dutch auction. Now, this Dutch auction, so as the price decreases of the Dutch auction, the conversion becomes more and more attractive until somebody takes it and the price spikes back up. So therefore, Polar can only be made with burning PETH. So what does this mean for the system? It means that minting of Polar and the issuance of Polar is directly aligned with the ecosystem health, because it improves the collateral base, rises the floor price, and releases yield into the system. Now, once there's yield, where should it go? And this is where stewardship comes in. So Polar votes and maintains a whitelist of protocols and smart contracts that are eligible to receive yield from the bonding curve. And this is not restricted to only receive yield from, to Polaris native ecosystems, but rather to the larger overall ecosystem. So in this way, Polar can vote to distribute yield to the products that drive the biggest demand and the biggest growth for the PETH ecosystem. Now, this is not just theory. Where do we stand in development? It's available on testnet, and you can try it out. It is a gated testnet, so you do have to contact me or the team, but I'm happy to set it up. So what emerges out of all of this? Well, first, a PETH asset which rivals Ethereum staking for long-term Ethereum holders. Second, scalable decentralized stablecoins built on that reserve layer. And third, a stewardship ecosystem that continuously distributes value to ecosystem expansion. So Polaris is not just a simple stablecoin, but rather a broader reserve-centered architecture for DeFi. I'm happy to answer any questions.
Okay, so I start. So the bonding curve is a core thesis for the yield, right? For the whole.
Yeah, so it's only one component, because if you think of it, the CDP system is still a CDP system. So the bonding curve yield can give a bonus to that, right? So at the base layer, the CDP system still has borrowers that pay interest rate. So the PETH layer gives a boost to this.
Okay. So the problem with market with like low volatility, for example, or like sideways market, just influence this element.
Right.
Okay, so you just go.
So the bonding curve component makes the interest rate competitive, right? It gives you an edge. Or it's not the sole.
Or if the market is not really great for you, it just makes it less competitive, but not completely.
Well, if the market is not great, typically there's an overall downturn, right?
Yeah.
So the interest rates will be low everywhere, but we still have an edge. So it's kind of that thesis.
Okay.
But yeah.
Okay. Thanks.
What oracles are you using in the system? I guess you have to price the collateral, which is PETH, right?
Right. So the bonding curve doesn't need an oracle, but the stablecoins do. On PUSD, we use a medianizer of 3 oracles. On P-Gold, you will need to set it up. So, I mean, we're still developing for P-Gold the oracle. And for each CDP, it's like each CDP system, you will have to have your own oracle.
So you price ETH with the medianizer and then PETH to ETH with the bonding curve.
Sorry, what?
To price PETH, you use the bonding curve to price PETH to ETH.
Yes. So, no, to price PETH to ETH, you don't need an oracle. What you need is the oracle for PUSD, and for that you need to multiply the oracle with the bonding curve price. If that's
okay.
That's what you mean.
That's what
yes. Okay.
Other one, do CDPs kind of choose their interest rates, or how are they set now?
No, they're set autonomously. So that is, it's actually a novel approach because we do have this direct minting and redemptions. We can use the minting volume and redemption volume on chain to control the interest rate based on market forces. So this is one of the novel approaches because we have this minting and redemption volume. So it's fully autonomously.
Are you engaging market makers or somebody to do the minting and redemption, or are you just saying whoever?
It's an arbitrage operation. So if there's a DPEG on the stablecoin, up or down, this is a arbitrage operation. Anybody can call it. It's fully permissionless. It actually will be MEV territory. So MEV territory an arbitrager can mint if it's profitable.
Yeah, that's what they said about Terra and some other like algo stablecoins. There's arbitrage, but sometimes it doesn't work that way.
Why you say this is an algo stablecoin?
Huh?
Wait, sorry.
It seems like what you're saying is that everything is due to the bonding curve, right?
Yes.
That's holding everything together.
Yes.
But I feel like bonding curves can still be manipulated.
So the bonding curve that we use uses a very narrow, shallow, so it's concave, right? It uses a power law with an exponent. And I'm happy to go into more detail because I don't think we'll be able to cover it like here. But it's a concave bonding curve, right? So it's not an exponential or something. So rather it is designed to be exactly competitive to liquid staking, meaning that if you look at the price chart here, for example, like the price chart here, the advantage that you get from PETH over over normal ETH is it just outcompetes like the liquid staking rate. So you're talking about like 5, 6, 7% per year. So it's a very narrow, because you can tune the bonding curve, right? The bonding curve can be tuned via this beta parameter. So it's not it's very tightly coupled to ETH. Does that answer your question?
Kind of. I mean, bonding curves work until you have times of high volatility and people just want to unbond. So,
but that's why we have the floor price, right? Like the floor price is a continuously ratcheting up of your collateral base. So any person that enters into the bonding curve, like we can define a maximum loss that he will have even if the system fully unwinds. So if you enter into the bonding curve and you know the floor price is, let's say, at 75%, like you know that even if Polaris fully unwinds, you will still have this exit value because of the floor price. So the bonding curve is designed to be very secure. And yeah, so it's not a system that can implode. Like by construction, it cannot. Unless there's smart contract. I mean, there's smart contract risks, right? But the smart contract is designed such that it can fully unwind and still give back value to the user.
What prevents earlier PETH adopters from dumping into the bonding curve? And
so if you're an early adopter of PETH and the bonding curve expanded, like you're free to sell, right? But the thing is that because of the way the bonding curve is constructed, the amount of liquidity it has to get out is extremely large. And it's because of the concave curve of the curve. So this is vital, right? So the PETH is constructed as a safe collateral with a very shallow curve to avoid exactly these kind of things. So the appreciation rate is comparable to liquid staking on purpose to provide an alternative to liquid staking.
Is Polaris liquidity free?
No. It's not. I mean, I just showed you that we're innovating on 3 different layers. So even though there's an overlap on some of the team members, I think the innovation is quite significant.
That's it, guys.
Thank you.
No more time. Okay. Next on stage, Taulant from Twine, right? Twine.
Yes, thank you. Hey everybody, big fan of Polaris. Everything that I'm going to talk about right now would also be buildable on top of them, so happy to look into that. We are building programmable credit on top of existing lending markets. I mean, all lending markets are programmable, but we look at the loans as objects, and we try to transform them into new risk tranches to just build new DeFi primitives. This is the leverage profile of the Aave protocol. You can see that there's a $12 billion sitting at 0% LTV, taking no leverage at all. And on the far right, there's the E-mode. They are leveraging up $66 billion. And you can see these two clusters. Everybody gets the same access, but everybody's using the product wildly different. So what we are proposing is to create a marketplace for idle credit. You can see the collateral of the lender and its credit capacity. On the right side, there's a borrower. They are approaching their debt limits. And what we built is a credit vault in between to allow the lender's credit to flow over to the credit of the borrower, and the borrower can now borrow more on the Aave protocol. The whole flow also goes back with the yield, and everybody just uses their capital in a more efficient way. How does it work? It is just a simple accounting trick. It is one position, and we have two perspectives on the position. Right now, you can see, okay, you can barely see it, but there's an $80 debt position and $100 of collateral. It's an 80% LTV, and Twine gives you 90%. In the same position is also on the Aave protocol, but Aave sees the composite position of the creditor and the lender. In this case, they have a 50% liquidation LTV, and the Aave LTV is the composite position, which is $40. If the price now moves against the user, he gets liquidatable on the Twine protocol, but Aave is still a healthy position. And everything is kept together by invariants that makes sure that the math always holds. We even can tune the buffer between keeping the positions healthy or unhealthy, or making them liquidatable at the same time. Yeah, I mean, risks usually arise in lending markets when liquidations happen. We have two liquidation layers. The first one is a Twine liquidation. If that happens, creditors are always protected. And the second liquidation is the Aave liquidation kicks in. Here, the outcome depends on the efficiency of the liquidation. We have a clear loss absorption order. The borrower who's taking the leverage, they get hits first. If then any losses remain, the creditor are absorbing them, and Aave is completely segregated from all the things happening on the Twine layer. And even if we have different credit vaults, different borrowers are isolated from each other, so they don't inherit any risk from other users. We tried to analyze the CLP losses if all the liquidations would be Aave fallback liquidations, pushing ETH liquidation LTV to 94%. You'll get annualized losses of 0.16%. If you as a creditor earn more than that, then it's a positive EV play for you to be a creditor. And yeah, I mean, taking on that risk helps a lot because a small liquidation boost goes a really long way. You can here see if you would boost the liquidation LTV from 95 to 98%, it's just a 3% increase, but you'll get 30 more loops out of your strategy, which is the aggressive way of using Twine protocol, but you can also use it offensively as liquidation protection. We ran a simulation to see how liquidated user positions would have evolved over the next 30 days if they had a 10% buffer on top of what Aave gives them. The result is 94% of the position would have survived. Twine has this crazy efficient way of bootstrapping new markets. This is how the position would look like if you boosted it from 95 to 98. There's $1 in credit needed, which enables $32 in leverage borrowing capacity on the Aave protocol. So all these $32 can now use all the borrowable tokens from Aave, and they just come for free because we're building on top of them. The other nice effect is that the $32, if they would pay 1% in yield as a cost for the credit, that yield would be multiplied as well, which is going back to the creditor as 32% in yield. So the bootstrapping mechanism is just crazy efficient compared to setting up a new morpho market. What makes it also better is you can choose your liquidation LTV. You can keep it at 95, you can go to 96, 97, 98, and everything in between. The risk and interest rates and the supply caps, they are always accounted for. So the higher the liquidation LTV you choose, the higher the risk premium is that you're paying. And on the other side, the higher the liquidation LTV is, the smaller the supply cap is that you can use. So we naturally penalize the high risk takers while also allowing people to choose the full spectrum of the liquidation LTVs. Let's zoom out a bit. Lending evolution, I mean, holy shit. That's one big Aave pool. Everybody shares liquidity and shares the risk. Morpho innovated on that by segregating pools. You have stronger risk contamination, but you fragment liquidity. And Twine is just layers on top of the existing markets, can be built on both of them, where you can share liquidity, but still isolate the risk. So where are we now? We just launched a new PT Senior USDE looping vault that would be yielding 30% on Aave. With our boost, you get twice as much. On the plot, you can see where we launched the vault. Since then, the TVL 4x in the last 10 days. And yeah, still at 0 TVL basically, and looking to now grow these vaults. And yeah, I mean, QR codes if you want to follow us and yeah, see what we're up to. That's it. Thank you.
If Aave or Euler came along and just copied your features and functions, what would happen to Twine, or how would you keep it defensible?
I mean, yes, you can say that for any DeFi protocol. I mean, they can build it themselves. Our usual thinking about it is that you're building a network, and the bigger your network is, the bigger your network effects are. So if you build one network on Aave, one on Morpho, and one on Euler, and you start connecting the three of them, you build a moat that Aave will never follow because they will not aggregate other lending markets. So our pathway of escaping that is to be on top of all the lending markets and then be the aggregation layer for all of them. Kind of like AMMs were aggregated by just routing through protocols, and then the newer intent-based systems started to batch the users and just use the network effects of these users to provide a better service. And we'll do the same for lending.
Okay, this idle borrowing capacity on Aave, it serves also this risk buffer purpose, right, on Aave?
Yes.
Are you somehow influencing it or removing that function?
I mean, depends how you look at it. I mean, risk buffer in terms of the protocol, yes. The LP, they seem to be not taking on risk because they cannot get liquidated. In the case of an exploit, they have all their money in the protocol, so they get hit the hardest. And our answer to that is, if you are leaving all your money in the protocol, you should utilize all its value and get paid for it, which you're right now you're just wasting your capacity. So redelegating that and being properly paid for the risk that you're taking is, for the LP, the better answer. For Aave, I mean, we have to basically, we are constrained by the logic, right? We cannot, our composite position always follows the rules of Aave protocol. So if they make vaults more conservative, we basically need to follow that path. So as long as they set the parameters the way they do, our logic always flows up, and our creditors take on the additional risk. They just get hit first.
Okay, thanks.
Can it overall lower the collateralization ratio of Aave as people use more of their credit capability, and then liquidation becomes more correlated, basically?
I mean, can it lower the collateralization ratio? No, we use the underlying collateralization ratio. We increase the utilization of the lending market in the best case. So all this idle capacity is just, you can think about it like a load balancer. There's some idle value somewhere, someone else in the system needs it, so just create a pathway so the credit can flow there. And for liquidations, we built a liquidity V2 style liquidation. If you are a lender with a big balance sheet with borrowing capacity, you can simply absorb and inherit liquidated users' positions. So you're not dependent on DEX liquidity, and you can essentially farm the people that are taking too much leverage.
About the security parameters, are there curators or are users just selecting their own?
as of now, the Twine protocol is setting 1 volt, but we can launch all the curators at any time. Like, we are built on top of the Euler AVC EVK stack. Like, we get the curators for free essentially, but we want to first, prove the use case, grow some vaults, and then risk curators can be onboarded on top of that. But the users, so we set the max liquidation LTV, and the users can then choose whatever liquidation LTV they want from Aave to the max.
Can I get my question in? Is this across all blockchains or just one chain? Like, are you dealing with fragmented liquidity or?
To start with, on one chain, on one lending market, the grand vision is to then be on one chain on all the lending markets, and then the obvious next step is to just connect it also cross-chain through all lending markets. But yeah, there needs to be some single entry point to all the lending markets and if you have the network that generates more value compared to the underlying, you should over time get more and more flows and just grow the overall network.
Okay, cool. We are out of time, so thank you.
Thank you.
Thank you. Last but not least, Karan from Monetary. Good luck.
Hello, everyone. So yeah, my presentation will be much easier. So let's talk some RWAs. I am Karan from Monetary. I'm the co-founder and CEO. So we are an end-to-end tokenization infrastructure for financial institutions in emerging markets that has lots of traction over the last year. But today I will be talking about our Turkish Eurobond tokenization project, which is returning 2x T-bill returns and DeFi composable with government-issued debt notes. So at this point of RWA, real-world yields, we see that most of the DeFi liquidity providers on-chain treasuries are stuck with US treasury bills, which is around at maximum 4 to 5%. However, in real life, most of the liquidity is starting to pivot towards emerging markets, which has the juiciest yields, obviously. But we are not yet leveraging the blockchain benefits to bring these global financial products in global distribution. Right now, there is only 1.3 billion non-US government bonds, which are mainly European government bonds that has even less yield than US Treasury bill. So at this point, as Monetary, our solution is tokenizing Turkish Eurobonds. Right now, there are 36 Eurobonds that are issued by Turkish government in European and US markets that has maturity of around 5 to 7 years. It floats around 5 to 11%, depending on the bond. So we are working with an investment bank, which is also we are actually a subsidiary of that investment bank. They are already running some funds to their sovereign clients. We will just basically tokenize their strategy. We are adding 300 to 500 BPS premium over treasury bills. These are government-issued debt notes, no DeFi algorithms or anything. Our structure, which I will deep dive next slide, is institutional-grade FINMA custody with Clearstream and security agent. So how our operation works is this. We have a Cayman Foundation, which has no beneficial owner. This Cayman Foundation will issue a debt note that will be bought by our Nexum Bond SPC. This Nexum Bond SPC will be the SPC that the investors will be investing in, and this SPC will buy the debt note. Eventually, we will be working with Incor Bank as a broker. There were other options, but we believe it is the best way to go in European market rather than US market. Incor Bank will have a segregated Eurobond custody account under Clearstream, and we will also work with the security agents in terms of collateralization. The tokenization regulation will be under Swiss Art and will be under our battle-tested smart contracts. So how it works, it's very simple, straight. You deposit USDC, you mint the tokens, which represent fractional shares of SPVs that we go and buy Eurobonds for you. So at this point, the important notice is how do we manage the collateral for you to maintain the dual finality. So after your post-subscription, we give the order to our broker. He settles it right away, even though the bonds come at T2, but you already lock your cash and trade claim. After post-settlement, the Eurobonds stay at Clearstream, which the whole world works with. And we use buffers to provide your redemption, which is not only sitting on idle cash, but also overnight repos that we can easily redeem in the daily time. So how about our bankruptcy remoteness? If we go bankrupt, it doesn't mean anything. We don't have any beneficial ownership with the foundation. As I said, it doesn't have any ownership. What happens if Incor Bank goes bankrupt? It doesn't mean anything because they only have a segregated account under Clearstream, but the real custodian is Clearstream, not Incor Bank. What happens if SPV defaults? We are working with a security agent which will lower the yield, but cover the collateralization, which most of the European private credit funds are already working with, and is a battle-tested option for collateralization in real-world assets. So what is the yield source really? It is a coupon income. These Turkish Eurobonds are semi-annual coupons. Our fund will go around 7%. There will be accrued interest daily from NAV, from our fund manager. So there is some price movement variabilities because of risk assumptions, which is sovereign credit. Right now, for the past 1 year, Turkish credit risk has been increasing, but it has not always been the same case. It can fluctuate. Also, we can have struggling with liquidity buffer depletion. We can be on the wrong side on a wrong day, like Iran war or an Israel war, that we can maybe go and stop redemptions for 1 day. Our smart contracts are battle tested. I will go into that. And in terms of counterparties, our counterparties are really solid traditional finance brokers and custodians. So in terms of our regulatory pathways, we will go with phase 1 fast launch with Swiss FINSA exempt. It will be qualified investors, no prospectus, and minimum ticket size around 100K. Then we will go and try to get the EEA passport with Liechtenstein prospectus in the head with our investment bank. So our phase 2 is obviously go into this permission lending looping strategies, or even like centrifuge wrapping this token into a more DeFi compatible utility token. But for now, it will be whitelisted only. In terms of competitive landscape, this is no arbitrage, this is no crypto strategy. This is real life government bond yield that is 2x the treasury bill. And as I said, plain and simple, we are giving you 2x T-bill yield. We are your local provider that US or European brokers that don't have the know-how, don't have the network, and don't have the brokerage to provide you this emerging market real-world yield. So our roadmap is that we are right now, actually I don't have much time, we are working with TerraBank. We are doing their licensed custody service, and we are also working with Cointra to give them our gold tokenization project. After these 2 projects finishes at the Q2, by the way, the gold tokenization ICO will be starting around 10 kilobars, which is also huge. We will go straight dive into the Eurobond project. We are also working with Visa in Turkey to Eastern European corridor for a deposit token for Turkish banks. We are working with a core banking partner, Fimple, in that project as well. And in terms of KYC AML, we have embedded Osprey's solution into our tokenization infrastructure. So thank you for listening, and happy to answer your questions.
Okay, thank you. I want to ask about the business model. I got maybe a bit lost in the beginning. So you are infra provider, right? But this, so you can white label, or others can white label, but this Turkish bonds is something you do yourself, or no?
Yeah, we will be doing the tokenization issuance from our platform, but we will be working with a brokerage, but eventually the issuance will be on our platform, so we will get the fees.
Okay, but for the Turkish one, it's like part of your business model, or no?
What do you mean by the Turkish ones?
The one you described in the presentation, like the Turkish Eurobonds structure.
Yeah.
That's done by some client of yours, or it's?
No. The TerraBank is our holding company.
Okay.
They are an investment bank. They already run these Eurobond funds to their sovereign clients. We are just providing them a new distribution channel in DeFi.
Okay. So you are the infrastructure provider?
Yep.
Okay.
So just to clarify that, so the Turkish government is issuing a Eurobond, and you're tokenizing that and putting that in on-chain? Yeah.
Yep.
Okay.
These are dollar-denominated sovereign-issued government bonds, around 5 to 7 years maturity. There are 36 of them right now in European and US markets. They are in average issuing 4 in every year, but it fluctuates.
Did you write your own smart contracts, or are you using some existing solution?
You know, we wrote our own smart contract in Gold, and in this project, for our Gold tokenization project, we already have an audit from Hacken, and we are also talking with Halborn guys to have an additional audit. Maybe we will go into double audit in the Eurobond tokenization as well.
On which chains are you deployed?
Right now, for Gold, Ethereum and Stellar, but we are talking with other RWA chains as well. And for the deposit token work with Visa, we are working on Canton, but it is not for the Eurobond, obviously.
How interoperable is the token with DeFi, given KYC requirements?
Yeah, it is not with the permissionless ones. It will be only open to permissioned lending markets like Horizon. Or another solution is to wrap the token like Centrifuge to give composability, but it is not our phase 1 problem. We are just looking to provide the tokenization and work with LPs to give it a start and see what we can do with that. Thank you.
Thank you, everyone. So now, guys, it's your job. 2 minutes to decide the winner. So you can group. Yeah, also here, no one will listen. Yeah. And then you tell me. Actually, I will listen. I will turn off the mic.
Is it off?
No. Yeah. It's already. It's gone. You know exactly. So
for me, to find it now, interesting. Also like at this, but I got the computer, and it's also like.
Hello? Okay, guys, you can sit back. We have a winner, we have a name. So, the winner of this Zero TVL competition for StableSummit 2026 first edition Cannes is Twain, sorry. Sorry, guys, I'm pregnant and my brain stopped working at 4 p.m. So, but it's Twain. So Taulant is welcome on the stage. But Polaris is second place. So, congrats to Polaris because the judges were undecided. Please.
Thank you so much.
But all the rest of the pictures can come for a picture, right? We need to make a picture, correct? So everyone jump in. Twine, not Twain. Not Mark Twain. I said I'm pregnant, guys. You need to bear with me. With the judges too, please. Congrats, second place. Okay, I will. Done? Cool. That's it. We will put you in touch with the guys for your prize, the consultancy. Cool. Thanks, guys. It was fun, anyways, to hear you.
Thank you.
Polaris.